from my conversations with traders and investors, it's more of a gradual process that's already been set in motion.
Okay, all right, well, at least that would avoid knee-jerk reactions, which are never really favored by the market. Okay, Lisa, thank you very much for that wrap-up. Right, let's just look at some stock-specific news for a moment. SK Hynix shares have surged some 12%. This is after the South Korean chipmaker announced a $29 billion share buyback plan. This is a move that's part of its broader plan to return half of its free cash flow to its shareholders. It follows a recent plunge in its share price amid investor concerns over the durability of global AI spending. And since we're talking about AI, India and Dubai are stepping up their cooperation in the AI space. India's National Association of Software and Service Companies, or NASSCOM, has signed an agreement with Dubai's Chamber of Commerce to accelerate the adoption of agentic AI within the private sector and support Indian tech firms entering the Emirates. The partnership aims to boost operational efficiency and capitalize on advanced technologies following Dubai's goal to become a global leader in AI deployment. Also, Charles Schwab is expanding its presence in India with plans to grow its new Global Capability Center in Hyderabad to around 2,000 employees by the end of 2027. The US financial services firm says that it plans to hire around 500 people in the first year, with recruitment to follow in phases. The center will provide tech, engineering, and operational support for Schwab's US businesses, including bringing some technology work currently handled by contractors in India in-house. Well, there's been a lot of concern about AI disrupting India's job market. Goldman Sachs says the adoption of Gen AI will have wide-ranging effects on India's economy. Its baseline view is that in the medium term, it will be positive for India's growth outlook, but the impact on the labor market will be uneven. We're going to talk more about it. Shantanu Sengupta is the chief India economist at Goldman Sachs, and he joins me down the line now. Shantanu, it's great to have you with us on the program. First of all, I want to get to that jobs and AI conversation, and I want to understand a little bit more about this report and what it's actually signaling for us. But before we do, we have so many macro stories on India today to digest, and I first want to get into these RBI minutes and the inflation picture and couple that with what is happening in the United States at the moment with this bond buyback program. What sort of a scenario has it created for those waking up in India today looking at the outlook?
Yeah, thanks, Manisha. So the RBI minutes, in our view, was clearly hawkish compared to the governor's statement. So if you just look at the sequence of events, the governor's statement we thought was quite dovish, especially given the circumstances in terms of inflation, oil prices, the food inflation shocks which were possible from the El Nino on August 5th. Thereafter, the press conference we thought was slightly more neutral, and by the end of the day, you had a VRRR from the RBI sucking out some liquidity, about $1.5 trillion. So that went slightly more hawkish by the end of the day. And then 14 days later, you have the minutes, which is looking hawkish in our view, especially Deputy Governor Poonam Gupta pointing out that monetary policy action could be considered later in the year if inflation indeed remains high. I think there are two things that the RBI is really watching. One, whether you have a food inflation shock from the El Nino, which can materially take food inflation higher. Our base case is that it will not in this year. It's more of a next year story, and we can come back to that why. And B, they'll be looking at the broadening of core inflation pressures, especially in core goods and core services baskets. Now, evidence until now is suggesting that core goods is broadening out, but core services is still relatively benign. So our sense is that 2 rate hikes from the RBI in this cycle, 25 each in December and the February meetings.
Okay, so you talked about, we can get into why on the food part. So why are you saying that that's perhaps a next year problem? But also, why did you actually not mention just then oil prices? Because, energy prices is something that is definitely spooking markets across the board, and we're seeing no resolution over the situation in the Strait of Hormuz. This continues to be an ongoing back burner concern. So if you could answer those two whys, that would be great.
Sure. So oil first. Look, I think what we have learned over the last 3 or 4 months is that there are fiscal and quasi-fiscal levers that India can pull to let the international oil prices not pass on to the consumer. I think you've seen fiscal policy at work through the excise cuts on pump prices of petrol and diesel, and you've seen the oil marketing companies take some hit on their balance sheets as well. So as long as oil price volatility is temporary, and you're having this range of 80 to 90, we think it'll be absorbed by the fiscal and the quasi-fiscal. If oil prices are indeed elevated and stay at, call it like late 90s or so, that is when the pass-through question again comes up in our view. On food inflation, look, there are two structural reasons. The basket, the new inflation basket, has about 9 percentage point lesser weight of food than earlier. So food actually contributes lesser to headline inflation now than in the past. And B, India is more irrigated now than in the past. I mean, you've had about 10 pp increase in irrigation, and therefore the dependence on the monsoon rains is relatively lesser. You still depend on it for the winter crop. But again, we are finding that inventories of rice and wheat are at 11-year and 5-year highs. So you should be able to take care of a cereals production shock cycle now. And therefore our point is that if there's a risk, it is more backloaded than immediate.
Okay, before we move on to AI and jobs, just one last question on this bond buyback program. So there are a few things happening over in the US which is going to have a material impact elsewhere. One is this bond buyback program to bring those yields down, particularly in the 10-year and the 30-year treasuries. But also it is realizing that US debt is now running at, $40 trillion. This was a figure that came out overnight. President Trump was asked whether any of this is a problem for the American people. His response was essentially, I don't think so. There are some who are saying that this is a pre-midterms policy decision from the Treasury. But there are lots of wider questions about this. All of this has put pressure on the dollar index. There has injected those dollars into the system. But we have seen this ongoing volatility that emerging market currencies are facing. And this is all based on what is coming out of Washington. How does this sit from India's perspective?
Look, on the currency, that is the dollar INR in particular, we think that the RBI had bought itself some time with the FCNRB flows. Now that they have stopped the FCNRB flows, but you've had about $50 billion of inflows, we think the net number is somewhere in the 40s or early 40s. The ECB program will still be on till the end of the year. We think that you will have enough flows to take care of any currency shock for the foreseeable future, which is over the next 3 to 5 months or so. Thereafter, I think the deeper questions on whether India gets equity flows back, FDI net inflows back, all those questions will come up. And therefore, we also think that that is one of the reasons, I mean, that's not the primary reason, but one of the reasons why the carry needs to be slightly higher than where we are today, given the exact dollar environment that you described earlier. So that's why we are penciling in a couple of rate hikes by the end of the year.
Okay, so you guys produced this report, and this was sort of looking at, AI, job creation, some various factors. It was really made some quite fascinating reading. If you needed to direct people to what you thought was the most interesting, most impactful finding from it, what would you say?
We think that the labor market story that is being painted is one of doomsday. But what we think is that augmentation and not broad-based replacement is the dominant labor market story, at least in the initial phase of adoption. I mean, our findings are that around 8 to 12% of the non-agricultural labor force could face substitution risk, but you have nearly 45% facing complementarity from AI adoption. So that is the first thing I would point out. The second I would say is that there is about 40 basis points of productivity improvement that you can have if you have adoption. And then final, which is super important, is that if firms deploy AI in the labor augmenting way first, especially in GCCs, you talked about a GCC opening earlier in your show, healthcare, education, finance, other business services, India can capture the productivity upside faster while limiting the labor market disruption. But if the adoption is only for disruption, labor market disruption first, then you'll have a drag on growth from job losses, etc. So I would say that you asked for one, but I would say those are the three main takeaways.
Okay, so I think it was interesting that in the Independence Day celebrations, the Prime Minister was very quick to pick up on the youth of India. This has been a very prominent theme given recent developments. So I had this sort of question, India has the world's highest Gen Z population, but can India produce enough quality white-collar jobs over the next few years, especially when there's this ongoing conversation about how AI, and you've already alluded to the replacement part, but it can also make people much more productive, can't it?
Look, again, our point is that the labor market productivity will be, as I said, about 40 basis points higher, and it has a pretty wide range of about 0.1 to 0.8 over a 10-year adoption period. I would be careful about white-collar jobs. The way AI adoption will probably happen, not just in India, but elsewhere in the world also, I think you'll be making a distinction between what kind of jobs you produce in terms of white-collar versus blue-collar. And one of our findings was that the physically intensive tasks, construction, mining, parts of manufacturing, remains less prone or directly exposed in the near term to AI. And maybe for countries with large labor forces, that is one way to look at spreading the.
Yeah, really, social media is abuzz with two words today: Treasury buybacks. And the superlatives have already been flying all over the place. This is QE light. This is, according to one Wall Street hack, Operation Twist all over again. So we are being forced to talk about Treasury buybacks. And in this video, I'm going to tell you what a Treasury buyback really is, as well as its real purpose, as well as what its real purpose is right now today. There is a ton of misinformation out there about it, which, by the way, always keep this in mind, is on purpose, on both sides in this case. Those who are upset about Treasury buybacks, making a big deal about them, as well as those who are announcing the Treasury buybacks and doing it. There's disinformation on both sides and misinformation on both sides. We're going to clear all that up, what Treasury buybacks really are, what they're supposed to be, where they fit into the grand scheme of things right now, the bond market, as well as, yes, there's a long history behind them. We're going to get everything clear here. And yes, this is one of those topics that we should not have to cover, but because economics and the mainstream does such a horrible job of educating the public on mainstream or basic fundamentals for Main Street, nobody really knows what any of this stuff is. So it's kind of like this gets announced. So based on your biases, fill in the blanks. And by the way, again, like I just said, this is what they're counting on. They're counting on a headline making an impact on both sides of the equation here. Nobody's really interested in what's happening. So on the one side, you've got everybody screaming about how this is QE or QE light. Like I said, one Wall Street firm's already comparing this to Operation Twist, which if anybody knew what Operation Twist was really about and how it performed, that would not be a favorable comparison. But anyway, everybody is shouting about it. There's a big reaction in the gold market, which I will explain and get to at the end of this video. But before we get there, we got to talk about Treasury buybacks and how and why everybody sees this as potentially money printing. And the true answer is, anything the government announced, whether it be the Treasury Department or the Federal Reserve, and yes, the Federal Reserve is part of the government, immediately the usual suspects are all pointing the finger at money printing. The money printer go over, this is inflationary, this is more money printing. So that's one reason why there's been such a huge reaction to what really is not worth reacting to. But that's where we start with the react QE, the comparisons, money printing. More grounded analysis is really about, okay, understanding that this is the Treasury Department trying to change the subject. Everybody over the last couple of days has been talking about the 30-year long bond. The Treasury Department, the president, the administration would prefer that nobody talk about the 30-year long bond. So as far as a symbolic approach to what's happening or a symbolic response to what's happening, shake things up a bit. Make it seem like the U.S. government has the ability to control interest rates. And there's another term that has been thrown around, yield curve control. The Treasury Department is throwing around or testing yield curve control. And it's understandable where this is coming from. Yes, the 30-year long bond, as I've done a couple videos on this recently, and I highly recommend you check it out to see what's really going on in the long bond in the Treasury market. But the 30-year long bond hit its highest yield since 2007, which makes from one perspective, a terrific headline from the media perspective, certainly social media perspective. From the other perspective, the government's perspective, a headline that they would wish people would stop talking about. You see where I'm going with this? How do you get people to stop talking about the highest 30-year long bond yield since 2007? Well, you got to do something about it. You got to announce something. And the other bigger part of this, which has less to do with interest rates than you believe, is that very quietly over the last little while, the U.S. government very likely crossed the 40 trillion mark, the 40 trillion threshold in the amount of debt outstanding. That's the real problem here, not the Treasury market and interest rates. It's the out of control government. So once again, put these things together from the government's perspective. How do you flip the narrative? Let's stop talking about the national debt, which continues to get higher and higher and higher. Let's start talking about how we can control interest rates, and therefore it's not that big of a problem. They can't control interest rates. Interest rates are not the problem. Interest on the debt is a bigger problem. The spending on the debt, the spending that comes along with the debt, is a huge problem. But those are not about what we're talking about here. This is a political operation, a symbolic measure to try to get people to talk about something else other than the massive political problem, social problem of the deficit, which is not a Treasury market problem. But because nobody understands interest rates or yield curves, everybody is flipping out about the 30-year long bond. So the question answers itself on both sides. Misinformation on the one side, the government would like to change the subject and talk about anything other than the 30-year long bond and its $40 trillion debt. Meanwhile, those on the other side who are critical of that $40 trillion debt would like to prove their case by saying this is money printing and it's going to lead to hyperinflation and everything they've been shouting about for 20 years since they first started with TARP and QEs. Misinformation on both sides. But let's actually talk about what a buyback really is. Let's go beyond all the headlines and all of the misinformation and all the tweets and everything else. Let's talk about what a buyback really is, and then the history of buybacks and how they've been buying back bonds for a lot longer than you think, and nobody was well, they have been shouting about money printing, but it's pretty clear that's not the case. Before we go on with our video today, let me ask you a question. What if your gold could actually pay you every single month in more gold? That's what today's video sponsor, Monetary Metals, lets you do. And here's how it works. You still own the gold, it's still in your name, it's fully insured, but instead of just sitting there doing nothing, it actually starts working for you. Monetary Metals has built a system that turns idle gold into productive gold, earning real yield paid in physical gold, not dollars. No selling, no trading, no converting. You keep your gold, and every month you get more of it. It's a simple idea, but it solves a big problem. If gold is money, it should act like money, and now it finally can. If you're a long-term gold holder looking for a smarter way to store value, check them out at monetary-metals.com/Snyder. Again, that's monetary-metals.com/Snyder. I highly recommend booking a call with them today to see if they're the right fit for you. We thank Monetary Metals for their sponsorship, but now let's get back to the rest of our video. So a Treasury buyback is actually really simple. The idea is you issue more Treasury bills than you actually need. So in this case, just hypothetically speaking, let's say the US government needs to raise $100 billion in bills, which by the way, these days it is pocket change. I mean, there are weeks when they auction off $100 billion in a single 4-week bill auction or a single 8-week bill auction. So $100 billion is actually a drop in the bucket, which means the numbers we're talking about here for these buybacks are tiny. Even if you do think it's a money print, even if it was money printing, the amount is so minuscule that it amounts to a rounding error of a rounding error of a rounding error. Everybody's excited about a couple $1 billion when the government regularly auctions off $100 billion increments every single, not just every week, but a couple days every week. So let's just say, hypothetically, we need $100 billion from Treasury bills total. So the government, instead of raising $100 billion, raises $104 billion. Now it has $4 billion in additional cash that it didn't actually need for all of its stupid purposes, transfer payments and wasting money and all the fraud that gets perpetuated in the people's name. So we got an extra $4 billion from our Treasury bill proceeds because we borrowed more from bills than we needed. And by the way, the market loves the bills and the market wants the bills, which is why they sell the bills. You take those extra $4 billion and you go over here to the long bond or the 10-year bond and you buy those with the $4 billion. But here's the thing. This is the real purpose behind a buyback. You're not buying just any old Treasury bonds or notes with that $4 billion. You're buying what are called off-the-run securities. And these are securities that were auctioned off a long time ago, maybe last year, maybe 10 years ago for a 30-year bond that's 20 years old. It was auctioned off 20 years ago. These are securities that do not have a liquid market. That's one of the problems with, again, lack of information from the mainstream. The Treasury market is the deepest, most liquid in the world, but that doesn't mean every single security that was ever issued by the Treasury Department is itself liquid. In fact, what you find is that the most liquid issues, where they do have a ready market for, are what's called on the run, the most recently auctioned off securities. Off the run securities, yeah, you can buy and sell them as you need to, but if there's ever an issue, if there's ever a pickup in demand or a pickup in sales from whatever reason, usually dollar shortage reasons, if there is a rush of sales of off-the-run securities, that's where it leads to these problems that we've seen over time. This is where all of this Treasury market liquidity broken nonsense is coming from. It stems from largely March of 2020, when there was a rush of reserve managers selling their reserve assets, which happened to be off-the-run U.S. Treasuries, which don't have a liquid market for them. And the dealer network couldn't handle all these off-the-run securities. They couldn't repo them in repo. They couldn't sell them without having to take a little bit of a haircut. So the point is, when you have a lot of people who are trying to sell their off-the-run Treasury securities at the same time, because there is not a ready liquid market in off-the-run securities, the geniuses at the Treasury Department said, well, what if we create a program, a regular program, where we use additional proceeds from bills to buy these off-the-run securities regularly so that the marketplace knows that at least the U.S. government will be the marginal buyer for these off-the-run securities. That's all the buyback program is. Forget about all the other stuff we're going to talk about in the rest of this video. It's not money printing. It's about trying to deal with what might be considered a technical flaw or a technical weakness in the Treasury market. That isn't really a technical weakness, because the reason why reserve managers and other people who have off-the-run treasuries have to sell their off-the-run treasuries in periods like March of 2020 is the thing that we never get to talk about. We're not allowed to talk about why they sell in the first place in bunches. And that's the dollar shortage. We know what's happening here. Dollar shortage hits, reserve managers have to sell the reserve assets. And if a lot of reserve managers are selling the reserve assets, which happen to be off-the-run treasuries at the same time, there's difficulty in doing so because there is no liquid market for off-the-run treasuries. So a treasury buyback in this context is intended to help solve a problem, a specific technical problem about liquidity in the treasury market pertaining to the fact there is no liquid market for off-the-run securities. It's not anything other than rejiggering bills versus bonds. There is no policy here. It is entirely about the marketplace. However, that doesn't mean, as I just said before, that there aren't other reasons behind announcing something like what we got today. What was announced today was nothing more than the Treasury Department is going to double the pace of this buyback operation, which, if you're listening carefully, you already know the problem here, at least one of the problems here. Double the pace of an existing program that has been existing for, well, let's get into the history here, because nobody knows that either. Yeah, this is frustrating to have to go through this. Again, I don't blame people. I don't blame people on social media. I do blame some of the so-called experts who think that they're experts. This is really about central bankers and economics and the mainstream media who just fail to educate the public on any of these things. And so the Treasury Department is counting on these headlines to come out that make it seem like it's in control, like this is actual yield curve control when it's just, like I said, a drop in the bucket here. But Treasury buybacks, the Treasury Department has been talking about buybacks since at least October of 2022, at least in the modern or the more recent incarnation. Actually, there's a much longer history of buybacks that go even further, which I'll get to in a second here. But in October of 2022, which the timing here is not accidental, and I'll get to that in a second too. October of 2022, the Yellen Treasury Department started talking about buying back their debt. And of course, it made such a huge issue at the time, especially with consumer price rates still. They weren't accelerating, they had already started to come down and decelerating, but the consumer price rates were still pretty substantial. So you can see where the money printer go burr people latched onto this and say, okay, here comes more money printing on top of the money printing that went on in 21 and 22, 2020 and 21 and 22. So at the same time that long-term and short-term interest rates are rising, though importantly, short-term rates are going up much farther and faster than long-term rates, but if everybody missed that signal too. But there was a reason why the buyback issue came up in October of 2022, because of what's really going on here, which is symbolism and psychology and sentiment, not actual money or really any kind of policy other than trying to change the subject or trying to get people to think that the government, your good government, is doing something about rising interest rates. So buybacks were already on the table as early as October 2022. It took the Yellen Treasury Department a couple of years to actually do it. It wasn't until May of 2024 that they finally announced that they were going to do this buyback program. Why? Well, because interest rates had calmed down in between late 2022 and early 2024. However, they started to pick back up in 2024, and with an election looming, the Biden administration had to make it seem like they were going to do something about rising interest rates, because rising interest rates were going to be double digits, triple digits. Just listen to what Jamie Dimon was saying in the middle of 2024. It was going to be a huge problem. So in May of 2024, you can't really see it there, but it's May 1st of 2024, the date of this press release, the Treasury Department announced that it was going to start buying back treasuries in exactly the manner that I just diagrammed for you before. They issue a little bit more in treasury bills, in this case, $2.5 billion more in treasury bills, $2 billion of which we're going to buy coupon securities, notes or bonds, and $500 million to buy some tips. So again, the alarm bells, the bright flashing right in your head, light bulb should be going off. Yes, the Treasury Department has been buying back treasuries since the middle of 2024. You see why I said, why the f are we talking about this stupid Treasury buyback program? The announcement was intended to have this effect to get people talking about everything else other than the current state of the 30-year long bond, or more importantly, the $40 trillion in deficit. The Treasury has been buying back these securities since May 29th of 2024, 2+ years ago. $2.5 billion. So we went from $2 billion, which was a drop in the bucket, to now 2.5 when you include the tips, but just for treasury notes and bonds, $2 billion to $4 billion. That's the only thing that has changed. We've gone from $2 billion to $4 billion. These are not huge numbers. These aren't even at the margins. They're the margins of the margins of the margins. Yet everybody is going ape shit crazy over it because They want to go ape. They want to do the misinformation. And of course, back then in the middle of 2024, that unleashed the same kinds of tirades. So another key clue here, another thing to focus on, is how this happens repeatedly. And every time it happens, it just disappears because it's never what everybody says it is. And then when we come back and revisit the thing again, nobody ever explains what they got wrong the first time. Same thing with QE and QT. QE was money printing. Where'd the money printing go? Well, okay, the next one's money printing. The buybacks in 2020, that's money printing. Then no money printing. The next one's money printing. You see, we keep repeating this because we all sit in ignorance thanks to the mainstream media, the economics, and central bankers, as well as politicians who have every interest in keeping people ignorant. They even like the fact that their critics tell them that they're money printing because it makes it seem like the government is powerful when it actually isn't. This is all symbolism. This is all symbolic. But of course, back in 2024, you had all the usual suspects lined up for the money printing and how this Treasury buyback program, which is a pitiful $2 billion, $2.5 billion when you include the tips, how that was a drop in the bucket. Yet this was going to, as Rubini said, that moron, Rubini said this is activist treasury issuance. The Treasury Department is manipulating the yield curve. They're doing stealth QE, and at the time that was stealth QE was hindering the Fed's ability to stamp out inflation because remember May 2024 sticky inflation. This was going to be a huge problem, higher for longer. All that stuff that wasn't actually happening. So you had all of these experts who were talking about how this was backdoor stealth QE in the middle of 2024 and how it was going to reignite inflationary pressures just in time for an election, by the way. Again, that's both sides, critics as well as the government under Biden and Yellen. Biden and Yellen had a very vested interest in making people believe that they had everything under control, and the people on the other side had a vested interest in making people believe that they didn't have everything under control, when all of this is just trivialities. And including the Rubini wasn't alone. Notice who his co-partner is, his co-author. Yeah, that guy. The guy who became Fed governor. So back in 2024, he was like, hey, we can't do this Treasury buyback stuff, this stealth QE, because we have an inflation problem. Then he gets appointed to the Fed in 2025, and what he said, oh, we need to cut rates aggressively. This is the kind of crap that we have to deal with and wade through because, again, everyone has an interest in making sure you don't know what's actually happening. And then they flip around as soon as it suits everybody else. So they went crazy about the money printing back in 2024 and then quickly forgot about it as the Fed ended up cutting rates because the biggest economic risk was, as we know, flat beverage and labor market difficulties. And all this stuff just disappeared until it became politically convenient for the next administration to resurrect it in 2026 because too many people were talking about long-term interest rates and they wanted to change the subject. And they knew if we double the rate of buybacks, at least the buybacks of the coupons, it will create headlines that do exactly that, which is change the subject. It makes it seem there's going to be people shouting across social media how this is yield curve control. We're going to control the yield curve with just a couple billion extra buybacks, despite the fact we've been buying back at $2 billion, $2.5 billion for years already. It's such pitiful horseshit. So anyway, buybacks didn't even start in 2022. You go back to 2000. In fact, you go back earlier. The buybacks were actually started in the 1920s and 1930s. But March of 2000 was when we first started to get buybacks in the modern era. Bill Clinton's administration talked about buybacks. But back then, the context was very different. And you did not hear anybody talking about the money printer in 2000, even though at the time, and maybe some people were, gold bugs in particular, were worried about, government interferences. But back in 2000, it was a mechanical technique to help solve what was then a very different set of problems, which was the Treasury Department was running out of bonds to issue. As the U.S. government deficits were increasingly disappearing, what that meant was for the government and for the Treasury market, some of the issues that were important to the marketplace were becoming difficult to sort. They were becoming illiquid bonds, and so the Treasury buyback back then was because we were running out of bonds to sell the marketplace that still wanted a lot of bonds because the marketplace needs Treasuries as collateral and other things. And it needs specific kinds of Treasuries and specific kinds of collateral. So it was really just a technical thing. And back then, for whatever reasons, and we can fill in the blanks here, people actually understood what the buyback was for, and there was no media flip up. Maybe it's just the fact that social media makes every opinion easily distributable. But back then, at least people, there was no freak out about Treasury buybacks because people understood the context and what it was really actually for and actually about. And of course, on the government side, as I just mentioned, it's all about symbolic gestures these days. But this did lead to one of my favorite quotes of all time. Bill Clinton in March of 2000 issuing a statement where he said, the U.S. will be on track to be debt-free by 2013. I'm going to pause here for a couple minutes while you pick yourself up off the floor from laughing. We were going to be debt-free by 2013, and instead, 13 years onward after that, we're $40 trillion in debt. So let me back up here one last time before we wrap this up and get into gold. It's understandable where all of this stuff comes from. The media shouts about a 30-year long bond rate that is the highest since 2007. And in the video I did yesterday, I showed you exactly why that's not what everyone thinks it is. 2007, not exactly high rates. So already, but 40 trillion in debt, the highest 30-year long bond yield in 19 years, you can see where people are starting to say, holy crap, the debt market is cracking, this thing is coming down. So you can also see where the Treasury Department comes in, understanding that this is not what everybody says it is, but wishing to change the subject, and doing so with a pitifully small amount of a technical program whose purpose is to try to ameliorate a technical issue in the Treasury market. It really is this silly. It really does get to be this silly. But it all comes down to the fact that nobody knows what any of this stuff is. And so it's easier to just shout in these big ways, QE light, this is yield curve control, when none of it is true on either side. It's not QE, nor is this some kind of control on the part of the government. But both sides want you to believe that, either to make the government the villain or to make the government the hero. And of course, the truth is almost always in the middle. As I went over yesterday and again in the video, what was that, last Friday, what's really going on in the 30-year long bond? So the first buyback program, October 22, I mean, look at the timing here. Now, the buyback announcement did not change the trajectory of the 30-year long bond. It was just coincidental. But the 30-year long bond, there's a reason why they brought that up in late October of 2022, because long-term bond yields were spiking. And they were spiking not because of inflation over the long run, but because the Federal Reserve was raising rates at the short end. And so the curve had already radically inverted. The long end was resisting it. But as far as most of the mainstream are concerned, including Treasury Department officials under Biden, this was a big problem, so they needed to change the subject, which they did, and we went on to other bigger issues beside that, including the banking crisis, which showed up a couple of months later. When did we actually do the buyback program? Again, like I told you before, when Treasury bond yields were spiking in the middle of 2024, higher for longer, an election, which was just a couple of months away, so we're going to institute yield curve control in the middle of 2024 because long bond rates are rising once again. The Fed is talking about inflation, all that kind of stuff. And then when fast forward to 2026, now the buybacks are doubled to change the conversation away from the $40 trillion in debt that we are and the 30-year long bond that, as you can see from the chart that I'm showing you, isn't actually all that higher from where it was when we first started talking about Treasury buybacks a couple of years ago. It's about a half a point higher than it was back then. That's it. 4 years, buybacks, money printing, and the 30-year long bond is about half a point higher in yield than it was 4 years ago, despite everything and the trillions and trillions of dollars of debt that were issued in between. Yes, my veins are starting to pop out here because this is all so damn stupid. And it really isn't that difficult to understand what's taking place. But again, it's understandable why people don't get this, because you're never given the full truth. Nobody ever shows you the charts, nobody shows you the markets, and nobody ever explains what these things really are or really come from. They are counting, both sides, they're counting on you filling in the blank with your biases, because that's what basically the entire modern political movement has been built on. So long bond yield, I mean, like I said, I did videos. If you want to explain what's really happening on the yield curve, it's nothing more than steepening with a Federal Reserve that won't get out of the way of the front end. And even the rate of change in the 30-year long bond has been decreasing. But from the Treasury Department's perspective, they can't make that case. They have to try to change the subject and get people talking about yield curve control to get people to believe that there actually is control of the yield curve within the grasp of the Treasury Department, which is absolute crap. But then, one last thing is gold. Gold is up about 3.5% today. In fact, I'm looking at the chart here, 3.6%. So gold is making a big move, which, of course, then a lot of people, isn't that money printing? Why would gold be up if it's not money printing? It has to be money printing because gold is rising 3.6% in the aftermath of the announcement. And that part is true. Gold has absolutely jumped. But look at the chart here. Gold is up on a single day for the so-called money printing after being up sharply going back to the early part of August. So this is nothing more than another leg up in the rebirth of gold, at least a short-run rebound in gold. So gold already had some short-run momentum behind it. The Treasury Department announces this, and the social media immediately seizes upon the money printing, calling it QE. It adds a little bit more to the momentum, which means more market players chase gold on a single day. Gold is not up because the Treasury Department is about to print a bunch of money, which is, again, pitifully small amounts. Gold is up because gold has been up over the last couple of weeks and has been up sharply over the last couple of weeks for reasons that have nothing to do with what we're talking about here, except the fact that the 30-year long bond yield is not rising all that quickly when it should be rising all that quickly if everybody was right about what they're talking about, inflation, debts, and all that other stuff. It's the other side of it, demand destruction, safe haven demand. But on a day when everybody's piling into gold for, I'll call it all the wrong reasons, of course gold is going to pop even higher. That's not proof that this is somehow money printing. That's only evidence that gold is on a little bit of a run here. And so this is a short run catalyst, even if it is the wrong interpretation of something that very clearly nobody has any idea what's actually taking place here. And so that's the final message. Again, always keep this in mind when you're listening to both sides of every equation. They both have every interest in giving you the incorrect or incomplete picture. The Treasury Department in this specific case wants you to believe they are doing something substantial about a topic that is all over the financial media. And the reason it's all over the financial media is for largely political reasons. If you're a Democrat, you want to pound on President Trump, he's destroying the Treasury market, even though that's not actually true. By the way, this is bipartisan. A couple of years ago, everything we went through, the Republicans said the same thing about the Biden administration. Everybody wants to use the dollar dollar and the Treasury market as proof positive that whoever's in office at that particular point in time is ruining the country. They may be ruining the country, but they're not doing it in a way that actually affects the Treasury market. In fact, the more they ruin the country, paradoxically, the more demand there is for U.S. Treasuries. And therefore, we really don't need the Treasury Department to add 2 drops in a bucket to a huge bucket that's called the Treasury market. So on one side, you got the Treasury Department trying to change the subject. On the other side, people who shout about everything the government does as if it's the end-all, be-all of money printing, hyperinflation, Weimar Germany. See, I told you they're going to print the money. Here it comes. And in between lies the actual truth. And the actual truth is the yield curve is not behaving in the way that everybody says. And the government, its critics, they're preying upon the ignorance of the population that they have a large hand in creating. So that's what's going on with Treasury buybacks, what they really are, the history of it, and why everybody is freaking out about it, and why I'm about to go pound on something because this is all really stupid. I'll see you again very soon. From October 9th through 12th, I'm bringing together a group of roughly 40 serious investors and financial professionals, along with some special guests and friends like Hugh Hendry and Mike Green, George Gammon, Brent Johnson, and a couple of other ones.
Program. So basically, the market is seeing this as yield curve control, right? Because interest rates along the curve too high for the economy. Let's look at the 10-year. I mean, mortgages, that goes higher and higher and higher. And at some point, that's going to dramatically impact the economy negatively. So the idea is Besant has to come in and buy the long end of the curve to keep interest rates down, because we know that global interest rates are exploding. And that's true. But the question is, why are they exploding? That's key. Let me go ahead and do a screen share. Josh is not here. He's off swiping somewhere on some app. So let's do this. There we go. Okay. Now let's go over to CNBC. Then we're going to shoot over to Zero Hedge. And I want to get, kind of the mainstream take and then the alternative media take. And then I'll give you my opinion as to how this will impact markets, not only today, but kind of on a move forward basis. Okay, here we go. First and foremost, let's get down to the nitty gritty. Treasury doubles debt buybacks. That's what they're calling it. What is this? I would more so call it Operation Twist. A lot of people online, FinTwit, I'm sure once we get over to Zero Hedge, they will say this is QE. Look, I don't like to agree with the mainstream media. It feels like weird to agree with Scott Besant, but I don't think this is QE. And the reason is because they're really not using the Fed's balance sheet. They might use the Fed to go out and buy the long end of the curve through their open market operations. But at the end of the day, they're funding this, Scott Besant, by selling the short end of the curve, the front end of the curve. And hopefully we'll get into that a little bit more and I'll explain it in more detail. But we're not really all else being equal. We're not increasing the size of the Fed's balance sheet. We're not paying for these with bank reserves. And to me, that's what would need to happen in order for you to call it QE. Key talking points here. The Treasury Department said Wednesday it will double the size or level of government debt buybacks in the next few months, targeting the sensitive long duration segment of the market. So basically 10, 20, and 30 year. Yields tumbled following the announcement, as you would expect. But the question is, what will they do tomorrow? And what will they do next week? I think that's a much more important question to ask. Let's keep going. With fixed income markets under pressure and yields surging to levels not seen in 20 years, the announcement targets the sensitive long duration part of the Treasury market. Right, but let's step back a moment. And you guys know from watching my videos, why are interest rates surging? Is it because debt and deficits and people just no longer want treasuries and the central banks are selling and there's a credit risk with the United States because you're going to be paid back in cheaper dollars and blah. You guys know all the arguments. No, that's not it. The reason is because inflation expectations are increasing. I mean, one of the trades I made today in my own portfolio was, I won't go into it in great detail, but it's basically the crack spread. So you've got the price of oil and you got the price of everything oil produces, and that delta is, I'm oversimplifying, but that's the crack spread. And so you've got companies that are really taking advantage of that, right? Well, if you've got diesel trading at $7 a gallon, which I read a story today, it is in California right now as we speak. Well, regardless of oil being at 80 or 85, which when you adjust for inflation, it's not that high. But regardless of oil being right in that range, you get diesel at $7 because the crack spreads are so high. In other words, what's happening is the producers or the refiners, their input cost is 80, but their output is, let's just say 200. When normally if their input was 80, their output, whatever they're selling, would be, let's just say 100. Those aren't the exact numbers, but you get it. I'm just using those as a simple way to explain the concept. So right now you've got these spreads just absolutely massive. Well, if those spreads are massive, that means that the inflation pass-through, if you will, to the real economy is going to be much, much, much higher than what the $80 price of oil would lead you to believe, right? Because at the end of the day, does the price of oil matter? No, the price of oil is actually irrelevant. It's everything that is refined from that oil, gas, diesel, etc. That's what really impacts the overall economy, okay? So the point there is you got these crack spreads, you got all the energy costs exploding, even if gas or even if oil's relatively tame based on what's happening in the Straits of Hormuz. And therefore, you would expect inflation expectations to go up. I mean, this isn't rocket science. You hear a lot of people try to explain this and they get into the weeds and it gets all technical and this and that. China's going to do this and the BOJ is doing this and Saudi Arabia is doing this and the petrodollar is doing this and the deficits are this and we can't fund the deficits, blah, 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 blah. And at the end of the day, it's just, you're just wildly overcomplicating it. And by overcomplicating it, you're losing accuracy. If you want to overcomplicate something, fine, but do it to increase accuracy, not decrease it. And if I say this in every video, but just pull up a chart, nominal GDP, the 10-year Treasury yield, boom, there you go. Enough said. Okay, but let's keep going here. But regardless, it is true that yields have gone up. Now, another thing, going back to yesterday's video, we talked about at what point do interest rates impact the economy or impact the stock market. And we forget that the stock market in the 1980s did this, right? The stock market in the 1990s, especially, it did this. And the economy did pretty darn well in those 2 decades. But yet interest rates were way higher than they are today. So just because you have higher interest rates, again, it doesn't necessarily give you all the information that you need to determine what the likely path is for the economy and the stock market. You've got to go back and listen to yesterday's video where we break it down to, well, what is nominal growth? Is it all inflation or is it all growth? Anyway, let's get back to the article. Under the accelerated buyback, Treasury, led by Scott Bessent, will target 10, 20, and 30-year portion of the market, which has seen a buyer's strike since late June. A buyer's strike. Come on. Rates, a buyer's strike. If we had a buyer's strike, the rates would be at 40% with no buyers. Come on, a buyer's strike. We've had more sellers than buyers. We haven't had a buyer's strike. And just to keep things in perspective, let's look at the 10-year Treasury. I don't want to let the cat out of the bag here because I want to do this at the end of the video and focus on this, because what we really have to ask is, what is the impact of this actually going to be? Right? We've seen all the central planners in Japan, with the help of Bessent, try to bring down the yen. In other words, defend the yen against the dollar. So the yen was at 164. They got to get it down because the yen's too weak. The yen's too weak. And they intervene. And you guys know what happens. It's like a broken record. It's like it's like a Rocky movie. Or it's like Fast and Furious. It's like, it's on the 12th movie. I've seen this one before. I know how it ends. It's the same thing with all these stupid interventions from the central planners. The yen goes from 164 down to 158. And then gradually right back to where it was before. It was just absolutely pointless. And in my view, interest rates are going to do the exact same thing. Because again, interest rates aren't about what Scott Bessent is doing. I should explain that a little further. Let me actually write this down because it's important. Because that doesn't make a lot of sense to most people. And I get it. Because when you sit there and say, okay, George, well, you've got the buyers and the sellers. When you increase the buyers, you have an artificial buyer in there with the Federal Reserve, then obviously that's going to bring interest rates lower than they otherwise would have been. That's just pretty straightforward. But that's not the way it works because there's a mechanical issue in there. Okay, so let's go to the 10-year Treasury yield. And zoom out. And let's see this buyer's strike. This is a 3-month chart. 3 months ago, we were at 459. basically 4.6. Today, we're at 4.65. So today, interest rates on the 10-year are 5, count them, 5 basis points higher than they were 3 months ago. And this is a buyer's strike? I mean, come on. What are we talking about here? What are we talking about? I mean, let's just zoom out even further. Okay, we got a year chart. A year ago, they were 4.3, so we're up 34 basis points. I mean, that's significant, but I mean, it's not like a catastrophic event. And it's not like, oh my gosh, right here, everyone just started getting worried about debt and deficits. No, this is all just inflation. Initially it's all about the war, and then people thought the war was coming to an end, you get the MOU, and then the MOU, people realize that it's just complete and total nonsense. And then they're like, okay, this thing might last a little bit longer than we thought. Therefore, rates go up higher and higher and higher, and the crack spreads blow out, rates go higher and higher and higher. Again, it has nothing to do with deficits. I wish it would. But at the end of the day, we've got to play and set up our portfolio based on how the market works, not how we wish it worked. Okay, so now let's go back to the CNBC article here. The benchmark 10-year fell 6 basis points. Long bond tumbled 9. Okay, yields and prices move. Oh yeah, okay, we got that. Okay, the increase in buyback operation size reflects Treasury's desire to provide liquidity to support long-dated nominal sectors where there is consistent, strong sponsorship. Blah, 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 blah. Could you please speak English, for heaven's sakes? My goodness gracious. Just speaking. I think what happens, and I had some experience with this yesterday, is the talking heads and the experts out there. I think 2 things are happening here. Number one, they've got their own lingo. So they kind of naturally default to that lingo. I get it. Number 2, I think they believe that if they just put things in simple terms, they won't sound as smart, or they won't sound sophisticated, or they'll kind of sound like a rube or someone that's just naive. But at the end of the day, it's like, do you want people to understand what you're saying, or do you want to sound smart? And with me, I don't care if you think I'm smart, stupid, somewhere in between. I would much prefer that people actually understand, that people actually pick up what I'm throwing down. And, it's just frustrating here. We don't need to talk like this. It's just the bottom line is yields are up. The Cent thinks because of the lack of liquidity, meaning that there's just a lack of buyers. And he's probably just talking about the off-the-run treasuries. And so he just wants to go in there and be the buyer because there's not enough buyers. And therefore, he wants to be a buyer so the sellers can sell at a decent price. That's, just put it in terms that everyone can understand here. The stepped-up operation can help crowd in potential buyers. Tempted by the prior run-up in yields, and force the near-term short covering while discouraging investors from going max short in the future of being ambushed again. Yeah. Okay, so let me translate that one for you. Basically, you got a bunch of short sellers in there, and that's going to theoretically, it doesn't, but theoretically it's going to drive up yields. And you could argue that yields are higher than they otherwise would have been because of all the shorts, because what they're doing is they're borrowing these treasuries and they're selling them. So this creates artificial selling pressure, or artificial higher yields, artificially lower prices. That's the argument. Again, it doesn't really work that way, maybe in the short run, but definitely not in the mid to long term. But that's basically what she's arguing here. They say, but the operation changes almost nothing in terms of the fundamentals, in particular, the unchanged need to finance the tidal wave of hyperscaler debt. This isn't, are you kidding me? I didn't read this. This is, man, sometimes doing these videos, it gets so frustrating because you just have to deal with this nonsense. I actually feel sorry for you guys, for the retail investor out there, because, you don't have enough. I'm retired. So this is what I do for fun. So I'm neck deep in this stuff all day long. But for you guys out there, I mean, you got a job, you got to deal with your wife or your husband, you got your kids, you got to pick them up from school, you got to take them to soccer practice, you want to watch Monday Night Football. I mean, look, you don't have time for this nonsense. So when you're spoon-fed this garbage, like it sounds right, So you just assume that it's true because it's coming from a quote unquote expert. And that's what really frustrates me. So let me explain what they're talking about here. And then I'll explain to you why it's total nonsense. So you've got a wave of hyperscaler debt. So what happens is NVIDIA is issuing all of these bonds. So the idea is that if you can get an 8% interest rate, I don't know what it is, I'm just using it as a hypothetical, an 8% interest rate on an NVIDIA bond, well, those are dollars that would have gone to a treasury, but now that capital allocator is like, oh, no, treasuries. Why would I buy a 10-year treasury at 4.6 when I could buy an NVIDIA bond at 8? So then what happens is all that capital that would have gone into bonds, treasuries, to keep interest rates lower, all now goes into debt of hyperscalers. So it's like you're robbing Peter to pay Paul. It's like a zero-sum game. That's what this idea is. So why is that false? Here's why. Because banks, especially in the Eurodollar system, are the marginal buyer and seller. And they have an infinite balance sheet. They're really not hampered by Basel III or regulations. I mean, is it an impediment? Sure. Can they get around it? Absolutely. If the risk reward makes sense, the banksters out there are going to be 10 steps ahead of any regulator, I can assure you. So what ends up happening is, let's just say that the hyperscaler debt is crowding out some of the government debt in terms of, or just taking that capital that otherwise would have gone to the sovereign bond market, the treasury market. And then what's going to happen? Interest rates are going to go up, but they're only going to go up temporarily. Why? Because when they go up to a certain point that's above growth and inflation expectations, the banks are going to come in and buy it hand over fist. Why? Because the risk reward is juicy. Because they don't care about inflation, because they're only pocketing the spread between the asset side of their balance sheet and the liability side. And if the liability side doesn't go up in terms of what they have to pay, then the spread just goes higher and higher and higher and higher. And they're going to come in, and at some point they're going to be like, okay, I've got two options here. I can either buy treasuries because I have to have dollar denominated assets because my liabilities are dollars. So I've got to have dollar, and even in the Eurodollar system, the vast majority of liabilities, commercial bank deposit liabilities, are in dollars. They're not in euros or yen or anything, even outside the United States, the majority. So they have two options. Either they can lend to the government, i.e. treasuries, for a dollar asset, or they can create a dollar loan. Okay, again, it's just a risk reward. Once those interest rates go to a certain level, the risk reward for buying that treasury is going to far outweigh the risk reward for creating that same nominal loan and issuing it to XYZ corporation, because you might not get paid back. And with the United States government, you don't know what the dollar's going to be worth, but you're at least going to get paid back. You see? So that's why it's really weird. And that's why I always say supply creates its own demand. Because when you have this additional supply, even if momentarily it outstrips demand, it creates this opportunity for the banks. And that's why when you look at a chart of the 10-year treasury versus nominal GDP, that's why you can go back as far as you want in U.S. history, and you always see that relationship. Always, no matter what the dollar is doing, no matter what the Fed's doing, no matter what deficits are doing, no matter what the debt is doing, it just doesn't matter over the mid to long term. And that's why, mechanically. Okay, let's keep going. All right, they're talking about Bissent being political. He wants to get down rates, probably for the midterms. Okay, I get it. Okay, now let's go over, and here's Peter. Peter's a great guy, by the way, Peter Bookvar. I disagree with Peter on a lot of things, but we definitely see eye to eye when it comes to the role of government, and that should be almost zero. Peter, just like me, is a hardcore libertarian. He says this is not a debt pay down. Yeah, he's right. It's just a rearrangement of maturities, schedules of treasuries. Absolutely correct. Absolutely correct. Again, so what they're doing is they're buying that 10-year treasury, and where do they get the money for the 10-year treasury? Is they just issue, let's say they're buying $1 billion worth of 10-year treasuries. They're just going to issue $1 billion worth of 3-month bills in order to fund that purchase. So you're just shuffling the chairs on the Titanic, if you will. All right, let's go over and make sure the screen share is working. Yeah, it is. All right, let's go over to Zero Hedge and let's get their take. Here comes QE Light. Yeah, I disagree with that. And the reason I disagree is because we're not using the Fed's balance sheet. We might be using the Fed to buy. We might be using the trading desk at the New York Fed, but we're not using their balance sheet. Okay, so Fed watchers, the Fed's Treasury. This is not the Fed's Treasury buyback. This is the Treasury buyback. Okay, maybe they're either not understanding the mechanics here, or this is kind of just a misprint, but let's keep going. With this website consistently arguing that contrary to what washed out in Bridgewater traders, blah, blah, blah. What is this? Okay, Treasury buybacks were just that when it comes to what matters, such as market reaction. Okay. Yeah, again, I hate to agree with Besant or Warsh or any of these clowns, but if Besant is calling it not QE, I begrudgingly, I would have to agree with him. Let's keep going here. Okay, so Besant finally resolved the debate when 30-year, 20-year highs and threatening to blow out higher as U.S. Treasury shock markets sparked a meltdown in yields and surge in equity futures when it announced at 8:30 a.m. it will be increasing, doubling the size of the buyback program. Okay, basically the exact same thing that we saw on CNBC. This change will go into effect September 9th. So what the market's doing right now is it's just digesting it and kind of baking that into the cake, or baking that into the current price. They say, okay, according to the statement, this increase in buyback operation size reflects Treasury's desire to provide greater liquidity support in long-dated nominal security sectors where there is consistent, strong sponsorship from market. Oh, that was a quote, this word salad, as evidenced by the significant high or volume of high quality offered, blah, 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 blah. Okay. So in my view, why is Besant doing this? I mean, midterms, he's trying to do whatever he can. I mean, he probably gets a call from Trump. And Trump is like, damn it, what are you doing? I told you, I want interest rates lower. And this stupid moron at the Federal Reserve, this Warsh guy, I hired him. And his stupid ass isn't even lowering interest rates. So I need you to do something to bring down the 10-year to get mortgage rates down. So it looks like I'm doing something. I can at least have some sort of tailwind for the Republicans going into the midterms. So he backs Besant into a corner. He's like, do something. He's like, dude, there's not much I can do. It's really market driven at long end of the curve. No, that's not good enough. Just do something, anything. There's got to be something. He's like, okay, I'll buy some more at the long end of the curve. Yeah, do it. Chop. And to me, that's kind of what's going on here. It says Besant panicked, and the justification that there is no liquidity is a straw man. Well, that I agree with. With the Treasury now freaking out that demand for AI paper is crowding out demand for Treasuries. That's nonsense. We already talked about that. As we have been warning for the past several weeks, and as we predicted a week ago. Okay, so that's what they're predicting is, and this is, a big problem in investing, is when you think something's going to happen for a specific reason, and it happens for a completely different reason, but then you think you're right. And then you think the reason that you started with actually caused the result that you predicted. And therefore you double and triple down on this causal effect that actually was just a correlation. It wasn't a cause. So then the next time when you, let's just say, have something, corporate debt, you're like, oh my gosh, here it is again. It's crowding out the Treasury market. Let's go ahead and short Treasuries. And then what happens, growth and inflation expectations go down, then you're totally offsides. Yields go down, prices spike, and you get blown out of your position. That's one of the main reasons why it's so important to understand the mechanics and understand the plumbing and understand how the monetary system actually functions. A lot of people, oh, George, what you talk about with the stupid plumbing? There's nothing actionable. Well, maybe not directly, but indirectly, it's huge. It's definitely an edge. Okay, let's keep going here. So now they're talking about how yields tanked, which they did, but we'll see what happens tomorrow. We'll see what happens the next day. Because my base case is assuming, this is a big assumption, that growth and inflation expectations stay the same. So let's go over to oil prices because obviously that's a biggie. So assuming that oil stays right around 85 and assuming those crack spreads stay at really, really high, like epic levels, then I would expect the 10-year Treasury especially to trade right back up to where it started today. So it would not surprise me that by Friday, maybe even, maybe going into next week, we're right now at 4.64. We started before the announcement here at, call it 4.7. And then what happens is, Trump kind of texts all of his buddies. And of course, they front run everything here. And then this is when you get the announcement. But, to be fair, we had rates going down at the end of the day. So it'll be really, really interesting to see how this plays out over the next couple of days. But again, my base case is if the crack spread stay high, if the cost of gas stays this high, if the cost of diesel stays this high, if oil stays here, and if we don't have any resolution in the Middle East, I say Tuesday, Wednesday, we're right back up at 4.7. And again, why? Because unfortunately, the Treasury just doesn't matter. It's all about growth and inflation expectations. Let me give you an example. Let's go over to, this is what I had written down, and it's a good time to bring it up. I'm going to say QE versus 10-year yield. And hopefully this chart that I always use pops up. Yeah, it's right here. Awesome. And it's nice and large so everyone can see it. So this, the blue line, is the 10-year Treasury yield. Green is when the Fed did QE. So they're increasing the size of their balance sheet. They're buying treasuries. And each green shaded area is when the Fed is out there buying treasuries or creating an artificial buyer that otherwise wouldn't be there, just like the Treasury. Same exact thing, just like the Treasury. So do yields go up during this time? No, the exact opposite. Every single time, yields finished higher than when they started doing QE to begin with. How is this possible? If you have this big artificial buyer like the Federal Reserve coming in and buying, how their yields, and by the way, why are they buying? They're buying to keep yields low. But yields just do the opposite of that. How is this possible? Because it's about growth and inflation expectations. It's not about what Scott Bessent is doing. Or at the time, who was the Treasury Secretary? It wasn't Yellen yet, I don't think. It was, the guy from Goldman Sachs or whatever. But this is what I'm referring to, right? And what's happening here is they do QE, and the market's like, wow, growth and inflation. We're going to go ahead and sell the treasuries. And then what's happening is the Fed is buying, but the selling is outstripping the buying. Yields go up. Yields go up QE2, yields go up QE3. Boom, 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 boom. And this is happening not just out of luck, not just because of random sequence of events, but it's happening for mechanical reasons. And that's why you can be so sure that we don't know where interest rates are going. I don't know. Maybe they'll go up, maybe they'll go down. But I can assure you the reason they'll go up or down over the next 3 months is not because Bessent is trying to do yield curve control, because Trump is yelling at him over the phone. It's because of all these other things that we talked about. It's because of what's happening in the Middle East. It's because of what the market expects for the future for nominal GDP. All right, let's go back to zero hedge. Actually, let me make sure the screen share, we got that. Yeah, we do. Okay. And by the way, this is a very important point. So what happens? Do interest rates all just go down? No, the curve flattens out. So you've got you've got the long end going down, and you've got the front end pretty much staying the same, as we'll use the 2 years of proxy for that. So a flat yield curve is not what you'd expect if we're going into the 1970s. And I know there that the argument is going to be, well, they've got their thumb on the scale, but we already showed why that's nonsense, in my opinion. Okay, so now that what they're talking about is gold and S&P 500. So let's go over where everything closed the day. So we go to the CNBC homepage. Let's look at the US. And yeah, I mean, we're up a little bit. I mean, nothing major. NASDAQ is only up 41, S&P 16, Dow 119. No different than really any other day. So, I mean, this would lead me to believe that the market is already like, oh, wow, we got super excited, knee-jerk reaction. But once we thought about it, we're like, rates probably aren't going down. Rates are probably going to go right back to where they otherwise would have been. But to be fair, Treasury yields did respond. We've got now the 10-year kind of closed the day, or close to close. I'm not sure when the market closes for the Treasuries, but we're down about 7 basis points. Gold, big up day. Big up day. I'm a big believer in gold. I fortunately just bought GDX, what was that, a few days ago. So I had a huge gain there today. But I wouldn't be surprised if this comes back to us before going back up. Then I think Bitcoin had a massive day. Yeah, up 6%. I pretty much would fade all of this over the short run. And then market fundamentals will really drive it higher or lower. But I would just fade this knee-jerk reaction. This is obviously the most important. That's oil at 85, along with those crack spreads. And here's a perfect thing to really focus on. What's happening here, guys? Boom, down, right back up, down, right back up, down, right back up, down, right back up. What is this? This is the yen. This is where the central planners come in and intervene and create all this artificial demand for yen. It's like they're trying to create artificial demand for treasuries. And does it work? Maybe for a couple days. Maybe a couple weeks if you're lucky. And it just goes right back to where it would have been. So my base case is next week, yen's going to be right back at 160. Yeah, it dropped today because the dollar goes down because the interest rate's down. Interest rate differentials, blah, 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 blah. But I would fade everything today. All right, guys, enjoy the rest of your afternoon. As always, make sure you're standing up for freedom, liberty, free market capitalism. And we'll
sides. And as I said, we have some degree of resilience here. We had a better weather, thanks to this better weather. We think that in this year we may harvest even 2 times more than what we had in the last year. So the main food of the people, which is wheat, actually, I think it might be close to self-sufficiency, and for the short time, I don't see any big problem right now. But after 2-3 months, I don't know what may happen.
Right, and we also need to see the specifics of exactly what the White House and what the Treasury will do here. To your point, though, we do know that Iran has lived under sanctions for decades now, and this is an economy that has shown a high degree of resilience and adaptability to those external factors. On that point, though, how do you expect the regime to respond? I know you're inside Tehran right now. There's probably not too much you can say, but how will the leadership react to what the White House has said?
Well, I think the attack on Iran had some political benefit for the Iranian state. If they had this in mind, that this may trigger some political instability, what I see is on the opposite. I see that it now shows more confident in dealing with the opposition, in dealing with the other side of the conflict. So I think in the future, what we see is that the hardliners in the state are actually taking advantage of the situation, and that makes things harder for reaching an agreement with US.
Of course, the foreign minister also said that escalating sanctions against Iran is going to be a barrier to a negotiated exit here, an off-ramp to this conflict. Do you think the economic pressure makes a deal with the United States more or less likely?
I think it's less likely in the short term. And I said, because of the development and this pace of development is very fast. We can't see for now any reason in 2 months that changes. But I think after that, we don't know. As I said, we are under very severe pressure.
Right. And is there a point at which the economic pressure at all is going to change Iran's position on key issues for the Gulf, for the White House, like the Strait of Hormuz, for example?
As I said, in the short term, no. The answer is no. But for the longer term, say in more than 3 months, that may change. And that's long enough to has, the things in the region has great impact of the world economy, and that also puts much pressure on the United States as well.
And
but
who bears
on the
the cost
Trump administration?
Yeah. Right, and who bears the cost of all of this as well? As an economist advising the central bank in the past, is it the state or is it ordinary Iranians who are caught in the crosshairs between this regime and this White House?
Well, the people in Iran are under, enormous pressure, particularly those with the low income, and the young generation now have the inflation. They are struggling to find jobs, and some of them even, they lost their job because of war. So I think that the government, knowing that this issue and trying to respond, but the problem is that with limited access to finance, what the government does sometimes, could make the thing worse because of the, it may add to the inflationary pressure.
And just finally, of course, overnight, the president was also talking about some specific channels that we know are highly relevant here: oil smuggling, currency swap lines, exchange houses, and beyond. As a former central banker, can those channels actually be closed? And if you were advising policymakers in Tehran this morning, what is the most urgent economic risk that they need to address?
I think, if we think of all risks, I think on the top of that is risk from inside rather than the risk from outside. So we have now the problem of, imbalances in energy sector. And because of this, the government should actually, raise the price of oil and fuel. And this has a great impact, on the whole economy and the people. So I think that's a big challenge for the government right now. If they want to close all the channels that you said, they have to increase the price of oil, the price of fuel. But they are actually very, they worry about it, the consequences. I mean, the political consequences of that.
Modad, I wish we had more time, but we'll have to leave it there. I really appreciate the conversation this morning. Thank you for your candid replies to my questions. That's Modad Sapavan there from Darik Investment Group, live with us inside Tehran this morning. Modad, you take care.
Thank you for having me.
We can speak again soon.
May I also, for those of your audience are interested in, knowing more about the macroeconomic outlook of the Iranian economy, to introduce this report, I don't know if you, you can see the, the email address, so they can actually have this report, which has the 4-quarter forecast for the main economic indicators.
Okay. Thank you again, sir. We'll speak again soon. Appreciate it. Moving on now, and Iraq is asking Iran for special treatment as it struggles with the economic fallout from the closure of the Strait of Hormuz. Baghdad's parliament speaker has urged Tehran to allow Iraqi oil exports to pass through the waterway, citing the close relationship between the two countries. Iraq has been one of the hardest hit economies since the outbreak of the US-Iran war, with oil exports of some 3.4 million barrels a day disrupted. Oil revenue also falling sharply, leaving Baghdad struggling to cover a monthly public sector wage bill of more than $6 billion. Well, our transport and travel reporter Monica Petrelli joining us live now from Singapore with more on that and everything else that's moving right now. Mon, good to see you. What can you tell us?
Yeah, well, this container ship coming from South Korea, which will be the first commercial vessel that will go from South Korea to Europe using the Arctic route, will face things like storms, sea ice as far as the eye can see, also freezing temperatures even in the summer. But that's really just for starters. It'll also have environmental as well as political risks, because taking this route requires working with the Russians, which were informed that many Western officials oppose. But there are also rewards to taking this route, which is called the Northern Sea Route, because many believe it could be an established sea route as early as 2030 because of global warming. Now, the first to note, it's shorter, of course. This operator, Panstar, says it could shave 30 days off a round-trip route from South Korea to Europe. And it also allows this company to avoid the Red Sea. But having an alternative to the Red Sea is really just for starters, because we saw also in an op-ed today from Cho Jung Hee, who is the president of the Korea Maritime Institute. He said that this could also be a strategic asset for South Korea in the future, noting that because of fraying relationships and uncertainty, he says South Korea basically needs to secure greater strategic autonomy in the future. He said that this route would be the first step in doing so. It's back to you.
Mon, appreciate the latest there. Thanks again for joining us. That's Monica Petrelli there. Stay with us. You're live on CNBC. We're off for a short break. We are back in 2 minutes.
Abu Dhabi has now been branded as the capital of capital. There really are few places in the world where the concentration of sovereign wealth funds and smart investors.
It's a great place to work and live. I mean, living in Abu Dhabi, it's a very safe, secure city.
I love it so much, I don't think I'll ever leave.
Any company that's looking to grow and expand, really look at the Hub 71 Accelerator Program, the ADGM ecosystem. We couldn't have found a better home.
Everything is there for you to succeed here.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC Plus.
My ambition is just to be the best that we can possibly be. If you're watching CNBC, it's because you want to get an edge, you want to get ahead. It's our job to deliver that. People always ask me what I want to do next, and I always think they're a little crazy. This is what I want to do. It's the best job you could possibly have.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned, sponsors disappeared, fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
The Score, streaming now on CNBC.com and YouTube.
Welcome back. The Saudi AI company Humane is giving us a first look at its next AI PC built with Qualcomm. CEO Tarek Amin posting an unboxing video on X overnight. The device, which, yes, kind of looks a lot like a MacBook, is powered by Qualcomm's Snapdragon processor and runs Humane's own operating system called Humane One. The company describes it as an operating system for an agentic AI world. The idea is that instead of opening apps and clicking your way through tasks, you can tell the laptop what you want done and let the AI handle more of the work. The details are still thin though. Who makes the hardware? How much will it cost? When can you buy one? Most importantly, how well does it actually work? Well, we don't know yet, but it is an interesting move from the kingdom and a rare attempt by a gold company to break into consumer technology. More details expected at the LEAP Summit later this month. Meanwhile, India and Dubai stepping up their cooperation in the AI space. India's National Association of Software and Service Companies, or NASSCOM, signing an agreement with Dubai's Chamber of Commerce to accelerate the adoption of agentic AI within the private sector and support Indian tech firms entering the Emirates. Stay with us here on the program. We are back once again in 2 minutes.
One hour of added insight every morning doesn't just add up, it compounds. 1 extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC.
One of the world's largest private climate investment vehicles, Altera, aims to mobilize $250 billion by 2030.
What we're trying to show is that we can align those objectives and we can make money doing it.
Clean energy, emerging markets, even the AI boom. The opportunities are vast, but how do you pick the right investments?
We have people who specialize in these investments, and that's what makes Altera unique. That's our secret sauce.
Find out more on the next Managing Middle East.
Listen to CNBC on the move with the CNBC app.
A check on how Europe is set to open the trading day.
Real-time market updates.
A lot of strong numbers this morning.
Listen wherever in the world you are. Download the CNBC app now.
A market shaping industries. We are watching the 6 little dragons, the first to be listing in the Hong Kong market, supply chains, and global momentum.
Do you feel pressure to create the next Labubu soon?
This really is a business-first pivot, despite the geopolitical strains. The China Connection, weekdays.
The trade heads are gathering against the backdrop of the global energy crisis.
CNBC.com and the app anytime. Let's get to your headlines. Only on CNBC, connecting you with China.
Welcome back to one of our top stories now, and the 30-year Treasury yield pulling back from 19-year highs after the Treasury announced it would double its buying of longer-dated bonds. That's going to boost the buyback size for 10 to 30-year maturities to at least $4 billion per operation. It will start on September 9th and run through to November 4th. The move comes amid what you could call a bond rout, with investors worried about a worsening fiscal picture and as the Fed's latest minutes showed growing concern about inflation. New numbers show the US national debt hit a record $40 trillion now, having surged from around $6 trillion 20 years ago, driven by massive public spending during the global financial crisis and, more recently, the COVID pandemic. The 10-year yield currently at 4.64%. President Trump, though, saying he is not worried about the recent bond sell-off and calling once again for lower rates.
No, I don't think so, because like I said, our country is doing so well despite interest rates. We have interest rates that are artificial. They're actually artificially high. They raise them for no reason. And you can't go out to the market when you have a Fed that's raising interest. You can't say, oh, I want to pay 3 points less than what the Fed says you're supposed to be paying. So, no, I don't think so at all. I think we have a very powerful country, and we're powering through these ridiculous interest rates. They're ridiculous. Look, when our country is strong, interest rates should go down.
President Trump there. Meanwhile, across Asia, the Treasury's moves helping to steady global bond yields. Our East Asia reporter Lisa Kim joining us live now for more insights on that, and in particular, how JGBs in Japan are reacting. Hey Lisa, good morning.
Hey Dan, so Japanese government bond yields are lower today after the U.S. Treasury said that they will buy more treasuries on the longer end. 20-year JGB auction results came out in the past hour, and the auction drew stronger than average demand, so auction results were solid than expected. A JGB trader who I talked to after the auction said that he expects JGB yields to stay within range, at least in the very near future, because big auctions for this month are behind us when it comes to Japanese government bonds. But here's the thing, underlying reasons that pushed 10-year JGB yields to the brink of hitting 3%, which is a level last seen in the mid-1990s, remain unchanged. For one, Japan is still facing growing national debt. PM Takaichi is adamant on spending money to foster economic growth, and in fact, last month, PM Takaichi's cabinet scrapped the limit on Japanese ministries' investments allocated for growth and crisis management. Also, the Japanese government greenlit Takaichi's plan to reduce the consumption tax on food from 8% to 1%, which is expected to cost roughly 5 trillion yen a year, which is roughly the money spent on education in Japan. Inflation concerns from high oil prices continues to linger. Japan imports most of its crude oil, so that's why Japanese yen has been weak and inflation has been surging. Higher JGB yields have made Japanese government bonds more attractive to Japanese investors, and that's something that folks over in the States are keeping close tabs on. And the overarching opinion from the analysts that I spoke to, Dan, is that Japanese government bonds are more attractive now, and investors will gradually shift back home. Not immediately, but gradually. Back to you.
Okay, watching that space. Lisa, thanks so much for the update. Meanwhile, markets now pricing in a 30% chance of a rate hike at the next Fed meeting in September. The latest Fed minutes showing that more policymakers have flagged the need for higher rates in the face of what they now believe is sustained inflation. CNBC's Steve Leisman has more.
Inflation is on a very short leash for this Federal Reserve, according to the minutes of the July meeting. While most supported maintaining the current range, many thought rate hikes would likely be necessary if inflation did not decline. At the end of the meeting, 9 voters chose to wait for more information. 3 dissented in favor of a quarter-point rate hike. The minutes show an intense debate among the committee over inflation. Inflation hawks on the committee argued that rates were not high enough to bring inflation down to the 2% target, that underlying inflation was elevated even when you take out the impact of tariffs and energy prices. Higher inflation expectations also could affect wage and price decisions. The Doves responded that tariff and energy prices would ease over the next several months, and the two sides debated whether businesses could pass along higher prices to consumers. The Doves got a major boost with recent calmer inflation numbers and muted job growth data. Minutes also show concern at the Fed over the massive build-out of the AI infrastructure, including the possibility that AI developments could end up disappointing financial markets, leading to significant repricing of stocks, generating tighter financial conditions and strains on financial institutions. Finally, the minutes show Fed Chairman Kevin Warsh directly supporting moving from 8 to 6 meetings a year, saying it would allow the committee to gather more information between meetings to make better monetary policy. Steve Leisman, CNBC Business News.
And Middle East markets closed mixed on Wednesday. The Saudi benchmark eking out just modest gains. Abu Dhabi down nearly 1% after it reported those missile threats from Iran. Qatar, which is the market to watch, fell 0.8% yesterday and is now at a 1-year low. Let's get more on the regional and global equity trade. Akbar Khan is the acting CEO of Al Rayyan Investment. He joins me live from Doha this morning. Welcome to the program, sir. Let's begin with the big development in the last couple of hours. You've heard this morning President Trump threatening secondary consequences on any country doing business with Iran. How do regional equities price that today?
Good morning, Dan. Good to be here. Look, there have been headlines like this one and many others, both positive and negative, over the last 4.5 months that this conflict has been waged. I think while the news on the face of it clearly is a negative, I think what's important to look at both from an equity perspective as well as the credit markets is what they are looking at, and that the market is clearly pricing in the medium-term outlook of what a normal looks like, and I think that's what a medium-term investor would be focusing on, rather than just the day-to-day headlines, which clearly do add to volatility.
So expand on that for me, because when you look at the equity trade, and in particular right now, when you look at what's happening with oil, we're almost 6 months into this war. You really do get the sense markets may not necessarily be pricing geopolitical risk anymore. Maybe they've stopped reacting to the headlines altogether, and traders are actually looking through what's happening in the region right now. Agree or disagree?
I would largely agree, Dan. I think if you were to do a thought exercise and say, let's say we were in 6 months ago, and somebody was to describe that the region would have had the kind of kinetic warfare that we've seen across the entire region, with the intensity that we saw over the period of time that we've seen, what the situation with Hormuz, I think the expectation would have been that the impact on public markets would have been far more severe than what we have seen. I think where we are today is reflective of the fact that this region throughout 2025 stood out because of the comprehensive growth plans that we've seen across many countries, the extreme wealth that means that this growth is self-funded, and not reliant on the discussion that was just happening about what the cost of US dollar money is, particularly with the steepening of the yield curve, and also the track record, frankly, of the leadership of the region in terms of in executing on their growth plans. So that was where we were in 25 and where we were leading into this crisis. And so I think markets are expecting and pricing in that normalization of going back to where we were is what is going to be the outcome in the medium term. And given that given that there aren't concerns from a credit perspective in terms of the sovereign balance sheets, nor corporates, and we've seen increased liquidity in terms of deposits across the GCC banking sector, they've continued to increase this year. So I think markets are pricing in that this region will resume the trend rate of growth that we've been used to in the previous many years.
Okay, so with that as the context, how and where are you deploying capital right now? You have this momentum and premium valuations in Saudi Arabia. You have deep value in Qatar and Oman. What side of the trade are you on at the moment? What do you like? What do you not like?
So yes, you've characterized it well. You do have for the investor who looks at the region from not in terms of the short-term headlines, but in terms of deploying capital over a reasonable length of time. You have a number of blue chips across the region trading at extremely attractive valuations, sometimes single-digit trailing PE multiples. For companies with outstanding franchises, local dominance, sometimes even international dominance, depending on the sector that they're in, and with reasonable dividend yields as well, mid-single-digit dividend yields. So these are very, very attractive entry opportunities for a number of high-quality blue chips. You also have many companies, and we've obviously going through second quarter reporting season, we have many companies which, despite what's going on, are still delivering top-line growth, are still delivering net profit growth. In many cases, there is a margin squeeze because of the increased costs of operations, but there are enough companies out there for us to be able to take advantage of to continue to be allocating constructively to our portfolios, albeit with some rotations from where we perhaps would have been 6 or 9 months ago.
Do you have a market preference at the moment, or a highest conviction trade in this environment?
So from our perspective, we're very bottom up. We're not market focused, we're stock focused. We're looking to generate alpha from a bottom up perspective, and we invest both across both GCC public equities and across fixed income. Everything that we do is Sharia compliant, so we invest in Sukuk. So it's not about the market, it's about the company. It's assessing, as any institutional investor would, it's assessing the company's long-term fundamentals, and then obviously understanding where current valuations are and whether that's attractive or not. So we are company focused rather than market focused.
Okay, and just on the issue of fixed income as well, I know you're calling out Sukuks here, something that we don't often get a chance to talk about on this program, but still, a growing area of investor interest in and outside of the region. Walk me through the Western approach to Sukuk right now, and why do you think Western institutional money is still a little underweight this asset class, given some of the returns that we've seen in this space over the last couple of years?
Thank you for mentioning Sukuk. Look, it's something that we spend a lot of time and effort on. Obviously, it's a focus for us. I've been involved in markets for many years, and let's say 15 years ago, Sukuk was, or even 10 years ago, Sukuk was rightly seen as a niche, small little market, which was really something that very few investors outside of the core Sukuk investors focused on. It's now the outstanding Sukuk globally are now in US dollars are in excess of $1 trillion US dollars. So it has certainly come of age to a large degree. What you're seeing is far greater participation, and over the last, I would say, 5 years, from the largest global fixed income investors, asset managers, pension funds, who are investing actively and regularly in Sukuk, being very active when there are new issuances. And also you've seen Sukuk enter some of the largest global bond indices, emerging market bond indices. So there has been a significant difference in the amount of Sukuk that have been issued, the liquidity of Sukuk, and also the acceptability of Sukuk from outside of traditional Sukuk issuance countries. So I think that combined with the fact that more than 80% of Sukuk out there are investment grade. At the moment, more than 90% of all Sukuk have a stable outlook, despite the fact that Sukuk are predominantly issued from within the GCC. So I think that is very reassuring for investors who are essentially buying into the very strong sovereign and corporate balance sheets that we have across the region, and are able to benefit from almost negligible or almost zero default rates that you've seen. I mean, Sukuk, globally, Sukuk, there have been zero defaults over the last 4 years.
It's certainly an area to watch. Akbar, we'll leave it there. Appreciate the conversation this morning. Let's see how regional risk assets unfold over the course of the session today as they digest all of these big headlines from overnight. That's Akbar Khan there from Al Ryan Investment, live with us this morning out of Doha. Stay with us on the program. We're off for another quick break.
I grew up a news junkie. It's really the only thing I ever wanted to do. I like holding people to account. You can't just show up and say, I like XYZ stock, because I'm going to ask you why. And then if you say you sold it, I'm going to say, well, why'd you sell? Get away from talking your book and tell me the real story. Ambition is a fuel and a fire. They call me the judge for a reason. I'm supposed to make people squirm, as long as I get the goods at the end of the day. We're talking about people's money. I feel the weight of that, the responsibility, and I love it.
The AI boom is usually told as a Silicon Valley story, but some of the biggest winners are thousands of miles away in South Korea. And their windfall is now spilling into an unexpected place, the housing market.
Before we saw this massive rally this year, people just like to invest in the housing market because there is no alternative for savings and investment.
From January to April 2026, home buyers used about 3.7 trillion won, or roughly $2.4 billion from stocks and bond sales to fund purchases.
The government wanted to boost the stock market so that people could move away from homes into the stock market, but people are coming back to the property market with the money that they earned in the stock market, and it's also sort of this vicious cycle.
The danger is not that one stock market sell-off would immediately crash home prices. It's that the same wealth channel pushing stock gains into housing depends on confidence.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
Good Thursday morning here in the Middle East. This is Access Middle East. Here are some of the other top stories on our radar this morning. First up, the Trump administration has told Congress it will send more than $206 million for a Gaza peacekeeping force. According to a note seen by Reuters, the money has been earmarked towards infrastructure, equipment, and vehicles for the International Stabilization Force. It's the first swathe of funding for America's efforts to rebuild the war-torn enclave, and comes despite Israeli pushback on that peace plan. President Trump saying he is now hoping to meet North Korean leader Kim Jong-un as soon as this fall. This comes after the US halved its military exercises with South Korea that will now end tomorrow instead of next week. Trump saying he didn't want to disrespect his good relationship with Kim.
I was not happy when South Korea said, no, they're not interested in helping us with the Hormuz Strait, and yet they get 60% of their oil from the Hormuz Strait. I said, would you like to help us? He said, no, thank you. I said, that's nice, please, thank you. He made us a lot of money. I didn't like that. So I felt that to do we were doing a massive war exercise. I thought that was very insulting to somebody that, frankly, has been, during my term at least, very well behaved.
Oh, and Kim's his friend. Meanwhile, Ukraine has officially appointed a new defense minister after a surprise shake-up over 5 years into its war with Russia. His predecessor now calling for elections, saying that the country faces a crisis of governance and that its democratic process, quote, cannot be held hostage by Russia. Law actually prohibits an election during war in Ukraine, and with millions of Ukrainians displaced or living overseas as refugees as a result of the war, any vote would be a challenge. Moving on now, and President Trump met with regulators, bourse operators, and leaders of the crypto industry at the White House on Wednesday to discuss the Digital Asset Market Clarity Act. It's a bill that would establish clear rules for the cryptocurrency industry. He urged lawmakers to pass the act to ensure the U.S. remains a global leader.
So now we need Congress to take the next step by passing the Clarity Act, a fair version of the Clarity Act, and this landmark structure legislation. It's a very, very powerful structured legislation which will keep us ahead of China, keep us ahead of everyone else. Will open the door to the next wave of innovations and innovators.
The CEO of Robinhood was on Squawk US overnight and talked about the role of regulation in the future of tokenization.
Tokenization, we're at the beginning of a super cycle, and it's going to take over the entire financial system. Now, a month ago, we launched Robinhood Chain outside the US, and this is our crypto blockchain. And one of the interesting things about it is it includes stock tokens as a primitive, which give tokenized exposure to US stocks. Now, we started with 90 of them. Now we're up to 190. And these trade 24/7. And you can move them around the blockchain like you can Bitcoin or any other crypto asset. And what they really do is give exposure to US stocks to people in over 120 countries. And I think this provides a roadmap for what the financial system can look like. Now, I think tokenization in the US has come up, and I'd say it's broken up into two camps. There's sort of two sides to it. On one side, enthusiasts that just want to get their hands on this new technology, new capability, and they're asking us, when is it coming to the US? What's that going to look like? On the other side, there's people that say, well, we already have simple access to markets here. We have products like Robinhood that provide fractional shares, 24/5 trading, maybe it's not 24/7, so what's even the point? And so through my post, I kind of outlined the three key improvements on an infrastructure level that can actually impact people's lives in a positive way and make it easier in America for people to become investors and owners of our great economy.
So Vlad, I get the tech part of it, or the value proposition of the tech. I think there's a philosophical question about public markets versus private markets and effectively the convergence of them, and this idea of whether private markets should be available at scale in the same way that we have public markets, just without all the same regulations and necessarily disclosures. Where do you land there?
Well, I think that we certainly have to make sure we balance innovation with investor protection. I don't think that they're in conflict. In fact, what's made American capital markets the greatest in the world has been the balance of the two: strong regulations, access, and investor protection. I do think there's a real problem to be solved here, because if you look at all of these private companies, the AI companies like SpaceX up until recently, the lion's share of that value creation, the economic value, has been created without ordinary individual investors being able to participate. And I think that's a big problem. I think that broad ownership, particularly of these innovative companies, is essential to maintaining a free, stable, and prosperous society. So we've been pushing forward through that, be it through our tokenization initiatives outside the U.S. or Robinhood Ventures within the U.S., which is attacking it from a slightly different angle, but still getting to the same place.
I know this is a hard question for you to answer or not, but if you succeed on the tokenization argument that you've been making, it obviously should be a benefit to Robinhood. We could talk about other companies that would benefit. Who would lose? And maybe that explains who would be on the other side of this debate.
I think it's unclear exactly who will lose, but in any disruptive innovation, I think that if the incumbents can't keep up with modern technology, if they can't keep up pace and offer products that both institutional and retail investors can benefit from, I think they could lose share. But I think the great thing about tokenization is it does open up net new opportunity, particularly outside the U.S. Because, even though inside the U.S. there are vibrant equity markets and a lot of people have access, outside the U.S. a lot of people still don't have functional bank accounts. And so, getting access to U.S. stocks is generally a net new opportunity for billions of people around the world.
And before we go, Moderna stock nearly tripled overnight after a major breakthrough in a cancer vaccine that it's developing with Merck. In its first ever late-stage trial, the experimental mRNA vaccine showed positive results. The Moderna CEO explained how it worked.
I would even say it's individualized. Because personalized in medicine is if you and I have the same mutation, we might get the same drug. Right. It's individualized, which is you will get a different drug. If you're diagnosed with melanoma today, and I'm diagnosed by the same doc, you and I will get a different chemical. But we're going to take a biopsy. We're going to sequence all the letters of the DNA of your cancer cell. We're going to do the same for your healthy cell of your body, most blood work. We're going to compare electronically where the mutations are. And we designed and we aim to improve an algorithm to pick 34 mutations that we believe are the most important in your tumor. We put that into one molecule of mRNA, we stitch them together, and we inject that to you in your arm. And that's what Dean was just saying. That's to give your immune system, to give to the dogs, to give the same energy.
Extraordinary. Thanks for watching. I'm Dan Murphy in Abu Dhabi. Europe Early Edition starts right now.
Abu Dhabi has now been branded as the capital of capital. There really are few places in the world where the concentration of sovereign wealth funds and smart investors.
It's a great place to work and live. I mean, living in Abu Dhabi, it's a very safe, secure city.
I love it so much, I don't think I'll ever leave.
Any company that's looking to grow and expand, really look at the Hub 71 Accelerator Program, the ADGM ecosystem. We couldn't have found a better home.
Everything is there for you to succeed here.
Halftime Report, weekdays streaming on CNBC+.
For me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. You want to learn more about it. And I think CNBC allows our viewers to fulfill their passions. There's no doubt that the people who watch us care. I am very much focused on trying to land interviews where there is something at stake and asking them fair but tough questions in which their answers are important. I could not imagine covering anything else.
Welcome to Europe Early Edition with me, Ritika Gupta. Let's get into your headlines. Global government bonds get some much-needed relief courtesy of the U.S. Treasury announcing plans to double buybacks at the longer end. President Trump bemoaning the Fed for high rates amid the rising debt burden.
We have interest rates that are artificial. They're actually artificially high. I think we have a very powerful country, and we're powering through these ridiculous interest rates. They're ridiculous.
President Trump threatens economic consequences against any country that helps or does business with Iran, adding the U.S. is preparing crushing economic warfare. And ECB Chief Christine Lagarde warns the U.S. retreat from the global order is hurting Europe's growth trajectory, urging policymakers not to repeat the mistakes of the dot-com boom in the AI era. And welcome to the show. Let's get into our top story. The U.S. Treasury has stepped in to try and stem the sell-off in treasuries, announcing it will at least double the size of its liquidity support buyback operations for bonds dated from 10 to 30 years. The announcement pushed the yield on long-dated debt sharply lower, with the 30-year Treasury yield down at around 5.18% this morning. That yield is closely tied to the rate Americans pay for things like mortgages and car payments. So it is perhaps unsurprising the Trump administration has moved to try and push rates down as its war on Iran helps push gasoline prices to their highest level ever for August. That gasoline price surge has helped hold inflation at nearly 1.5 times the Fed's target. President Trump hit out at the central bank on Wednesday, suggesting members of the Federal Open Market Committee hike rates because they like the politics of it. The Fed hasn't actually hiked rates in more than 3 years and cut them 3 times in 2025. This came as minutes from the FOMC's July meeting were released on Wednesday, with many officials saying a hike would be needed if inflation doesn't abate. But the U.S. leader insisted rates are too high where they are.
We have interest rates that are artificial. They're actually artificially high. They raise them for no reason. And you can't go out to the market when you have a Fed that's raising interest. You can't say, oh, I want to pay 3 points less than what the Fed says you're supposed to be paying. So, no, I don't think so at all. I think we have a very powerful country, and we're powering through these ridiculous interest rates. They're ridiculous.
This as America's national debt hit $40 trillion, more than doubling since Trump's first inauguration less than a decade ago. With more than a quarter of that $40 trillion coming under Trump's watch, exacerbated by his One Big Beautiful Bill Act, which the Financial Times says is set to push debt up by more than $4 trillion by 2034. The swelling debt figure now means the government spends a record $1.37 trillion a year just on servicing interest. That's more than the budget for the Pentagon and is more than this year's outlay on Medicare. Earlier this month, a Reuters Ipsos poll found that Americans now see Democrats as better stewards of the economy than Republicans for the first time in around a decade. Bond yields around the world are starting to pull back after the Treasury's intervention. Lisa Kim joins us now to look at how bonds in Japan are reacting to the news. Lisa, we are seeing bonds over in Japan moving higher this morning after the U.S. Treasury announced its plans to double the size of bond buybacks. I mean, we've seen that 10-year yield on JGBs. That's inched closer to that 3%, which we haven't seen since the mid-90s. And that seemed unthinkable just recently, given we had seen the central bank stepping in to keep those yields artificially low.
That's right, Ritika. So Japanese government bonds are rallying today after the U.S. Treasury announced those measures overnight. So there was a 20-year JGB auction that took place just a few hours ago. And before the U.S. Treasury announcement, analysts expected it to draw weak demand. But actually, in fact, demand turned out to be stronger than average thanks to the change in overall sentiment. A JGB trader I talked to after the auction says that he expects JGB yields to stay within range in the very near future because the big JGB auctions for this month are behind us and overall sentiment has improved. But here's the thing though, underlying reasons that push 10-year JGB yields, the benchmark JGB yields, to the brink of hitting 3%, a level last seen in the mid-1990s, remain unchanged. First, Japan's rising public debt is an issue. PM Takaichi is pouring money into the 7 strategic sectors deemed important to the Japanese economy. She wants to spend her way to growth. In June, Takaichi's cabinet scrapped the limit on Japanese ministries' budget requests for growth, essentially telling them that it's okay to request as much money as you see fit as long as the money is intended for economic expansion. The Japanese government also greenlit Takaichi's plan to reduce consumption tax on food from 8% to 1%, which is expected to cost the government equivalent to what it spends on education. Inflation concerns also linger from high oil prices. Remember, Japan imports most of its crude oil from the Middle East. Rising JGB yields, though, have made them more attractive to Japanese investors, a lot of whom have long invested in U.S. Treasuries. Shokyo Mori, chief fixed income strategist for Japan at Deutsche Bank, told me that going forward, the renewed rise in JGB yields erodes the case for holding U.S. Treasuries. It's back to you.
All right, thank you so much, Lisa, for the update. Now let's get more with Florian Lelpo, the head of macro at Lombard Odier Investment Managers. Florian, welcome to the show. Thank you for joining us. Let's first discuss the rally that we're seeing now in bonds globally after we saw the U.S. Treasury stepping in to provide some support for the bond market. What is this telling us? How significant is this now, this move from the U.S. Treasury and the ripple effects it's having globally as well?
Hi, thanks for having me. the key point is to understand that the factors that are actually causing the rise in bond yields are not entirely in the hands of Mr. Bessent. So this intervention is interesting. Is now taking the role of normally the Fed, normally the central bank is much stronger, much better at controlling the yield curve entirely. They're the feeling of emergency, which is really good if you want to stabilize rates for good. Now, the one point to understand is that the level of rates, I'm sorry for Mr. Trump, but they are not artificial. Actually, the end of forward guidance is causing market mechanism to price the cost of capital at the moment. And that price currently is just much higher.
So is it Treasury, it's almost acting now as for providing this kind of the Fed put for bonds. So do you think investors are going to be looking at this as a policy backstop that we're going to keep seeing from the Treasury? I mean, how is that going to impact moves going forward?
Of course, it's something that's going to contribute positively to stabilizing the level of rates. Now, the thing is that you can't put in the same sentence something like we run a powerful country and rates are artificially high. The thing is that the two are actually related. The fact that currently growth is strong and investment driven makes that rates need to reprice that level of growth, either directly as an investment opportunity or because they have the crowding out effect. AI companies are investing and are issuing a lot of bonds in different currencies, but predominantly in US dollar. And that creates that basically drains the saving pools which is available in the US. And that's causing a competition, the direct competition with the government, who needs also to fund its own debt. You see, so there's competition at the moment for capital between basically corporates and AI corporates and the government. And that's causing most of that increase. Basically, it's not inflation, it's partially the fiscal premium, but also it's just bond repricing growth. So when does it stop? Well, basically it stops when the price is judged reasonable compared to the enormous equity opportunity that is currently in front of us. And probably we're not too far away from that. Just remember, the long-run performance of equities in the US over the past 200 years was about 6 to 7%. You see, so basically, when you see long-term yield, 30-year yield around 5.5, well, basically, you can maybe think that it could be something as a cap.
So even though we're seeing some reversal of those moves higher in yield, so yields coming down somewhat today, we have seen those yields hitting multi-decade highs. And you mentioned earlier that there's factors that are not in the control of the likes of Scott Bessent, one of those, of course, being oil prices. And we're seeing those tensions continue to escalate in the Middle East. I think Brent is now at $92 a barrel. But then there are things that are in the control, like government spending and the debt pile. I mean, how do you weigh all of those factors?
Well, inflation is a thing. But the long end of the curve is essentially repricing sub-inflation because of now the lack of forward guidance. So some of the change in management at the head of the Fed is actually causing that reaction on yield. So maybe a little bit of a retreat on that topic would be appreciated by market and would help again cap that evolution. Now, are we about to see fiscal austerity? Maybe not. There are signs of potentially a better controlled evolution of the budget. Remember, the last payroll report showed a net number of firing on the local government side. So basically, there are efforts that are being made. Now, the paradox of AI-driven economic growth is that it essentially goes through productivity, and productivity is not taxed. So basically, you can have much better growth in the US, but this will only improve the fiscal position of the US government in a limited way. So I think the best cap to the level of rates is actually a very natural cap, and that cap is basically the competition between equities and bonds. At some point, well, bonds will have seen their rates increased enough to be competitive and attractive to investors. I think we are not too far away from that point, actually.
You mentioned AI there as a factor, but what about also when you look at European bonds in terms of defense spending that could come down the line? I mean, that's rising sharply over here in Europe. Do you think the scale of that investment is going to be important for where we see demand-driven inflation and where bonds in Europe head?
Yeah, true. Just scales of magnitude. Just remember that basically every 1% increase, surprise increase in debt to GDP ratio leads to an increase by long rates between 1 to 3 basis points. That's pretty much what happened in 2025 when Germany announced its plan to invest more in the infrastructure plan and the defense plan. So this is an important factor. Now, the thing to remember is that sensitivity at the moment is magnified, again, by the competition for capital. AI corporates, I'm sorry to repeat myself, are basically, of course, they are raising money in the US, but not only. Now they've been also knocking at the door of Switzerland and they're issuing bonds in Swiss franc. So basically it says how much they need cash and how they are tiptoeing into the market to prevent from causing a massive increase in interest rate. But still, they are currently a competitor to governments at a moment when governments are actually spending a lot of money and they need to raise cash. These create a permanently higher level of interest rates. Think that as a long-term investor, this is not bad at all. It just means that the fixed income opportunity is restored for the next 10 years. This is an opportunity.
And just very quickly, last one, where do you see the 10-year and the 30-year yield heading to?
Well, they could be hovering around the levels where they are at the moment. I think it's a fair competition to equities at the moment. They think of bond as crystallizing some of that forward growth that is currently created by the industrial revolution we're experiencing. And they've crystallized already, well, a large amount of that, especially in the US. So say 5 to 5.5 on your 30-year bond looks pretty much attractive as a long-run investment opportunity. The same for the 10-year and the same around globally for European rates.
All right, we'll have to leave it there. Thank you so much, Florian Lelpo, the head of macro at Lombard ODA Investment Managers. Coming up on the show, our next guest says UK equities have performed strongly, but still sees further upside. We'll have more next.
In this CNBC Explains, we explore why Asia is leading the global IPO market.
We have a really big year for IPOs with SpaceX, OpenAI, and Anthropic, but analysts are pointing out that there's much more volume here in Asia.
And we look at how South Korea's AI chip boom is spilling into the housing market.
In Korea is a reflection of what people consider as their safety net, as well as a symbol of success.
The show that explains the why behind the headlines, only on CNBC.
Kelly Evans with in-depth reporting and analysis. Strengthen your investment strategy on The Exchange. Streaming on CNBC Plus.
Ambition is in my DNA. My grandparents came over from China to give their children a better life. They opened up a laundry in Buffalo, New York. They raised 5 kids, and they sent all 5 children to college. They achieved their American dream, so I can have mine. It's a privilege to be able to have the platform to help viewers out there make better investment choices so that they can have a better life, so they can achieve their American dream. That's what ambition is all about.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned, sponsors disappeared, fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
The Score, streaming now on CNBC.com and YouTube.
Welcome back, everyone. Let's get a check on oil prices now, which are moving higher today. This is after gains of over 1% yesterday. Just moderate moves to the upside now. Brent there trading just below $92 a barrel. WTI at $86 a barrel. This is as Trump vows economic warfare on countries helping Iran. He said that Washington will launch, quote, the most crushing economic operation ever taken against any country targeting Iran. Trump hit out at Tehran for failing to reach a deal to end their conflict, pledging economic warfare and isolation on an unprecedented scale. Trump also threatened tremendous consequences for any country that helps Tehran evade sanctions, urging an immediate halt to oil smuggling, swap lines, and cash transfers, amongst other channels. The U.S. leader's threat of economic D-Day came without details on specific measures or country. So we'll have to see how the oil prices, they haven't moved as much maybe as you might have expected on that news. But speaking ahead of his announcement, Trump addressed potential economic measures and praised the U.S. naval blockade of Iran.
We have things that we could sanction. We have very draconian sanctions, and we'll see what happens. Right now, the strait is open. A lot of boats are coming through. The blockade has been 100% successful. No boats have gotten into Iran, but they are getting in for other places. But we'll see. We're going to see what happens. It'll either be extremely good and oil prices are going to drop like a rock, or we'll continue to do exactly what we're doing. You know, they were talking about $350 a barrel, and it's today $84, $85. And we are getting a lot of oil out. But the other thing that's happened is people have found other alternatives, which they never thought about. Texas, Alaska, Louisiana, and other places. In addition, a lot of pipelines, record numbers of pipelines are being built. So I think the Hormuz Strait's not going to be quite as important as it was in the past.
And we take a look at European equities this morning, which are the outlier, mostly moving to the red there. Stocks 50 futures off nearly 0.2%. It's just moderate moves to the downside. But FTSE futures, you can see flat there. This is as we do see Brent rising to nearly $92 a barrel. Let's take a look at Asia, where it is a sea of green there, with the Nikkei 225 index and the Hang Seng index with gains of more than 1%. The Kospi, though, leading the gains, up nearly 6%. Those chip makers rallying. SK Hynix up in the double digits after a share buyback plan. And let's see how Wall Street gets set to open. Also moving higher with those US futures. This is after the S&P 500 snapped a 3-day losing streak yesterday, as we saw those yields on longer dated US Treasuries pulling back from those multi-year highs on plans of the government to increase its interventions in the bond market. Now, our next guest says he sees European stocks as particularly attractive, especially as investors look to hedge and diversify away from the US. He also sees a further 6% upside in UK equities. So I'm pleased to say Michael Field, the Chief Equity Strategy at Morningstar, joins me now. So Michael, let's first start off by discussing that statement there. What do you see as European equities are looking quite attractive right now, and investors, in your view, shouldn't be overlooking them?
So, Ridika, it's been a good year for equities. Generally speaking, European equities have more or less kept up with US equities, despite the lack of AI exposure that we have. There's been a lot of macroeconomic challenges, which you just mentioned a second ago, and we saw that clip about the Middle East. So there's a lot going on, certainly, but at the same time, companies are persevering. Earnings season has been quite positive, and actually we see a lot of upside still with some of these equities.
So let's dig into some of the macro factors there. One of them, of course, being oil. We are seeing oil moving a little higher today, and we've seen, of course, volatility in oil prices. But if we do see oil prices push higher or stay at these levels, what is that going to mean for European equities? Of course, Europe being much more vulnerable, given it imports a lot of oil.
So this is very true, and we saw a lot of disruption at the beginning of the year, with oil prices being higher, especially when they hit those peaks back in March at the beginning of the Iran war. Since then, it's calmed down somewhat. And one of the things, President Trump said that was quite correct there is people have found workarounds to some degree. Oil has appeared from other sources. And it's actually our view that supply will overtake demand in the medium term or even in the shorter term as well. That should push oil prices down further. The one thing I would say there that we could be concerned about is those second order effects of oil price inflation when that starts, hitting fertilizer prices and moving towards into the food chain. So we could see a bit of a resurgence in what we pay at the counter in terms of groceries and things like this. But with regard to the actual oil price, we're not as concerned as we were earlier this year at all.
Michael, do investors look at Europe as this kind of anti-AI trade? Is that where they're going to go away from the US to get more diversification? And how are you looking, I guess, at valuations compared to the US? How attractive does this make European equities? Or on the flip side, given they do have that lack of exposure to AI, is that really something that's going to hurt European equities going forward?
So investor sentiment always moves in waves, and at one point no one cares about diversification. They just want to get on the AI bandwagon and ride that out as far as they can. But every now and again, when AI gets a pullback, as we've seen recently, you get more interest in diversification and more interest in other regions that can potentially provide that diversification. And with Europe, we have a much lower exposure to tech. In the US, it's almost 40%. In the Europe, it's only about 12%. So there is that natural hedge away from tech that people now, I think, are becoming more interested in. And you hit the nail on the head there with valuations also. If Europe was trading at a much higher valuation than the US, then it's not something I would be advocating. But as it stands, the discount that we see about 4% upside to Europe, isn't completely different than what we're seeing in the US. So from that perspective, the risk reward is quite good.
So let's dig into the UK now, because you're seeing a further 6% upside in UK equities specifically. I mean, the FTSE 100 has been remarkably resilient. It's repeatedly reaching record highs. I mean, in your view, what is the force driving this rally?
So I think, for one thing, the UK had been undervalued as a market for quite a number of years, and that was illustrated in the last 2 years when we saw this kind of swathe of M&A activity with European and US companies taking over UK companies because the valuations were so cheap. And as you mentioned, the FTSE 100 has rallied since. I think people have come to see the UK as a good market and see that discount as unwarranted. So that's kind of a first point. And I think from a macro perspective as well, recent political situations such that the UK having a stable government again, all of these things are helping. And if you look at the the underlying macroeconomic measures, GDP, interest rates, inflation, it's not that much different from Europe at the moment. And I think investors are finally squaring those two up, and that's one reason why the FTSE has rallied so hard.
Do you think investors are maybe underestimating the political risks here with Andy Burnham as a new Prime Minister in terms of what we could get for maybe higher taxes down the line and more regulation? I mean, we're going to have the autumn budget if businesses are to get hit with more taxes, what impact that could have on UK companies.
So certainly there's a danger with any new political party or person in charge that something could happen, as you mentioned. Investors particularly fearful about that word regulation that you just mentioned, but at the same time, it's all relative. And if you listen to the statements that we've had since he took over as Prime Minister, a lot of those claims that were made in the run-up to the campaign have been watered down a little bit, such that businesses aren't completely worried. And relative to other European countries and US as well, and other places where the political playfield is uncertain at the moment or not completely known, the UK is a relatively stable place at the moment.
Well, how are you viewing the impact of the pound there? Because we have seen a strength in the pound. It's trading currently at 136.05 to the dollar. With the strength of the pound, is that something that could weigh on UK equities going forward?
So certainly, and I mentioned M&A activity earlier, obviously a strong pound is not going to positively affect M&A activity, but some businesses might look on that as a good thing. The pound is certainly strengthening against the dollar, but then again, the dollar has been very weak over the last couple of years as well. So I think the relative comparison maybe is more the euro and other currencies, but certainly that's not to take away from the strength that we've seen. One area that I would be concerned about is around gilt yields. You see those pulling back a little bit, but 10-year UK gilts are still trading at over 5%, which is, the highest since the financial crisis or whatever. So it's not like we're blasé about this. We're certainly looking at the risks here at the same time.
What about dividends? Those have traditionally been quite attractive for the UK or the FTSEs. It's been one of the FTSE's biggest attractions, I would say. But in a world where we are seeing these gilt moves, I mean, how important is the dividend story as well to the FTSE's case?
I think that's one of the big selling points for UK stocks generally, that the dividends are so high. And when I speak to US clients and my US counterparts, that's one of the things that I obviously mention with regard to UK stocks, how high dividends are there. I think, look, we're in a difficult economic environment for many companies. So, year to date, some sectors have done very well and some have done more poorly. So I think right now, the most important thing with regard to dividends is looking into the sustainability and the maintainability of those dividends. And you're not seeing that's the case with every single company. You're seeing some kind of home builders and stocks like this actually cut dividends, whereas other companies that have had a more stable revenue base over the last kind of 6-9 months, like utility companies, financials, etc., actually growing dividends. So it's a very mixed picture from that regard.
All right, we'll have to leave it there. Thank you so much, Michael Field, the Chief Equity Strategist at Morningstar. And coming up on the show, will AI replace the need for auditors, or will the technology give a boost to the industry? We'll discuss with the head of AI auditing firm Data Snippers right after the break. Stay with us.
As the Asia trading day begins, join me for Squawk Box Asia. What are you watching? Nobody would be thinking that level of a benchmark is possible. We're live across the region covering what you need to know from here and around the world that would shape the business day.
We know there's two winners in AI. It's going to be China-US.
Let's stay away from these companies that are selling it at 40, 50 times sales.
Join me for Squawk Box Asia, only on CNBC.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC+.
American soccer legend Landon Donovan. He'll explain how the 2026 World Cup could shape the future of Major League Soccer and the inner demons that drove him to greatness.
I was constantly chasing this insatiable desire to be noticed.
He's the man behind Apple's sports ambitions. In an exclusive interview, we talk about the tech giant's unique sports strategy and whether a blockbuster acquisition is on the horizon. This is CNBC Sport on the Record.
A market shaping industries. We are watching the six little dragons, the first to be listing in the Hong Kong market, supply chains, and global momentum.
Do you feel pressure to create the next Labubu soon?
This really is a business-first pivot despite the geopolitical strains. The China Connection, weekdays.
The trade heads are gathering against the backdrop of the global energy crisis.
CNBC.com and the app anytime. Let's get to your headlines. Only on CNBC, connecting you with China.
You're watching Europe Early Edition. I'm Ritika Gupta. Let's get into your headlines. Global government bonds get some much-needed relief, courtesy of the U.S. Treasury announcing plans to double buybacks at the longer end. President Trump bemoaning the Fed for high rates amid the rising debt burden.
We have interest rates that are artificial. They're actually artificially high. I think we have a very powerful country, and we're powering through these ridiculous interest rates. They're ridiculous.
President Trump threatens economic consequences against any country that helps or does business with Iran, adding the U.S. is preparing crushing economic warfare. And ECB Chief Christine Lagarde warns the U.S. retreat from the global order is hurting Europe's growth trajectory, urging policymakers not to repeat the mistakes of the dot-com boom in the AI era. South Korea will send a container ship headed for Europe via the Arctic this weekend in a bid to test the commercial viability of a new trade route. Monica Petrelli joins us now for more on this. Monica, what can you tell us?
Well, good morning. First of all, I can tell you there's many risks to this route, but there's many rewards. So let's talk about the risks first. First, I want you to think about sea ice as far as the eye can see. Also, storms and freezing temperatures even in the summer. But there's also environmental and political risks, as taking this route also requires that South Korea work with Russian officials to gain permits and the like, which Western officials are said to oppose. But the rewards include a much shorter route linking Asia to Europe. In fact, the operator of this vessel, Panstar, said a round trip could shave off about 30 days from going through the Suez Canal, which, of course, companies are avoiding these days, as we saw yet another attack on a cargo ship just yesterday near the Bab el-Mandab Strait. But the importance of this route goes well beyond finding an alternative to the Suez Canal. The route could become a national asset for South Korea. This is according to Cho Jung-hee. He's Korea's Maritime Institute's president. He wrote an op-ed piece today in a Korean broadsheet saying that the mounting U.S.-Chinese rivalry and its protectionist policies are really forcing South Korea's hand. And he said if Korea's past national strategy was largely about taking advantage of a given international order, its future strategy must focus on securing greater autonomy. Now, he also called this the first step in preparing South Korea for the Arctic era. It's an era that has not yet arrived, but one that already has competition, because this vessel, the announcement, and this vessel is set to sail on Saturday. It comes just days after the Chinese shipping company Sea Legend Shipping announced it would sail 8 weekly Arctic sailings between now and October. And they called this the first weekly container service through the Arctic Passage. It's back to you.
Thank you so much, Monica, for joining us there. Now, OpenAI CFO Sarah Friar has told company employees the AI startup will be a public company by 2027 or sooner, according to sources. Kate Rooney spoke to 2 sources familiar with Friar's comments and filed this report.
CFO of OpenAI, Sarah Friar, telling employees that OpenAI will, quote, be a public company in 2027 or sooner. This is according to 2 sources who were in that room, attended the meeting earlier. Friar, from what I'm hearing, did mention Anthropic, its rival in AI, said that there is a chance Anthropic does go public, maybe in September. She told employees, from what I'm hearing, that's okay. We are running our own race. She said the IPO is not a finish line, it's a milestone, called it another fundraise, and then pointed out that they raised $122 billion back in March, said that gives us flexibility. We will be a public company in 2027. She said we may go sooner if our business continues to, quote, inflect. But either way, we will do it on our own timeline. She also shared some new quarter-to-date revenue numbers. So revenue run rate up about 35%, pointed out enterprise revenue up 50% in the quarter. Codex, which is the enterprise side of the business, the coding side, 20 million users, up 3.5x, according to sources. This does coincide with OpenAI's latest model launching this summer, and some of the momentum, and it does, Mel, as you mentioned, come as the Journal reported earlier on some of the second quarter numbers from earlier this year, noting widening losses at the AI giant and then slower revenue growth, at least compared to Anthropic.
The deployment of AI within financial services is prioritizing internal operations rather than looking to reinvent a company's business models. That's according to the Cambridge Center for Alternative Finance, who say that process automation is the most common use for AI in internal operations as businesses look to improve their execution. I'm pleased to say now that Vidya Peters, CEO at Data Snipper, this is a platform that implements AI into auditing and data reconciliation, joins me now on set. Vidya, thank you so much for joining us. First of all, talk to me about how you're using AI in your business when it comes to auditing and data reconciliation.
Ritika, first, thank you so much for having me. It's a pleasure to be here. I think one of the key things that people get wrong about AI in audit is that it's not just about how quickly you get the job done, but it's about how much you can defend the job that you've done with AI, because ultimately there's no thank yous for doing the job to the finish line extremely quickly, but you will be fined by the regulatory organizations if you can't defend every line in your audit. So trust is at the heart of how we've built all of our agentic products at Data Snipper, which is, can you stand by where every number down to every decimal point can be traced back to evidence? And can you talk a bit about what the agent did versus what the human did? I think a lot of companies today operate in a black box with AI, which is you put in a prompt and you get back an answer. But the question is, what did the AI do? What did the human do? Where was judgment applied? These are the key questions that we focus on. Last but not least, when we think about trust, where's your data? And we're the only audit platform that has AI residency in the US, in Europe, and Asia Pacific. So we really ensure your client data stays within your borders.
Is there a big gap between adoption and integration? I read that in your notes. I mean, talk to me a little bit about this as we see this big enthusiasm for AI adoption.
There's enormous support at the high level. So if you look at our most recent AI survey, 75% of audit leadership is very supportive of using AI. However, only 13% of workflows have AI embedded in them, which means that people are dabbling on the borders, and mostly they're struggling with what I like to call the blank page problem, which is they want to use AI, but they're not sure how to. And so what Data Snipper did is we worked very closely with our customers, and we've developed now dozens of agents, pre-built agents, and a library that give them a starting point of where to build from their most common audit, whether it's payroll testing, revenue testing, closing the books at the end of a quarter. The most common audit and financial procedures now have pre-built templates. And what we're watching is now our customers have built thousands of agentic workflows using those pre-built agents. And that shows that what they're looking for is really that starting point to get further in their journey.
I mean, there's a lot of anxiety that AI is going to replace those entry-level jobs for new grads. If AI takes a lot of this work, I mean, what happens to the traditional career ladder for those in accounting and audit?
I'm an optimist. I believe they get promoted, which is instead of you starting as an entry-level data cruncher, you're starting as an entry-level manager. But you're not managing humans, you're managing agents. And why do I say that? It's because this is a business that's highly regulated. I just don't see OpenAI or Claude being called in to the SEC to be able to stand behind an audit. Ultimately, you're asking for someone with knowledge and certification to be able to back what the audit actually says. Second, it's not always black and white. You're really navigating an ocean of gray in terms of judgment and navigating all of the risks and the puts and takes that are involved in assessing a business. And last but not least, this isn't about you put in the data and you get out an answer. There's a lot of work that auditors do to sit across from a client, to ask the right questions, to develop an understanding of the business that provides the input into AI. And so I believe this is a partnership for the long run. It will change what the structure looks like. It will change the nature of the work, but I believe auditors are here to stay.
So you mentioned that there'll be more sort of manager positions, but do you still think overall that could mean that there are less or fewer people working in audit?
Well, we're already seeing fewer people work in audit. This is an industry where fewer people have joined it as a field of study. We see fewer people joining it as a profession, and we see more people leaving because they're exhausted from burnout. So actually, this predates AI, and so we have shrinking talent in this industry. AI is actually a huge boon because it's helping a talent-strapped industry do more with less, and I also believe this will help audit firms take on broader engagements, deeper engagements. There's no shortage of work in audit. Where we are short of is actually talent to go staff them.
Do you think regulation or regulators are keeping a pace with the speed of AI and the way it's being adopted into the industry?
I don't think anyone is keeping at pace with innovation. It feels like everyone's looking out the window and seeing the world zoom by. The regulators are doing their best to keep up with these standards, but the hardest part is never technology. The hardest part is human behavior, which is how do you get people to learn the new skills, to truly understand the risks and how best to balance technology speed with managing the risk, and not to mention managing the costs of using that technology. And I think there's a lot more that we can be doing in order to keeping up with where AI is going.
In terms of where you work, regions around the world, where are you seeing the biggest sort of growth opportunity? And also, what does audit look like 5 years from now?
Audit is very universal. And so one of the things we were struck by is at the highest level, the principles of audit are similar in Germany as they are in Argentina and Japan. And it's why we've been able to serve customers in over 175 countries globally. Now, we do find the American companies always at the tip of the spear in terms of their willingness and eagerness to adopt AI and move quickly. But I do have a lot of respect for European companies that want to be very thoughtful about customer data and privacy and really thinking through all of the ramifications before they bring AI into their firm. And so it's a balance. It's a balance of risk appetite and speed and your love for technology. We see those adoptions vary by region, and we wouldn't call them right or wrong. They're just very different in their approach.
But do you think then Europe maybe loses that race because they're slower with the adoption compared to the likes of the US in this industry?
It's fundamentally not a race. And that's where I beg to disagree, especially in audit, especially because no one is going to give you a gold medal for getting that audit done quickly. They will hold you accountable when you get it wrong.
All right, thank you so much, Vidya Peters there, the CEO of Data Snipper, for joining us. Now, coming up on the show, we'll discuss the outlook for the digital euro as Europe looks to strengthen its strategic autonomy.
One hour of added insight every morning doesn't just add up, it compounds. One extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC.
Listen to CNBC on the move with the CNBC app. A lot of strong numbers this morning. Breaking news.
We got a big IPO, something for the private markets. Could it be a rate cut scenario?
Real-time market updates.
I check now on how Europe is set to open the trading day ahead.
Your favorite programs live 24 hours a day.
Welcome to Squawk Box Europe.
Welcome to the China Connection, Squawk Box Asia.
Listen wherever in the world you are. Download the CNBC app now.
One of the world's largest private climate investment vehicles, Altera, aims to mobilize $250 billion by 2030.
What we're trying to show is that we can align those objectives and we can make money doing it.
Clean energy, emerging markets, even the AI boom. The opportunities are vast, but how do you pick the right investments?
We have people who specialize in these investments, and that's what makes Altera unique. That's our secret sauce.
Find out more on the next Managing Middle East.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show. Squawk Box, streaming on CNBC Plus.
Welcome back, everyone. Let's take a look at the markets over here in Europe. Pretty much the outlier this morning as we see futures moving to the downside. Stock 50 futures off nearly 0.2%. FTSE futures, though, flat. We do see Brent climbing a little higher this morning, close to $92 a barrel. Let's see how Asian markets are trading. And it's mostly there green across your screen with gains of over 1% for both the Nikkei 225 index and the Hang Seng. The Kospi, though, leading the gains higher, up 5.5%. It's been boosted by those chip makers. SK Hynix surging in the double digits on a share buyback plan. Let's see how the U.S. market closed. It actually snapped a 3-day losing streak for the S&P 500, closing up 0.2% higher. The NASDAQ as well, and the Dow also posting gains of a similar amount. This is as we saw those Treasury yields pulling back from multi-decade highs on some plans from the Treasury to intervene in the bond market to support it. We focus in on a stock of shares in Moderna surging 177%. This is after an experimental skin cancer vaccine developed with Merck produced positive initial results in its first late-stage trial. Data showed that the mRNA injection, along with Merck's immunotherapy treatment, met all key goals in phase 3 trials in more than 1,100 patients. Speaking to CNBC, Moderna's CEO explained the individualized nature of the treatment.
It's individualized, which is you will get a different drug. If you're diagnosed with melanoma today, and I'm diagnosed by the same doc, you and I will get a different chemical. But we're going to take a biopsy. We're going to sequence all the letters of the DNA of your cancer cell. We're going to do the same for your healthy cell of your body, most blood work. We're going to compare electronically where the mutations are. And we designed and we aim to improve an algorithm to pick 34 mutations that we believe are the most important in your tumor.
And if we take a look at futures in the US, we're seeing just small moves, though. The Nasdaq futures seem to be outperforming, moving to the upside. A little on the docket today, some jobless claims data that we'll be watching out for later. Now, the US President Donald Trump has called on lawmakers to pass a fair version of the Clarity Act as he met with top crypto executives at the White House. Bitcoin and other cryptocurrencies surged after Trump reiterated his support for the bill. Trump insisted the US is leading the field in the crypto sector.
We're ensuring that America remains the undisputed leader, not only in Bitcoin and crypto, but also technologies like prediction markets, artificial intelligence, and much more. And we're leading in every single one. And I will tell you, the AI, the artificial intelligence, we're way ahead of number two. Number two is China.
ECB President Christine Lagarde has warned that the US pullback from leading Western security is eroding Europe's growth model. Lagarde also urged leaders not to repeat mistakes from the dot-com era when it comes to AI, saying the continent cannot afford to miss out a second time. The final phase of negotiations between the European Parliament and member state governments on the operation of the digital euro are underway, with approval expected as soon as the end of this year. A pilot program is set to start in 2027, with the digital euro likely available for retail payments by 2029. The ECB sees the digital currency as a strategic asset which could help strengthen the bloc's autonomy and reduce reliance on US systems. Let's get more now from Pedro Schilling de Carvalho, the Assistant Professor of Financial and Environmental Law at UCL. Pedro, first of all, talk to us about, the timeline of the adoption of the digital euro. Does that look realistic in your view, and how significant is it?
First of all, thank you so much for having me. The timeline, again, it depends a lot on the political sphere. If you lawmakers really adopt the regulation, as you've mentioned, we're set to have the pilot next year and have the digital euro being adopted and issued by the European Central Bank at the earliest in 2029. The European Central Bank has done a number of milestones over the last couple of years, which sped up the process. It developed a draft rulebook, which sets the sort of common rules, the standards, the procedures for the digital euro to work. It started selecting providers from both the private sector and the public sector as well. It has been engaging with a lot of stakeholders to try to think about the best ways to use and deploy the digital euro as well. And the digital euro pilot will really be the test here, where some select participants will have a chance to use a beta version of the digital euro in real life situations, and we're going to really see if the technical functionalities, the processes, the user experience is aligned with what the ECB expects. So as long as all of those many elements fall together, we could see the adoption moving forward.
So the ECB has said this digital euro is really about giving Europe some sovereignty when it comes to payments. How serious do you think right now the dependence is of Europe on these US payment companies like Visa, MasterCard, PayPal? Does that justify creating the digital euro?
It definitely, if we look at the data, we can understand where Europe is coming from, and the broader geopolitics sort of explain why the process might have sped up quite a bit, right? So nowadays in Europe, the first relevant piece of data is that the use of cash is really decreasing, right? That was accelerated by the pandemic, that was accelerated by people being more used to using e-commerce, using digital payments. The problem is that people don't really have access to any central bank issue money in the digital form nowadays. And that means that most digital payments in Europe will rely basically on a lot of US-dominated payment systems. So around 70% of European card payments or card payment transactions are basically managed by payment-related service providers that originate outside of Europe. And more or less 60% of the countries in the Euro area don't have national card payment systems for in-store purchases. So, go ahead.
I was just going to ask, Pedro, I mean, one of the big concerns around this is that if there's a crisis, that people take their deposits out of these commercial banks and they go into these digital euros. I mean, could that change the role of commercial banks?
This is one of the broader concerns with the discussions around central bank digital currencies or CBDCs. There's concerns that CBDCs could distort the cooperation between banks, central banks and banks, and could lead to some bank disintermediation. That largely depends a bit on the design of the CBDC. The European Central Bank has tried to alleviate some of those concerns by, saying that your bank will still be your main point of contact. There's a lot of engagement with private sector. There's a lot of attempts to make sure that distribution will happen through retail banks rather than directly from the ECB to retail consumers.
So over in Brazil, I mean, the PIX system there has become a pretty big success story really overnight in terms of instant payment success story. So is Brazil now looking at connecting PIX with payment systems abroad? Is this something that Europe could benefit from when it comes to building kind of low-cost, widely adopted digital payments infrastructure?
So it might sound like a leap going to Brazil to discuss something else, but Brazil basically developed something called PIX in 2020 by the Brazilian Central Bank. And it's basically a digital public infrastructure for payments. So you have your PIX key that connects to your bank account, and you can do all sorts of payments through there in a very seamless fashion. So think about, you could do your mortgage deposits there, or you could pay for some ice cream on the street as well. But what's striking about it is that the adoption really boomed, right? So in 5 years now, PIX has almost widespread adoption, close to 90% of Brazilian adult population, many of which didn't have either a bank account or access to electronic transactions, has a PIX key. And now PIX accounts for more transactions in Brazil than cards and credit card and debit card payments as well. So around 55% of transactions are made through PIX versus 30% made with other kinds of cards. So it's an interesting proof of concept, near universal adoption in 5 years, which Europe hasn't been able to achieve with private coordination as it tried to do in the past. And it sort of shows how a central bank can deploy that kind of digital public infrastructure with a large degree of success.
All right, we'll have to leave it there. Thank you so much, Pedro Schilling de Carvalho, Assistant Professor of Financial and Environmental Law at UCL. Before we go, we'll take a look at European futures. Moving to the downside, seems to be an outlier this morning. Stocks 50 futures up off 0.2%. Over in the US, though, we see futures also mixed, but the Nasdaq future seems to be moving solidly to the upside. This is as we have seen Treasury yields come in lower on the Treasury intervention news. Let's see how the day shapes up. But that is it for today's show. I'm Ritika Gupta, and Squawk Box Europe is up next.
Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving? The biggest guests, the market action.
Right here.
Squawk on the Street, CNBC.
Never miss a moment.
We think there is a huge opportunity for AI in the UK and Europe because it is that middle ground between the United States and China.
Andy Burnham has committed himself to the Labour manifesto, so I don't think that that's going to change in the immediate future. I think our historic destiny is to be back in the European Union.
The world is taking you at your word, sir. What happens next?
We're never going to see Iran have a nuclear weapon.
Ambition doesn't always look like you think it might look. I've just always been super fascinated by what's happening in financial markets and what is that telling us about where the world is going. That's what drives me. I love being part of this.
Become a smarter investor with CNBC Pro. 24/7 access to market-moving news and interviews with 3 global live streams. Subscriber-only content from Wall Street pros like Josh Brown.
If you love the stock market as much as I do, you're going to love the best stocks in the market list.
Plus exclusive live events.
This is my first time at the stock exchange and it's been awesome.
To be on the floor, I just can't believe I'm here.
Become a CNBC Pro. Go to cnbc.com/GoPro now.
From the markets to the courts. Kick back and relax while we serve up the highlights. Tackle your weekend. This weekend, race to your screen. The adventure continues. Dive into the action with CNBC Sports. CNBC Sports, afternoons on Saturday and Sunday, only on CNBC.
Welcome to Closing Bell Overtime.
Get the essential post-market edge.
A very busy overtime.
After-hours action and opportunities.
The economic impact is just beginning.
What happened today?
The market had to resort to defense.
We've got a developing story out of Washington.
What's moving in real time?
What do the numbers tell you, pro or con?
Be ready for tomorrow after the bell.
There's a wait and see about a lot of things for tomorrow, Mike.
Completely.
Melissa Lee, Mike Santoli, Closing Bell Overtime, CNBC.
A very warm welcome to Squawk Box Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. Global government bonds get some much-needed relief, courtesy of the US Treasury announcing plans to double buybacks at the longer end. But steady your horses, I'll go through this in a short while. But President Trump bemoaning the Fed, wow, for high rates. It didn't take long, did it? Amid rising debt burdens.
We have interest rates that are artificial. They're actually artificially high. I think we have a very powerful country, and we're powering through these ridiculous interest rates. They're ridiculous.
Meanwhile, President Trump threatens economic consequences against any country that helps or does business with Iran, adding the US is preparing crushing economic warfare. ECB Chief Christine Lagarde warns the US retreat from the global order is hurting Europe's growth trajectory, urging policymakers not to repeat the mistakes of the dot-com boom in the AI era.
One or two things to say about the bond market. Should we do it now? You ready? You sitting down? Got your coffee? Okay, let's go. The US Treasury has stepped in to try and stem the sell-off in Treasuries, announcing it will at least double. Wow, this is amazing. This is amazing. It's going to at least double the size of its liquidity, support, buyback operations for bonds dated from 10 to 30 years. That must be a massive amount of money if they're going to double it. We'll come to that in a moment. The announcement pushed the yield on long-dated debt sharply low, with the 30-year Treasury yield down around about 5.2, 5.18% this morning. But how much money? How much is the doubling? You got to know, guys. We've got to know this, haven't we? The doubling is going from, wait for it, a mighty $2 billion, I think, to $4 billion. Wow, that's going to really stave off all this selling at the long end, isn't it? Oh, hang on a second. Hang on a second. How much money does the US borrow every year? I don't know, a couple $1 trillion? But that's right. They're going to double from 2 to 4 billion their buyback of the long end. That'll save everything. No, hang on. What's the deficit? There isn't it. 6%? Oh, no, don't worry about that now, because they're going to double it from 2 to 4 billion at the longer end as well. How much money does the federal government spend every year? What, $8 trillion? Don't worry, because at the long end, there's going to be an extra $2 billion to stave off those concerns as well. Hang on, what's the interest payment in the United States from the government? What? $1.5 trillion a year for 2026? That's okay, though, don't worry, because the Treasury is going to buy an extra $2 billion at the long end. It's all solved now, okay? So don't worry, the show's over. Anyway, that 5.18% yield is closely tied. I mean, do you see what I'm saying? Do you get you get my sarcasm? Good, okay, right. It's British irony, okay, in case you don't understand. The yield is closely tied to the rate Americans pay for things like mortgages and car payments. So it is perhaps unsurprising the Trump administration has moved to try and push rates down as its war on Iran helps push gasoline prices to their highest level ever for August. Hang on, but didn't the president in the headlines just bemoan the government, the Federal Reserve interest rate level, which is way too high? But hang on, at the same time, gasoline price, the highest level in August. Oh no, the two are totally unrelated, that's right, I forgot. That gasoline price surge has helped hold inflation at nearly 1.5 times the Fed's target. President Trump hit out at central bankers on Wednesday. Oh, stop the clock, you lot. Stop the clock. How long has Walsh been in place? When did he get his confirmation? May, was it, I think? May, June? I bet we knew this would happen. As soon as light follows day and day follows light. We knew that, didn't we? The President Trump has hit out at the central bank on Wednesday. Kevin, you've had a honeymoon period. It's over. Suggesting members of the Federal Open Market Committee hike rates because they like the politics of it. Hang on, you elected Walsh. Oh, I'm really confused now. The Fed hasn't actually hiked rates in more than 3 years and cut them 3 times in 2025, actually. This as the minutes from the FOMC's July meeting were released on Wednesdays, with many officials saying a hike would be needed if inflation doesn't abate. But the US leader insisted rates are too high where they are now.
We have interest rates that are artificial. They're actually artificially high. They raise them for no reason. And you can't go out to the market when you have a Fed that's raising interest. You can't say, oh, I want to pay 3 points less than what the Fed says you're supposed to be paying. So, no, I don't think so at all. I think we have a very powerful country, and we're powering through these ridiculous interest rates. They're ridiculous.
What's that? Calm down, Sedgwick. The numbers aren't that big. I apologise. Someone's out there just shouting at the screen. Calm down. So, OK, I'll be more measured about this as well. So, the $1 to $1.5 trillion interest payment, it is what it is. The $8 trillion that the Fed will spend this year, the federal government will spend this year, is what it is as well. The $2 trillion of borrowing is what it is. So we don't perhaps worry about it quite so much. Oh, but there is another little inconvenient factor out there, and that is that America's national debt, have a look at this, national debt has hit, oh my God, look at that figure. It's almost as if they had it ready for me. $40 trillion. $40 trillion. It's more than doubled since the president's first inauguration less than a decade ago. Let's not be political about this. There's a chart showing whether you're a Democrat, whether you're a Republican, the figure has gone up, okay? And it's gone up also. It's not just about the absolute money. It's about the debt to GDP. And if I said to you we're roughly double what we were at the big financial crisis in 2007 to 2010, Our debt to GDP in America now is double those levels, give or take. Now, more than a quarter of that $40 trillion is coming under the President, Mr. Trump's watch, exacerbated by his One Big Beautiful Bill Act, which the Financial Times says is set to push up debt by more than $4 trillion by 2034. So that swelling debt figure now means the government spends a record $1.37 trillion a year just servicing the interest on that debt. I just mentioned that. Now that's more than the budget for the Pentagon, and is more than this year's outlay on Medicare. Anyone else? Well, I'll do so in a minute. Earlier this month, a Reuters Ipsos poll found that Americans now see Democrats as better stewards of the economy than the Republicans for the first time in around about a decade. Don't forget, under Obama, it went up. Under Biden, it went up. And Republicans quite rightly then criticised Democratic administrations for, dare I say it, not getting a grip on the national debt. Now the boot is on the other foot. Bond yields around the world are starting to pull back after the Treasury's intervention. It says here, have a chat. I kind of almost said quite a lot of what I've got to say, but I'm going to talk one or two more things. Anyone else remember the acronym DOGE? Anyone? DOGE. Department of Government Expenditure, wasn't it? And that was Elon Musk coming in to hang on, I'll rip up the vast amount of spending, wasteful spending, that is leading to these big deficits as well. In fact, the Big Beautiful Bill plus Doge was going to actually get that deficit down from... I remember Kevin Hassett on CNBC many, many times. He'd probably still say the same thing now. Get that deficit down from 5.9, 6.3, whatever it is, down to the 3% level that they wanted to get to. Where's the evidence that this is working? And that's what's worrying me, Ben. It's 8 minutes past, you get a word in. Good morning, my friend.
Hello, good morning, everyone. I am here. I mean, it's at that point, just pick up on that point, the FT's done some calculations on this, and the federal debt, the gross federal debt, has grown by $3 trillion over the past year alone, and they reckon that's the fastest pace outside of the pandemic. So, to your point about efforts to try and scale back the growth of the deficit and how much is being added to the total debt pile, it doesn't seem to be working. The other issue that comes to mind with this, there's something I don't understand, and I don't know if...
Welcome to my club.
I don't know if anyone else understands this. Why does the US government borrow? Because they don't have enough money to cover the spending that they need based on what they're getting in. They've got less coming in than they've got to need to spend. So when they say they're going to buy back treasuries...
Yeah, it's to keep the liquidity going in the longer end.
But where's that money...
On the longer dated stuff, the older stuff that's not got quite so much...
Where's that money coming from to buy the debt? Because presumably they're having to borrow to then buy the debt, which sounds like a bit of a house of cards.
Sounds a bit like financial alchemy, doesn't it?
It does. It really does.
There is another factor. Oh, sorry, please.
And I was just going to say, I mean, I suppose there are lots of people sort of looking at this thinking, I don't want to ask this or point out because if there's an obvious answer, I may sound very silly. But actually, to me, it doesn't make sense.
The obvious answer is always the right answer, Ben, and that's why I don't understand a lot of what's going on in the world at the moment. I hold my hand up. Any regular viewer knows I've had my concerns about the debt profile of very many places, by the way, not just the United States, for a very long time, including China, including Europe, including United Kingdom as well.
Because it's not the central bank doing it. It's not. This isn't the Fed we're talking about. This is the Treasury. And I suppose one way to do it is you borrow at the short end to fund some of this longer dated bond buyback. But if you're doing that, it's effectively like taking out more on your credit card to pay down your mortgage.
What does Kevin Walsh want to do? What does Kevin Walsh want to do? He wants to be a good steward of a growing economy that doesn't have financial market ructions as well. One of the ideas that Kevin Walsh has had, and he said many, many sensible things, he said in his affirmation hearings, confirmation hearings, in my view. One of the things he wants to do is have a smaller balance sheet for the Federal Reserve. That is the big thing. Quantitative easing works in periods of time, but it should not be something to lean on the whole time as well. How on earth, given this backdrop, does Kevin Walsh significantly reduce the size of the Federal Reserve balance sheet? And that is a question which I haven't had an answer for anyone. It sounds great in principle. Why have we got this huge asset base of bonds that actually is distorting the broader market. But actually, what we want, it seems, given the Treasury's action, is a little degree of less market and a little bit more degree of distortion. But if that's the case, when does the real battle tanks of the Federal Reserve have to start either A, reinvesting the bonds that expire, or actually then just buy more bonds outright as well, increasing the balance sheet rather than declining the size of it as well?
Well, yeah, I mean, it's the question that I think we've asked multiple times to the guests we've had around this desk with us, and said, you know, how can he possibly achieve that well-established goal that he set out before he even took the job as chair of the Fed, that he wanted to trim the balance sheet? How can he do that without further pushing up these yields that were already at nearly 20-year highs? And no one seemed to be able to give any sort of set of circumstances in which he would be able to do that. Maybe you could argue, if there were an end to the conflict with Iran and fears about inflation eased and the Strait of Hormuz reopened and oil started flowing, the inflationary fears that are feeding into this might have...
And here's the point. Here's the dispelling of the myth as well. US interest rates are 3.75%. It is not Kevin Walsh. It is not Jay Powell. It is not Lisa Cook. It is not the FOMC more generally that is setting that 10 to 30-year paper as we speak on a daily basis. It is the market turning round and saying, we are concerned, we're not flashing red, but we are concerned about the $40 trillion. We are concerned about the 6% deficit. We are concerned about the $1.5 going to $2.5 trillion interest payment that you're having to do on this, which wipes out Medicare and or defense as well. It is the market that is saying, we are not going to lend you money at the longer end unless you give us a better yield. It is not the Federal Reserve which is dictating that price as well. And by the way, the answer to the question is 97 days.
What was the question?
The question is, how long did it take for Trump to start getting annoyed at the Federal Reserve's policy under Kevin Walsh?
Yeah.
Because I'm pretty sure I've heard the president saying in the intervening period, Kevin's doing a great job, we've no problem, we're going to be hands off, he knows what he's doing. And that's pretty much the same kind of time frame that happened back in 2017 with Jay Powell.
Yeah, and I think...
Who was appointed, of course, by Donald Trump.
Just picking up on your point about it's the markets, it's the bond markets, it's the bond investors who are...
It's the buyers.
It's the buyers who are setting it. They can often be portrayed as, you know, the villains. Politically, they may be portrayed as the villains, you know, they are causing problems. But I don't think, you know, I don't think the bond market is an impatient one. They don't necessarily even want to see it solved now. They just want a roadmap and to feel that the government is serious and has a credible plan for dealing with the growing deficit.
Absolutely.
And that would be enough to placate, to my mind, that would be enough to placate the bond markets and ease some of the pressure. That's what
this show would be very, very happy for the plan to work. I don't want to see financial cataclysms. I don't want to see bond market reactions. I want my own personal life, my family's, my children's, my friends, I want them to have a nice, easy world where actually they're not worried about high inflation, where they're not worried about bond markets stopping them getting mortgages at decent rates as well, where they're not worried about their student loans, what have you. I genuinely want this to work. But if the big, beautiful bill, which is cut taxes, and the rest of the policies combined from this administration continue to create a 6% deficit rather than the targeted 3%, then the plan isn't working and it's just storing up more problems for the next administration and then the next administration, which, again, Democrat and Republican politicians have failed to address. This is a combined problem. This is not a Republican-Trump issue on its own. This is everyone failing to do their duty for the next generation. Steve.Sedgwick@cnbc.com. I will take all your emails. Genuinely, I will look at them all, the good, the bad, the ugly, and I will look at them and I'll try and get back to as many of you as possible, either in writing or indeed in the show as well. Paul, you've been writing in this morning. Gary, you're always writing in as well. Thank you very much indeed. There's quite a lot of you out there who probably feel as exacerbated as I do about this. In the meantime, oil.
Yeah, and I should say, he does reply. He does reply. Sometimes when I'm talking, you'll hear the keyboard tapping away. That's Steve replying to your email.
I'm not as bad as it's supervising producer Katie, who destroys her keyboard when she types. I'm a little bit quieter than that.
Anyway, yes, as we were saying, let's have a little check on what's happening with oil. And it is up again in the session, around about 1/5 of 1%. It had jumped yesterday about 0.2%. Brent crude was up at $91.62, so adding to that advance. Just to say, if you're tracking oil across this week, both Brent and US crude up between 3.5% and 4%, on pace for a second positive week in a row. So unsurprising given the lack of clarity about any sort of route out of the conflict between the US and Iran. In fact, US President Donald Trump has said Washington will launch, quote, the most crushing economic operation ever against any country targeting Iran. Trump hit out at Tehran for failing to reach a deal to end their conflict, pledging economic warfare and isolation on an unprecedented scale. Trump also threatened tremendous consequences for any country that helps Tehran evade sanctions, urging an immediate halt to oil smuggling, swap lines and cash transfers, among other channels. The US leader's threat of economic D-Day came without details on specific measures or countries. Speaking ahead of his announcement, Trump addressed potential economic measures and praised the US naval blockade of Iran.
We have things that we could sanction. We have very draconian sanctions, and we'll see what happens. Right now, the strait is open. A lot of boats are coming through. The blockade has been 100% successful. No boats have gotten into Iran, but they are getting in for other places. But we'll see. We're going to see what happens. It'll either be extremely good and oil prices are going to drop like a rock, or we'll continue to do exactly what we're doing. You know, they were talking about $350 a barrel, and it's today $84, $85. And we are getting a lot of oil out. But the other thing that's happened is people have found other alternatives, which they never thought about. Texas, Alaska, Louisiana, and other places. In addition, a lot of pipelines, record numbers of pipelines are being built. So I think the Hormuz Strait's not going to be quite as important as it was in the past.
What's that? You gave Ben 2 minutes of airtime in 18. Yeah, I know. It's too much. Yeah, I agree. Okay, thanks.
Bring Steve back in. Let him get a word in edgeways. What?
Well, the thing is, one of the greatest things about a journey is at least you're aware of your own faults sometimes. You know,
it's not a fault, it's a quality.
I can look in the mirror and see my own faults sometimes.
It's not a fault, it's a quality, and we admire
Bless you, you're very sweet. Coming up on the show, he has to say that. Coming up on the show, OpenAI's CFO says the company will be public by next year or sooner, according to sources. We shall discuss. Plus, Heathrow loses its crown as Europe's busiest airport. We're going to speak to the CEO of the new title holder, and it's a beautiful airport. I was there quite recently, actually. And we'll speak to the CEO of Novonesis after the group ups its full-year organic sales growth forecast. Esther Bergette coming up in a few moments.
You can master your strategy, but performance could be limited by your instrument. Precision trading starts with the right instrument. Over the past 3 years, Interactive Brokers clients outperformed the S&P 500 on average. Like returns, trading costs compound. Interactive Brokers is built to lower costs through smarter execution. Access stocks, options, prediction markets, and more across 170+ global markets. The best informed investors choose Interactive Brokers.
From the markets to the courts. Kick back and relax while we serve up the highlights. Tackle your weekend. This weekend, race to your screen. The adventure continues. Dive into the action with CNBC Sports. CNBC Sports, afternoons on Saturday and Sunday, only on CNBC.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned, sponsors disappeared, fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
The Score, streaming now on CNBC.com and YouTube.
Halftime Report, weekdays streaming on CNBC+.
Welcome back. Shares in Moderna surged 177% after an experimental skin cancer vaccine developed with Merck produced positive initial results in its first late-stage trial. Data showed the mRNA injection, along with Merck's immunotherapy treatment, met all key goals in phase 3 trials in more than 1,100 patients. Speaking to CNBC, Moderna's CEO, Stéphane Bancel, explained the individualized nature of the treatment.
It's individualized, which is you will get a different drug. If you're diagnosed with melanoma today, and I'm diagnosed by the same doc, you and I will get a different chemical. So we're going to look at, take a biopsy. We're going to sequence all the letters of the DNA of your cancer cell. We're going to do the same for your healthy cell of your body, most blood work. We're going to compare electronically where the mutations are. And we designed and we aim to improve an algorithm to pick 34 mutations that we believe are the most important in your tumor.
Novonesis has reported first-half organic sales growth of 8% amid solid performance in its food and beverage and household care units. The Danish biotech firm raised its full-year sales growth forecast to between 7 and 8%. Always a privilege to speak to Esther Beget, who is the CEO of Novonesis. Esther, congratulations on the numbers. They look incredibly solid to me, but just tell me what the highlights are for you and where you perhaps need to do some work still.
Thank you, Steve. Always a pleasure being here with you. Yes, we feel very good. We are in a good place. We deliver another quarter of extraordinary performance, another dot on our trajectory of a say versus do. 8% growth, it's a good number, the growth of the first half. And that strong growth coupled with the good momentum, also what we see in Q3, and our read of the market and the strong pull on demand for our solutions puts us in a good place. And raising the guidance of revenue to 7 to 8%, with also aiming to the high end of the profitability and strong cash flow. Important to mention that we also announced a multi-year share buyback program while we continue to invest for future growth, sustainable long-term profitable growth and share value creation for our shareholders.
Esther, you and I have talked a lot about the Christian Hansen merger, which is, about 2.5 years ago now, the start of that process. Now, have you finished extracting all of the obvious benefits from that in terms of synergies and what next for the combined company?
Oh, we're not done. We're just starting to see the tipping point of the amazing combination and the power of biology. We see the powerful combination of enzymes and microbes together in dairy, not only enabling higher yield, higher productivity, cost savings for our customers, but higher protein, taste, texture, palatability, extending the shelf life. We see the combination also in a higher protein or low sugar, lower salt baking goods. We see the power of the combination in new innovation coming in beverages, where we're growing in a difficult market with innovation. We see the power of the bigger company in emerging geographies and having the muscle and collecting the fruits of the investment we've made in commercial resources, getting closer to the market in commercial geographies and in emerging geographies and getting that capitalized into growth. So we are in a good place, but we are not done.
Esther, it's Ben here. Nice to see you as well. I just wanted to get a little more detail on the this new denim bleaching product that your company's come up with, because it is such an imperative for any company involved in chemicals to try and reduce the, I suppose, the environmental impact of the processes. And it sounds like this gives consumers what they want, that classic denim faded look, while lessening the environmental impact. Here, just explain how big a deal this is.
I don't think I can add any better words to the way you describe it. Maybe if anything, it's not at the expense of cost. Novonesis continues to prove the world that making a better planet and driving a good business, they go hand in hand. We drive productivity improvements, cost efficiencies, as we come in with solutions that replace chemicals, coming to solutions that enable healthier products, cleaner labeling food, and the beautiful denim example you show is just a way of showing that there is innovation also in a market where we can continue to make a difference.
In terms of the way that the company's using AI, if at all, how big a role is it playing in terms of research and development in developing chemical processes and speeding up getting new products to market?
Absolutely. AI is a beautiful friend for us. We have embedded AI across all the enterprise, but particularly in R&D, where we're capitalizing on a very strong foundation. We have more than 100,000 strains in our libraries. We have more than 50 million structures of enzymes. And we have all the data on how those microorganisms, those proteins perform at the fermenter, and also the performance they bring at the customer. We used to use machine learning, so we have that mindset and that structure already in place. And now with the more powerful LLMs, with AI in place, we're simply capitalizing on that. We already see the fruits with more shots on the goal. We have reduced the length of R&D projects from years to months. We're increasing the impact and the power of the solutions that we bring. And you saw that reflected a little bit in the sales, but only we see it on the strength of the pipeline. Today, more than 20% of our solutions, our revenues from solutions that are less than 5 years old and contributing to growth. AI will be a further boost of that efficiency gains, of that breakthrough of innovation, continue to be closer to our customers and continue to provide value-added solutions.
Esther, you have come from the same place I do as well. It is heartbreaking to see the yields diminishing on so many agricultural areas of the world because there's not enough water, because the climate is just too hot as well. All kinds of issues there as well. I know that what you're doing and what your team are doing is part of the trying to work out solutions, but do you have concerns that the climate change challenge that you and I have looked at so much, and we've been privileged to be at so many COP meetings as well, that actually that challenge is being lost despite the best efforts of innovation?
I'm going to unfortunately repeat myself here. I see no change on the momentum for biosolutions as an enabler of a healthier, better planet. Because we don't make a trade-off between productivity, efficiency, and then benefits for the planet, benefits for healthier people, benefits for healthier foods. And that momentum has never been that strong. And now, building on the previous question, with the power of AI, with the capability of bringing even bolder solutions faster into the market, we continue to be under investments we've made on the past, on people, on R&D, and on CapEx. We feel in a very good place to continue to contribute on healthier planet, health solutions that enable healthier foods, and being our contribution on moving the world into a better place as we're driving shareholder value creation.
And I've seen the buyback as well, so that's fascinating for a lot of the shareholders. Esther, I'm going to leave it there. Time has beaten us. Lovely to see you as ever. Thank you for joining Ben and myself. Esther Bergette, who's the CEO of Novonesis. Thank you. And as I'm sure a lot of you are aware, Esther is incredibly generous with her time in our Conversational Executive Decisions podcast. And I'll be brutally honest with you, and I hope Esther doesn't mind me saying this as well. She finds it very difficult to kind of talk about herself rather than the business as well. So that made the conversation even more valuable. And it's available in all the usual podcast places. It was a brilliant conversation with a brilliant CEO. It's available on cnbc.com and our YouTube channel. Right, let's take a look at the European equity futures as we go to break. We are 30 minutes away from the start of trading. We are called around the flat line at this early stage.
Kelly Evans with in-depth reporting and analysis. Strengthen your investment strategy on The Exchange. Streaming on CNBC+.
Welcome to Closing Bell Overtime.
Get the essential post-market edge.
A very busy overtime.
After-hours action and opportunities.
The economic impact is just beginning.
What happened today?
The market had to resort to defense.
We've got a developing story out of Washington.
What's moving in real time?
What did the numbers tell you, pro or con?
Be ready for tomorrow after the bell.
There's a wait and see about a lot of things for tomorrow, Mike.
Completely.
Melissa Lee, Mike Santoli. Closing Bell Overtime. CNBC.
A warm welcome to Scorebox Europe with Ben Boulos and myself, Steve Sedgwick, and these are your headlines. Global government bonds getting some much-needed relief courtesy of the US Treasury announcing plans to double buybacks at the longer end. President Trump bemoaning the Fed. Didn't take long, did it? For higher rates amid the rising debt burden.
We have interest rates that are artificial. They're actually artificially high. I think we have a very powerful country, and we're powering through these ridiculous interest rates. They're ridiculous.
President Trump threatens economic consequences against any country that helps or does business with Iran, adding that the US is preparing crushing economic warfare. Plus, the ECB chief, Christine Lagarde, warns the US retreat from the global order is hurting Europe's growth trajectory, urging policymakers not to repeat the mistakes of the dot-com boom in the AI era.
Let's check in on the markets, and for a change we've got some green in our summary of how Wall Street did in the previous session. All the three benchmarks snapping their three-day losing streak and closing higher. We saw equities get a boost after the Treasury Secretary Scott Bessent announced that plan to buy back government debt at the long end. So that has given equities a bit of a lift. We also saw a big jump in healthcare in the US. This is after Moderna and Merck gave an update on their skin cancer vaccine and some positive updates there. The biotech ETF from SPDR jumped by nearly 6% after the back of that. And we also got the minutes from the Fed, worth mentioning that, and it showed FOMC members more divided, and some of them saying quite outright that they feel that the Fed would need to hike rates if inflation does not start to ease. But anyway, the equities performance on Wall Street set the tone for the Asian trading session, and this is how things look on Asian equity markets. A very strong showing from the Kospi, up almost 6%. The Nikkei advancing as well. These have been helped because as soon as we saw the yields on US government debt ease, we also saw similar moves on other sovereign debt elsewhere globally. So that has also helped to lift equities. That's the picture on the Asian markets. We are rapidly approaching the European market open 25 minutes from now, and a slightly more muted picture being expected. It's just the FTSE futures on this wall that is being called higher. We have seen, it's worth saying, one thing that may be holding equities back from any more ambitious gains is the oil price. That has continued to tick up day by day. Brent crude is pacing for a weekly rise of around 3.5%. It's currently above $91 a barrel. But let's focus in on the treasuries, because the announcement that the Treasury, US Treasury Department, will double the level of its buybacks from September has helped to ease some of the pressure on sovereign debt a bit. It's helped to ease it a bit. But this is in the context of those yields on the 30-year debt having hit the highest level for almost 2 decades. But you can see across the curve, they've all pulled back following that announcement. In terms of what's happening with European yields, this is the picture for European government debt. Again, tracking that easing in the concerns in the US debt as well. Steve.
Thank you. You're getting in touch in LinkedIn, in email, in Messenger. Appreciate it. Trying to get to all of you as well. Just one more point. I can't help get exacerbated about this story. I'll just make the one point. President Trump says that interest rates are at artificially high levels, and the US economy is powering through despite those artificially high levels. Okay, let me take the president at his word. What happens? Because, by the way, the government in America, in any government, doesn't borrow money from the Federal Reserve. It borrows money from the market. It borrows money from the bond market. What happens to the cost of that borrowing for America if Kevin Walsh were to listen to the president and cut rates? Let's say, what does the president want the rates cut? He wants them cut 1%, couple of percent, 2%? Okay, let's just go with a scenario where it's not too extreme. What happens to the cost of borrowing, the cost of the money that America will borrow off the bond market, if the Federal Reserve were to cut interest rates by 1 to 1.5% tomorrow? Would the cost of borrowing for America go up or down? Would the credibility of the Federal Reserve go up or down? Would the confidence in the dollar as the reserve currency of the planet go up or down if Kevin Walsh were to do tomorrow what the president is asking him to do and cut interest rates, not by 25 or 50, by an aggressively large 100 basis points plus? I'm asking you the question. I think I know an answer, but I don't know. All right, let's leave it there. Shares in Rockwool fell after the building materials company raised its revenue guidance for the year, but it was less than some investors had been expected. The Danish firm said it expected revenue growth of between 5 and 7% for 2026, up from 3 and 6% previously. The results come amid a summer of heat waves across Europe, with the Copernicus Climate Change Service confirming July was the second hottest July in Western Europe on record. Wow. Placing further emphasis, of course, on building sustainability. Jesmund Hansen is the president and CEO of Rockwool and joins us now. So many questions for you. Thank you so much indeed for joining us today. You're our second Danish CEO of the morning, so there must be a thematic. Look, tell me a little bit about your company and about the products you're offering in the 21st century and what the challenges are. There's a lot of questions in one there, Jez.
Yes. Yeah, thank you very much for having me on this morning. So Rockwool is a global player in the building materials industry, and we're known for our insulation products. And our name Rockwool literally says what we're doing. We are taking stone, melt it into a lava, and then we spin wool out of it. And this material is a fantastic insulator. So many buildings are insulated with stone wool. And it has the additional properties of being non-combustible and very strong acoustic properties. And these are important factors these days, of course, when people talk about energy efficiency and the heightened awareness around fire and fire protecting of buildings.
Yeah, and look, what it becomes really interesting for me as well is I look a lot at the retrofitting of buildings to make them fit for purpose in the 21st century, whether it's homes, whether it's offices, whether it's manufacturing sites as well. So it's not just about new buildings, it's about getting the building infrastructure we made over the last 30, 50, 100 years and making it fit for purpose, giving it proper insulation, as you say, noise and sound insulation as well. How much has the climate change story been a driver for you, Jez?
It is certainly a factor. But again, you're mentioning two big drivers of our growth, and we see significant growth right now. In Europe, it's very much the renovation of existing buildings. The EU has come with a row of regulatory measures, so has the UK, by the way, very similar, of upgrading buildings, being more energy efficient. And it is because buildings consume around 40% of the energy consumed in Europe, and hence also, of course, generates around 40% of CO2. So renovating the existing building mass has become a very high priority for EU, and not just for the sustainability reasons, but these days it's about geopolitics. It's about being independent from energy from abroad, but it's also very much about competitiveness, that we don't spend so much of our resource set on energy, and in both in industry and in other commercial settings, but certainly also in residential, can reduce our spend on energy.
Yes, it's Ben here. I'm just intrigued as to how the bigger picture is affecting your company, if at all, because when you see inflationary pressures when it comes to energy, inflationary pressures when it comes to processes and materials, it can potentially hold back investment, whether that's by businesses and expanding their premises or building new premises. How much of that do you feel is holding things back? How much better would the situation be if we weren't seeing this jump in energy prices, for example?
Just to put it in perspective, we delivered a 10% growth last quarter. So even though some of the factors you mentioned, of course, influence our business, the interest in saving energy these days, energy efficiency is overriding some of these. But you're right, traditionally, the building industry, construction, has been very sensitive to interest rates and input cost, and it certainly is still a factor. But it's basically overridden by the need for energy efficiency measures in both industry and commercial these days. And then back to your original point of how does the heat wave influence it? When it comes to energy efficiency in buildings, us Scandinavians have grown up with that this is about keeping a house warm. But of course, what we have realized in Europe, and by the way, this is a global agenda, but certainly also in the US, is that during summer, it's equally much a matter of keeping the heat out. And that again really drives a demand for products that can insulate, protect buildings, both, as I said, with energy efficiency measures, but certainly also the fire aspects. I mean, just look at the tragedies this summer, how many wildfires we've had, both in Europe, Asia, and in North America. So people are much more cognizant around these factors when it comes to their buildings, protecting high-value assets, and that drives our growth these days much more than whether or not the interest rate is a few, elements higher or lower.
I was going to ask you about that, the impact of, obviously, globally, government borrowing costs are high. Yes, they have eased in the last day. But, of course, that then sets the parameters for mortgages for people. That then affects the construction of new homes and whether developers are willing to proceed with that, if they feel the market is there or not. How concerned are you about what we're seeing in terms of the elevated borrowing costs globally at the moment?
But historically, it's something we have followed very carefully, and again, it is certainly a factor when it comes to capital-heavy investments such as construction and buildings. But some of the other elements of renovation, and in Europe, also providing dwellings. I mean, Europe has, the last many years, built up an enormous deficit on dwellings. If you look at the UK, we're talking maybe north of 500,000 houses that are needed. The same in France, in Germany. So yes, there are short-term effects of macroeconomics here and now, but there's also some long-term trends of a need for many more dwellings in Europe, similar case in the US. And then this heightened political interest of reducing our dependency of energy from abroad. And renovating buildings are just the fastest and, by the way, cheapest way to get rid of Russian gas. And that's what drives the demand and overdrives the demand via the macroeconomic factor.
Okay. Jess, thank you very much for your time this morning. Jess Munch-Hansen, President and CEO of Rockwool. Thank you for your time as well, and stick around if you can, because we've got plenty more coming up, including Heathrow losing its crown as Europe's busiest airport. We'll speak to the CEO of the new title holder. And remember, as always, you can subscribe to CNBC's The Daily Open EMEA newsletter, giving you a quick and succinct recap of the key markets-related stories from overnight, as well as a look ahead to what is coming up in the trading day.
Never miss a moment.
We think there is a huge opportunity for AI in the UK and Europe because it is that middle ground between the United States and China.
Andy Burnham has committed himself to the Labour manifesto, so I don't think that that's going to change in the immediate future. I think our historic destiny is to be back in the European Union.
The world is taking you at your word, sir. What happens next?
We're never going to see Iran have a nuclear weapon.
American soccer legend Landon Donovan. He'll explain how the 2026 World Cup could shape the future of Major League Soccer and the inner demons that drove him to greatness.
I was constantly chasing this insatiable desire to be noticed.
He's the man behind Apple's sports ambitions. In an exclusive interview, we talk about the tech giant's unique sports strategy and whether a blockbuster acquisition is on the horizon. This is CNBC Sport on the Record.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC Plus.
A market shaping industries. We are watching the six little dragons, the first to be listing in the Hong Kong market, supply chains, and global momentum.
Do you feel pressure to create the next Labubu soon?
This really is a business-first pivot despite the geopolitical strains. The China Connection, weekdays.
The trade heads are gathering against the backdrop of the global energy crisis.
CNBC.com and the app anytime. Let's get to your headlines. Only on CNBC, connecting you with China.
Here's a question for you. What's Europe's busiest airport? It's not Amsterdam, it's not London Heathrow, it's Istanbul. This is according to figures from the Airports Council International. The airport in Turkey's largest city recorded 8.15 million passengers in July, surpassing Heathrow, which was the previous title holder. I'm delighted to say that Selahattin Bilgen, the CEO of IGA Istanbul Airport, joins us now. I suppose we begin by saying congratulations on the title, Selahattin. Good to have you with us. Just explain how you achieved this. Is it a focus on certain routes? Was it targeting certain carriers? How have you achieved this growth?
Thank you so much. Good morning. Actually, this has been a combination of many factors. Aviation, there is a strong link between aviation demand, economic growth, and connectivity. Istanbul being located in the crossroads of Asia, Europe, Africa, and Middle East has historically had the geographical advantage for the connectivity. But combining this with enough capacity in place, with the flexibility to grow further, and putting a world-class service at the highest efficient standards has made us achieve this success.
Now, as I understand it, some of the loss of traffic at Heathrow has been down to the Middle East conflict, the US conflict with Iran hitting passenger numbers. Are you concerned at all that once that hopefully comes to an end and things are peaceful again, the traffic will return to Heathrow and eclipse Istanbul Airport as Europe's busiest once more?
Actually, the situation in the Middle East has impacted all the aviation sector. We, as Istanbul, has been losing certain traffic from the routes from Middle East. You know, Istanbul had been one of the major gateways for the countries in the Middle East. So when we look at the geographical density, we have been also negatively impacted. But what has distinguished Istanbul from other airports was its ability to compensate that loss of traffic from other destinations. We've been growing very strong in many routes, including Asia, Americas, and Africa. So, in my opinion, this conflict in the Middle East, when it comes to end, of course, will have positive impact on the aviation industry as a whole. But our positioning as Istanbul Airport has been not only relying on the specific circumstances, but the having more share in the overall global aviation industry.
Selahattin, I just want to say I came back from Ankara via Istanbul. It is a fantastic airport. I thoroughly enjoyed my time there. Expensive pizza, but it's very nice. But that aside, but I just want to expand on Ben's point as well, because you know how vicious the competition is from Dubai and from Abu Dhabi. They are magnificent airports as well. And I just wonder whether your brilliant hub that Istanbul is going to come under a lot of commercial pressure. Are you going to have to change your pricing for airlines?
Let me clarify that issue. Actually, Istanbul Airport is one of the cheapest airport in terms of airport charges. So when think of the expensiveness of the airport, there can be several points like the F&B prices, duty-free prices. But when we focus on the airport charges, Istanbul Airport is one of the cheapest airports when compared to its peers. But that's not the only thing. It has been coupled with several other factors, including our success in efficiencies and passenger experience. Istanbul Airport has for quite some time leading Europe in terms of on-time performance, turnaround times, baggage delivery rates, baggage loss rates. So in many performance-related KPIs, which directly impacts the profitability of the airlines, Istanbul Airport has been the #1 in Europe for 2 years now. And this has significantly impacted our success. Putting that aside, we also have geographical advantage. Flying to many destinations has made the connectivity of the city very strong. Istanbul is currently the leader in the world in terms of air connectivity. We have destinations to more than 340 locations in 147 countries. That's why this connectivity combined with the efficiency has made several airlines start flying from Istanbul. That's why going forward, of course, putting the right capacity at the right time, but also having the flexibility to increase the capacity is important. But this has to be coupled with operational efficiencies and having the right level of service at the right cost. And having Istanbul's geographic location together with those makes Istanbul extremely efficient to be the global hub in many flights.
Yeah, we're going to have to leave it there. It is a great airport, and congratulations on becoming Europe's busiest as well. Thank you very much indeed, sir, for your time. Selahattin Bilgin, who is the CEO of IGA Istanbul Airport.
What was the pizza you had?
I don't know, but camera operator Mike made me put it on expenses rather than him.
Rightly so.
Well, you know, we do split it occasionally, but, well, we used to anyway. Now he seems to put it all on mine. ECB President Christine Lagarde, hear this interesting story. ECB President Christine Lagarde has warned that the US pullback from leading Western security is eroding Europe's growth model. Well, actually, Madame Lagarde, can't it galvanise Europe's growth model? I'm just saying. Lagarde also urged leaders not to repeat mistakes from the dot-com era when it comes to AI, saying the continent cannot afford to miss out a second time. Surely if the US retreats, then Europe can fill that gap and use that as part of its growth model. If Europe has been relying on energy from others, it can have more homegrown source of energy. If Europe has been relying on defence from the US and others, surely it can grow its industrial defence military capacity to fill that gap. It's an opportunity rather than an issue, potentially. I don't know, maybe it's both. In fact, I'm sure it is both. Let's take a look at the European equity futures. They were flat, and they are still flat. So no big direction despite all that oscillation in the bond market that we've seen in the last few hours or so. We will take a short break, and Ben will talk you through the markets when we return.
One of the world's largest private climate investment vehicles, Altera, aims to mobilize $250 billion by 2030.
What we're trying to show is that we can align those objectives and we can make money doing it.
Clean energy, emerging markets, even the AI boom. The opportunities are vast, but how do you pick the right investments?
We have people who specialize in these investments, and that's what makes Altera unique. That's our secret sauce.
Find out more on the next Managing Middle East.
1 hour of added insight every morning doesn't just add up, it compounds. 1 extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC.
I was studying molecular biology, going to grad school. I started investing a little money for my dad, and I got bitten by the bug. I was a stockbroker, and it's fun, but we all wished we could just follow the markets and talk. And my ambition was to be able to pay my bills and not have to constantly be selling. In today's world, I would urge a lot of people to get financially savvy. Squawk Box and CNBC, it is my home. It's the greatest job in the world.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show.
Please,
Squawk Box, streaming
check your euro-dollar now.
The AI boom is usually told as a Silicon Valley story, but
Please,
some of the biggest winners
check
are
your
thousands
euro-dollar
of miles
now.
away in South Korea. And their windfall is now spilling into an unexpected place, the housing market.
Before we saw this massive
Please,
rally this year,
check your
people
euro-dollar
just like
now.
to invest in the housing market because there is no alternative for savings and investment.
From January to April 2026,
Please,
home buyers used about
check your
3.7
euro-dollar
trillion
now.
won, or roughly $2.4 billion, from stocks and bond sales to fund purchases.
The government wanted to boost the stock market so that people could move
Please,
away from homes
check
into
your
the
euro-dollar
stock market,
now.
but people are coming back to the property market with the money that they earned in the stock market, and it's also sort of this vicious cycle.
The danger is not that one stock market sell-off would immediately crash home prices, is that the same wealth channel pushing stock gains into housing depends on confidence.
How extraordinary, isn't it, that the bond markets have had their wobble, and whether they continue to have that wobble or not remains to be seen. We'll ask experts about that on a daily basis. And yet the equity market really hasn't really got too involved. I mean, yes, the Nasdaq came off a little bit in the meantime, but the funding concerns that many people are talking about, the crowding out trade with AI funding affecting bond market funding, it hasn't had a two-way effect. And actually, the markets have been relatively glacial, and that's something we'll speak to Helen Jewell of BlackRock about in a few moments' time. But in the meantime, it looks like the markets are just very tempered at the moment, flat start to broader trading.
Yeah, let's break it down sector by sector. And this is the board of outperformers this Thursday morning. It's car makers and parts at the top. Not one we see often jumping to the top of the board of gainers, given the pressure that the industry in Europe faces from Chinese competitors increasingly. But it is the top performer at the moment, 0.8% higher in the first few minutes of trade. Utilities advancing 0.7% thereabouts. Construction on the front foot, and tech advancing as well this morning, just over a fifth of 1%. Those are the outperformers. It was Basic Resources yesterday, actually, that was the standout performer, advancing 3.3% by the close. Let's have a look at the board of laggards. This is where we're seeing the sharpest losses this morning. Travel and leisure stocks down 0.2%. Media giving up some ground as well. Retail off 0.4%, and insurance as well giving up some ground. Yesterday it was banks that were the biggest fallers. That basket of stocks closing the Wednesday session 1.5% down on the day. That's the breakdown sector by sector. In terms of the regional picture, it's a little more mixed. Something of a reversal of what we saw in the previous session. Yesterday, the FTSE was the only one of these four to close higher, giving up a little bit of the gains that it had made. Those gains, nothing to write home about, really. It just closed up 0.14%. Below the flat line in the first few moments this Thursday session. The CAC on just above the flat line, the Italian MIB as well above the flat line, and we still wait for a print from the Xetra DAX. And Steve will keep us going until we get that.
The US Treasury has, well, I don't know, it depends how long it is. The US Treasury has stepped in to try and stem the sell-off in Treasuries, announcing it will at least double. This sounds magnificent, doesn't it? We're going to double the size of our liquidity support buyback operations. Yeah. How much do you think that is, everyone? Unless you, if you haven't read the story, just don't cheat. How much do you think doubling of the size of that liquidity support buyback operation is? For the 10 to 30-year paper. Yeah, it's significant, but it's from 2 to 4 billion, okay? Right? So you're going to $4 billion. Not bad in a $40 trillion debt market, is it? Anyway, the announcement pushed the yield on longer-dated debt sharply lower. It's the signalling, isn't it, I think, as much as anything else, with the 30-year Treasury yield down at around 5.18% this morning. That yield is closely tied to the rate that Americans pay for things such as mortgages and car payments. So it's perhaps unsurprising the Trump administration has moved to try and push rates down as its war on Iran helped push gasoline prices to their highest level ever for August. Now, that gasoline price surge has helped hold inflation at nearly 1.5 times the Fed's target. Bond yields around the world are starting to pull back just a tad after the Treasury intervention. Well, Helen Jewell is the CIO of Fundamental Equities at BlackRock and joins us now. Hi, Helen, how are you?
I'm good. Good morning, Steve. Good morning,
Thank you.
Ben.
Well, look, I mean, luckily for you, you've missed an hour of utter cynicism from this desk as well. But enough about Ben, it was me. But seriously, I mean, I watched the slow motion ructions in the bond market. And I say slow motion because I think it's a story that we can talk about any time in the last 10, 15, 20 years. It predates Mr. Trump. But the equity markets, I think, despite a little bit of a wobble, have been very relaxed and calm about what we've been seeing in the bond market. Is that your interpretation?
It's not quite. I think the top line is pretty calm, but actually if you look at what's happening under the water, there's actually been quite a lot of movement, quite significantly moves in the momentum, the names, significant volatility under the hood. And that is actually causing, for portfolios, quite a lot of movement. And a lot of that is coming from this big basket of AI names, which we've just seen this incredible moves up until July, then that big rotation through July, and then that move through August. But then one of the contributing factors, I think the other is the continued uncertainty in Hormuz, but one of the contributing factors to some of the big moves we see in the last couple of days has been concerns on capital and concerns on bodies might get to. So you're absolutely right in terms of the top line, but I would disagree with actually what we're seeing underneath in terms of the individual sectors.
And that's great, and that feeds into this narrative that we're all looking at the wrong measure. Well, we, CNBC, the VIX is not what we should be looking at. What I should be looking at. I should be looking at the single stock volatility, perhaps, in a lot of these names as well. So there is volatility, it's just not in the broader index.
Exactly that, exactly right. The index itself, is doing really well because the earnings are actually really stable, and they're actually broadening out in terms of where we're seeing the strength in the earnings, particularly if you look at a global picture. And Europe has been some really strong results, kind of, and a really good, strong breadth. But some of the moves that you see, I mean, from the semis perspective, they were up 60% to July, down 15% in 1 month. And then August, they were 8%, and then down a bit in the last couple of days. So those kind of moves, and on some of the single stocks, particularly some of the Asian names, I mean, just incredible numbers. So they are the numbers that actually do show that the market is reacting to what you're seeing in the bond market.
BlackRock is a behemoth. It is everywhere. Does it want to be in the racier end of the market at the moment? Look, it is there, because I look at people's portfolios. I look at where the big names such as BlackRock are as well. Are you making any... internally, everyone must be thinking, is this running out of steam? Are we going too far? Is it still a great underlying thematic, but just the valuations are detached as well? Are you having those kind of conversations?
Yeah, always. I mean, we're always looking at where the market is going to. It's so important to do that. But there's a couple of things on that. I actually wouldn't say that the valuations are getting particularly racy. It's the earnings that are getting racy. There's no real valuation bubble. The valuations actually look pretty decent if those earnings come through. So it's the earnings that actually you need to believe in going forward. Now, of course, there's the conversation around it. We do think that the AI story has got a long way to go. We do think we're at the start of a multi-year investment framework. But you do need to diversify those portfolios, Steve. That is the key. And looking where those really interesting diversification opportunities are, again, Europe being one of them, the UK, healthcare as a sector, is a really interesting one, very, very low correlation with the AI trade. And also those parts of the market that I would call quasi-AI, which we've talked about before, the power names, which have got about a 0.5, 0.6 correlation with AI. They're not totally detached, but of course the power and the energy story is not just about AI. It's about air conditioning, it's about energy stability. So those are interesting names as well. So yes, we fundamentally do believe in the earnings, but building portfolios that are resilient is what's incredibly important for us.
Yeah, and perhaps I should be a lot more clear and more granular. When I talk about the detachment, you're absolutely right. I mean, the earnings from an Alphabet, for instance, phenomenal. The valuation of an Alphabet, not so phenomenal. I completely concur. But I guess when I look at Anthropic's most recent numbers, they were really good. They were really good, and yet this company hasn't come to market yet. And yet all of a sudden, I hear people talking about, was $1 trillion valuation, now trying to double it. And then I looked at SpaceX, and it's a tricky one to value, to judge that valuation. Then I look at OpenAI, what they potentially want if they ever get to market. So I guess what I need to diversify is the real world valuations from a lot of the hyperscalers compared with some of these illustrious names that haven't come to market or have just come to market.
Yeah, absolutely. And I think where we try and focus is those areas that we do see the real bottlenecks. And I think the memory names are really interesting from a bottleneck perspective, where you just see the parts of the market where you can have a certain level of confidence that you do see demand exceeding supply. So again, those power names, we're seeing that, the memory names, they are the areas that we are focusing, and actually from a portfolio perspective, we tend to be more overweight. That is where we have the larger positions in, and say those kind of parts of the market, the parts of the AI trade, where you do see the bottlenecks. Now that doesn't mean to say that there isn't a place for those racier names, your words not mine, in portfolios as well. There is, and I know part of what BlackRock do is make sure that we give clients choice about where they want their risk profile to be. But certainly the kind of core parts of our portfolio do tend to be in the picks and shovels, those areas that you do just see 2-3 year out, supply being less than demand. That is where we're focusing portfolios.
And then in terms of the diversification, where do you see that coming from if people are worried about the AI concentration? Where's the hedge?
Yeah, for me, Ben, do think about it in those two buckets. You've got the pure diversifiers and you've got the kind of quasi-diversifiers. So that quasi-diversifiers are the ones I get super excited about. As I've mentioned, the sustainable energy kind of names, because they do still have a correlation with the AI trade. You do see the move, but they don't move as much. The correlation is only about 0.5, 0.6, and in part because it's not just driven from the AI story. And then you've got the pure diversifiers, where the correlation is almost zero. As I mentioned there, healthcare I think is really interesting. I think the valuations in healthcare continue to be compelling. It is traditionally a more defensive name. The demographics look interesting, could also be AI beneficiaries. You've got the banks, you talked about the banks this morning. European banks, actually, if you look back over the last 5 years, on a total return basis, European banks have actually outperformed the Mag 7. So European banks remain interesting. And then you've got, from a regional perspective, the UK. The UK doesn't have a huge amount in terms of AI, but it does have mining. Mining continues to do really well, in part because of AI, but not just because of AI. It's got banks. And actually, from a total return perspective, again, really interesting. So pure diversification names, healthcare, UK, quasi-diversification names, you've got those names such as the kind of the sustainable energy names and the power names that are linked to AI, but not pure AI plays.
And then, because if someone were looking at their portfolio and they thought, oh, I'm invested in a world, the world equities fund. It's diversified, it's broad. I think you've actually point out in your notes that it's more concentrated than perhaps they would expect.
Yeah, exactly. So the ACWI now is kind of almost 65% in terms of AI trades, much more concentrated. The other thing about investing when you do it at a pure index level is it doesn't, because you've got this kind of large concentration, it doesn't allow you to pick out some of the smaller names that actually can be really interesting. So if you take the S&P 500, you've got some names that actually, if they were in the stock 600, would be a really big component, like a kind of $100 billion company would be enormous in Europe, but much, much smaller from an ACWI perspective or from an S&P perspective. And you're not able to kind of lean into those names that are going to grow going forward. So yes, you get the concentration, and B, you just can't tilt your portfolio to kind of take advantage of perhaps some of the future opportunities. But of course, I would say that I'm an active investor.
Yeah, of course, of course. And then, do you, forgive me if this isn't your area, do you deal with government debt at all, or are you focused purely on equities?
I'm an equity investor, but we always do need to keep an eye on what is going on in the bond market and the yields. Yeah. That is a really important part of what we're doing. Firstly, because the way you value stocks, it is the present value, and it is based on those future rates. So what you are seeing on a day like today, when you're seeing those kind of nervousness in the yields, you will see those higher growth names nudge back down. That is what I expect to see today. The growth names, the kind of higher momentum names, the yields will have an impact on those. And again, that's why a diversified portfolio is so important, because a lot of those AI names are those higher growth names, and they will be impacted if we start to see yields go up, not just because of what we're seeing from a government bond perspective, but also what we're seeing from a capital raise perspective for a large number of those corporates as well. You know, Nvidia a couple of weeks ago, or last week, time flies, we are seeing a lot of capital raising amongst those Mag 7s as well.
And actually, just a final point on that, if I may, of course, the bridge between the bond market and the equity market is the corporate bond market as well. Mm-hmm. Do you think this wave of issuance, the end of the buyback story, and it's not the end of it, that's too dramatic, the pause in the buyback story from some of these amazing companies that are going to capital heavy now from asset light previously, do you think actually that is taking away one of the big props of the market, of this huge rally we've seen over the last few years, the fact that these companies now are raising vast amounts more money in whether it be in equities or bonds, as opposed to buying back their equity?
Yeah, I mean, of course, it is something that we need to keep focused on. The key question is going to be, are the investments that these companies are making going to generate returns? So what it does is it brings in an additional question into the marketplace that didn't exist a year or two ago. I mean, it still existed, but it matters less when it's using cash flows than when it's using corporate debt. So it puts extra pressure on the need for the returns of the hyperscalers to come through. And again, that's what you've seen, is not that the AI story is going away. It still remains a key part of any portfolio, but certainly more questions that need to be answered and more certainty that needs to come forward going forward. So again, wanting to come back to it, that diversification piece, it increases the importance of that, because these are companies now that are not using their cash flow to generate this, to invest in this, they're using debt, and that's what it does.
And it's quite a sweet spot for you. You've already emphasised into one of your answers, Ben, that you're an active investor as opposed to passive. And bearing in mind, passive now is so at the whim of the largest concentration in semis, in tech, that I think we've ever seen almost. I'm pretty sure. I mean, I don't know what it was like in 1873, but I'm pretty sure it was definitely the bigger concentration than we saw in the dot-com bubble.
Certainly, yeah.
So being active, it should be a sweet spot for you.
Yeah, and it's not just about the concentration, it's also about the volatility and the risk. So the contribution of AI risk to portfolios is incredibly high. So we don't just look at the position size, and we look at the contribution to active risk. Because of that volatility, that risk contribution is very high. It is giving us real opportunities, but it does increase the need to get it right. So that's kind of a sweet spot of opportunity, but the number of shots on goal that before you score is probably a little bit lower than it was previously.
Exciting.
Helen, thank you very much.
Thanks
really good
for
to have you with us this morning. Helen Jewell, CIO for Fundamental Equities at BlackRock. So, President Trump hit out at the Fed on Wednesday, suggesting that members of the Federal Open Market Committee hike rates, quote, because they like the politics of it. The central bank hasn't actually hiked rates in more than 3 years and cut them 3 times in 2025. This as minutes from the FOMC's July meeting were released on Wednesday, with many officials saying a hike would be needed if inflation doesn't abate. But the US leader insisted rates are too high where they are.
We have interest rates that are artificial. They're actually artificially high. They raise them for no reason. And you can't go out to the market when you have a Fed that's raising interest. You can't say, oh, I want to pay 3 points less than what the Fed says you're supposed to be paying. So, no, I don't think so at all. I think we have a very powerful country, and we're powering through these ridiculous interest rates. They're ridiculous.
Well, this is America's national debt hit $40 trillion, more than doubling since Trump's first inauguration less than a decade ago, with more than a quarter of that $40 trillion coming under Trump's watch, exacerbated by his One Big Beautiful Bill Act, which the Financial Times says is set to push debt up by more than $4 trillion by 2034. The swelling debt figure now means the government spends a record $1.37 trillion a year just on servicing its debt interest. That is more than the budget for the Pentagon and is more than this year's outlay on Medicare. Earlier this month, a Reuters Ipsos poll found that Americans now see Democrats as better stewards of the economy than Republicans for the first time in around a decade.
Coming up on the show, Standard Life announces a partnership to expand its UK pensions risk transfer business. We'll speak to the company's CIO after the break.
Listen to CNBC on the move with the CNBC app.
A check on how Europe is set to open the trading day.
Real-time market updates.
A lot of strong numbers this morning.
Listen wherever in the world you are. Download the CNBC app now.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned, sponsors disappeared, fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
The Score, streaming now on CNBC.com and YouTube.
Welcome back. Novonesis has reported first half organic sales growth of 8% amid solid performance in its food and beverage and household care units. The Danish biotech firm raised its full-year sales growth forecast to between 7 and 8%. JD Sport has lowered its profit outlook for the year as it reported a slowdown in sales, with second quarter like-for-like sales falling 3.1%. The retailer blamed a highly promotional market as well as cost of living pressures for the fall.
That's fascinating, given we just had the World Cup. Right, let us move on. Standard Life has announced a partnership with CVC, Prudential Financial, Goldman Sachs, MS&AD, and others to expand its pension risk transfer business alongside access to private investment opportunities. The partnership will see a combined initial capital commitment of up to £2 billion, which is expected to be drawn over the next 5 years. Nuwan Gunatilake is the Group CEO at Standard Life. Nice to see you.
Morning.
What's new? Because Phoenix, now Standard Life, has been kind of involved in this business for a very, very long time as well. And, you've hoovered up a lot of these schemes. What's the new news today?
Look, I think the new news today is we've got £2 billion coming in of extra capital. And ultimately, if we think about the trillion or so that has to come to market over the next 10 years, it needs more capital. And so bringing in some like-minded investors, with CVC and Prudential leading the way here, with an aligned partnership around how we also get the assets to back those pension annuities, will really create something differentiated that we can offer to the market.
So you say a trillion come to market. This is people retiring and with their defined benefit schemes, is that right?
That's right. It's exactly right.
And this is creating a liability on balance sheets of institutions that do not want to carry their defined benefit liabilities anymore. Touch wood, we're all living a little bit longer, and those of us who are old enough to still have DBs as well, they're gold dust for the pension holder, but for companies they present quite a liability.
Yeah, and look, we've obviously seen this over the last decade as those schemes come to market, and as we move more through that sort of segment and sector, the schemes are getting larger now as well, and so it's requiring more capital to come and back those as they come through.
It's something that we talked with Andy about previously as well, but you'll see Andy Briggs. But I just kind of want to just drill down one more time. You said £2 billion of extra capital, and that's great, but why do you need partners in this area? It's a process that Phoenix Standard Life has been carrying out for a very long time. I'm just wondering what's changed that you want to get involved with all these other players.
Yeah, so I think if you think about what it takes to be successful across all of these things, if we think about the insurance expertise, the asset management expertise, and more providing bespoke solutions to these corporate schemes as they come through, all of these rely on different expertises, which ultimately, bringing partners into the game here will allow us to reach further into that toolkit and learn from their experiences also globally.
So what do they have that you guys have internally? You're over the road. You're our next neighbours. I've been in the queue of a sandwich shop with your CEO. What do they offer that you guys don't?
Look, I think they bring deep capital and private markets expertise ultimately. So asset management is completely part of the challenge here in securing and sourcing differentiated private assets to back these cash flows.
Great.
How does all of this help, if indeed it does, boost investment in the UK and help the growth of UK companies?
Yeah, so ultimately that capital, as it turns into pension liability, gets invested in the UK. It has choices. It can go to the US, it can go to Europe. We'd really like, obviously, quite a lot of it to stay in the UK to back things like critical infrastructure, defence, digital security, other projects which we think really do fit the profile of the cash flow that we have.
And then in terms of sort of the investments, that you're overseeing, what's your sort of bigger picture take on the state of play at the moment in terms of where pension funds are invested and where you see the direction of those going?
Yeah, so I think there's been sort of well-travelled articles around sort of coming out of equities and into fixed income, and ultimately Solvency II and matching these annuity liabilities is broadly a bond game. So if we bring it back to that, private markets has always formed part of our portfolio. We think it does add to the end result for better outcomes for customers, and so securing the best versions of those investments is really key, and hence why bringing some aligned partners along on this journey makes total sense to us.
Okay.
I was going to say about the private market side of things, it is a big area of growth for you as well. Clearly there are a certain class of investors who shouldn't have played in this area in the first place, but they were promised all kinds of interesting returns. For someone such as Standard Life, the opportunity in private markets is enormous. What about the risks?
There clearly are risks, and I think this is where the quality of the partners really matters. So, we've spent a lot of time being thoughtful about who we engage with in this space. And if we think about the quality of CVC, Prudential, Goldman Sachs, that's over 3 trillion of assets with a deep history of investing in this space. So we're very confident that we'll be able to source the right assets with the right profile for our customers.
Sorry, yeah, carry on.
I was going to say, I suppose historically, the fixed income side of things. The bond market has been maybe less exciting but stable anchor point for when you've got long-term liabilities, as pension funds do. Given the volatility that we've seen, I mean, in the last couple of days and also generally over the first half of this year, does that change your view of how solidly those fixed income sources can anchor a portfolio or not?
Yeah, I think it's one where we've always got to be mindful of the risk. Our investment strategy has remained constant throughout. So, I think bonds have, through various points, whether it was sort of GFC, QE, there's been various crises since, have always had periods of volatility. So I think it's coming back to the fundamentals of the investment strategy and our confidence in that. That today remains a bedrock of how we invest to back our annuity liabilities.
What day is the budget? Is it October? It's October, isn't it? 23rd of October. What do you want from the budget from John Healey that you're lobbying hardest for? So, apart from perhaps not an extra tax on financial institutions.
Yeah. So I think it would take a step back. What we're really looking for are policies which are progressive for the UK ultimately. As it encourages that, I think we'll see greater loosening up of investments into the system. So we want to see shovel-ready projects come to the UK where we can invest those pounds that come from the pension liabilities. So all of those points on critical infrastructure we mentioned, schools, road, housing, education, these form critical areas of interest where we would love to invest more.
Brilliant. All right, well, let's see whether they deliver as well. Nuwan, lovely to see you. Thank you very much indeed for joining us. Nuwan Gunatilake, who is the Group CIO at Standard Life.
Thank you very much.
Coming up on the show, President Trump launches, quote, economic warfare against Iran, warning countries against offering Tehran a lifeline.
From London, Paris, Munich, and Milan.
We've seen very strong demand all summer long.
End users are using our AI even more frequently.
Are you heading into a record Q4? We are gearing up for the biggest IPO of the year.
Prime Minister, it's a pleasure to be back in Athens.
It's a pleasure to talk to you.
This is becoming a very competitive market in the EV space.
Parliament continues to stay very fragmented.
This Bank of England decision certainly got more interesting over the last couple of months. Here's what investors are watching this morning.
Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving? The biggest guests, the market action.
Right here.
Squawk on the Street, CNBC.
There were definitely a few times when there was no money in the bank.
Before Careem became one of the defining startup stories of the Middle East, Mudassir Sheikha was trying to keep it alive from one funding round to the next. He'd left a safe consulting job, and he and his co-founder had each invested $50,000 of their own money into the company. In the early days, Careem wasn't an app that magically matched riders and drivers. It was the founders calling drivers themselves in the early hours of the morning.
It was radically basic. All we had was a website.
And 7 years later, Uber, the rival Careem spent years fighting, agreed to buy the company in a landmark deal for the region.
To do a deal with our biggest rival, the company that we thought was trying to kill us, was just very, very difficult for the organization.
Hello, welcome to Squawk Box Europe. I'm Ben Boulos with Steve Sedgwick, and these are your headlines. Global government bonds get some much-needed relief, courtesy of the US Treasury announcing plans to double buybacks at the longer end. President Trump, though, bemoaning the Fed for high rates amid the rising debt burden.
We have interest rates that are they're actually artificially high. I think we have a very powerful country, and we're powering through these ridiculous interest rates. They're ridiculous.
President Trump threatens economic consequences against any country that helps or does business with Iran, adding the US is preparing crushing economic warfare. ECB chief Christine Lagarde warns the US retreat from the global order is hurting Europe's growth trajectory, urging policymakers not to repeat the mistakes of the dot-com boom, now in the AI era.
US President Donald Trump has said Washington will launch, and I quote, the most crushing economic operation ever taken against any country, targeting Iran, warning of tremendous consequences for any country helping Tehran evade sanctions. Dan, interesting what the president is saying. Does it move the needle at all on anything going on in the Middle East?
Well, that's the real question, Steve. Good morning to you. As you just said, President Trump saying the US will launch what he's calling the most crushing economic operation ever taken against any country against Iran, threatening penalties on any nation that helps Tehran evade sanctions. On Truth Social, he called it economic warfare and isolation on an unprecedented scale. Now, we don't yet have the full Treasury details, but Trump says the targets include things like oil smuggling, currency swaps, and cash transfers, basically the channels that Iran uses to move money and stay connected to the global financial system. Of course, the UAE is a key part of that story, having been a primary economic lifeline for many years and the top source of Iranian imports, in fact. China, Turkey and the EU itself are also major partners trading with Iran, potentially putting the bloc and those nations in the president's crosshairs. The UAE has already moved to cut all trade and financial ties with the Iranians earlier this week after the suspected attempted attack on this country from the Iranians using missiles. Iran's foreign minister weighing in, Abbas Araghchi, firing back on X, calling Trump's economic D-Day a diversion from America's own debt problems. So the big question is whether more sanctions can actually break Iran's economy or move the needle on this conflict. I put that to the former Iranian central bank advisor Mehrdad Sepvand, live from Tehran this morning. If we have it, I wanted to play part of our conversation.
Over time, the economy has developed its own way of adapting to sanctions and operating under pressure. This doesn't mean that sanctions are not damaging. They clearly are, but it does mean that we should be a little bit cautious about the view that the Iranian economy is simply on the verge of collapse.
That's the view from inside Tehran right now. And it was an interesting conversation. The key takeaway there was while the United States has been pushing significant economic pressure on Iran, his view is that it doesn't necessarily change the needle domestically, economically, or politically for the regime. Now, of course, that's just one view from inside Tehran. There are others, but the real question is whether or not this additional pressure that we're seeing from the White House will do anything to change the status quo. Meanwhile, another interesting story emerging here. The US military has quietly established a shipping corridor through the Strait of Hormuz. This is via Axios, which is citing 2 US officials saying 15 to 20 tankers are moving through a southern channel along the Omani coast each night with US military guidance and air cover. The operation now moving close to 10 million barrels of oil a day, or about half of pre-war levels, and US officials say it was made possible after CENTCOM degraded Iran's radar and maritime surveillance. So that via Axios this morning. Read that with a grain of salt. There are other independent analysts out there saying that flows through Hormuz are much lower than what US officials are saying, but of course the proof is really in the pudding here and looking at which numbers you ultimately decide to believe. It's back over to you. Back over to you.
Indeed, we'll let people make their own decisions. Thank you very much indeed for that, Mr. Murphy. OK, let's take a look at European equity markets and where they're currently trading. We are on a negative bias in the UK and Germany, mildly positive over in Italy on the FTSE MIB. The sectors which are gaining this morning look like this. So we have autos and auto parts, utilities, healthcare and construction all moving to the upside, especially autos and auto parts, and to the downside. The stocks under pressure include basic resources, which are pretty much the highest beta sector at the moment, perhaps even more so than technology, certainly on the bigger, broader global issues, and telecom stocks down 0.7%. US futures look like this. Pretty flat at the start of trading.
Shares in Unitree have fallen after they'd surged 542% on its debut in Shanghai. The world's largest humanoid robot maker by sales was the latest name to hit Shanghai's star market, following on from memory chip maker CXMT's blockbuster debut last month. German industrial company Schaeffler is pivoting to humanoids, looking to use its expertise in the autos market towards manufacturing components that can be used for humanoid robots, with the firm becoming a key supplier to robot makers. Klaus Rosenfeld is the CEO of Schaeffler and joins us now. Tell us a little bit more about this pivot then, Klaus.
Well, good morning. Happy to share a little bit about our humanoid strategy. Humanoids are, as you all know, and the Unitree IPO is another showcase for this, is a trend that, from my point of view, is going to become much more important and much faster than what we expected so far. And we at Schaeffler, we have decided some years ago to look at that ecosystem, because that ecosystem has a significant business potential for us. Why is that? Because in a humanoid, whatever type of humanoid you're talking about, it's all about joints. It's about the components that you need, the little systems that you need, integrated actuators. And they make, also compared to a car, 50% of the bill of materials, and that part is relevant for us. So in humanoids, per humanoid, we as Schaeffler, with the products we have a significant addressable market that we're trying to reach. We discovered that potential quite early, so we are an early player in the ecosystem. Today we're working with 45 different companies. We have gained significant customer attraction. We have the first 5 important customer contracts. We're building an order book, and it's all about, at the end of the day, our precision technology for these humanoids. But that's only one part of the coin. The other part is that the humanoid success is not just the showcase where a humanoid can run a half marathon or where can dance, but it's the application of the humanoid in manufacturing. That is very important to us, and our strategy, our way into this market has always been twofold. On the one hand, the component, the system that we can deliver. On the other side, how can we apply humanoids in reality, in scale? Not just one use case, but in production. And we have started in a plant in the US, in Chiron, already in January 2025, applying a humanoid from a partner company into our own operations. And that sort of dual approach is, from our point of view, very important, because the success of humanoids is a function of how can you apply them, and we think there is ample opportunity to apply them in large-scale manufacturing. I stop here, but maybe that's a little bit the logic behind.
No, it's really interesting, Klaus, but the thing that strikes me when you talk about the integration of humanoid robots into the production of parts for humanoid robots, sounds to me like there could come a point where there'll be very few jobs, if any, left for actual humans within the manufacturing sector. Do you foresee a time where that is the case? And if so, how soon could it come?
Well, let me say I'm a realist. I'm not a visionary. There are people that say we will have dark factories where no human beings work anymore. I can only say what I expect for the next years is that the humanoid robot will complement the human workforce. Yes, there will be jobs that fall away. The jobs will change. The jobs will become different. You know, where are the use cases for humanoids? They are where work is dangerous, where work is boring, very repetitive, or where your work is sort of very tiring in terms of you're moving heavy parts from A to B. So I see for the next years not a complete replacement of human beings in factories. I think the opposite will be true in a sense that we need to learn to bring people together with humanoids. There's a little bit similarity to the agent in AI. In future, you will have people working with agents in teams, and that's the same on shop floors. You will have human beings working together with humanoids. And therefore, the experience we make month by month, quarter by quarter, with seeing how that works is positive. We see that most of our workforce is responding to this in a constructive way. They see it as an opportunity. And we certainly also need to understand the limits of this. We need to understand the safety components. This is all something that needs a little bit of time. It needs experience.
Sure.
You will see failure there. You will see things that don't work. And that's important to understand how can we optimize this over time. I don't believe that there is someone who can switch and say, now all of a sudden the factory is completely free of human beings. That's not going to happen, at least not in the near term. If that could happen, maybe that's something for the next 10 to 20 years. But for the time being, it's very important to understand the basis.
Sure. I just wonder if you think Europe's robotics sector can, in the medium and long term, effectively compete with what's coming out of China. I mean, Unitree seems to have so much momentum behind it, and the technology that they are showcasing just seems to be far and away, you know, leading the pack. Can Europe really compete?
Well, I'm positive on Europe, in particular in humanoids. And why is that? Because in humanoid we have three things that we can build on. The one is we have the manufacturing base. We have a manufacturing base that, in particular, when it comes to industrialization, when it comes to vertical integration, that is, you know, there to be further optimized. And the humanoid use case is exactly what is needed there. Second, very important, we have the data. Humanoids is not just high precision moving parts, sophistication and automation. It is very much about using data intelligently to train these devices. That's what we have. We have this huge database from the past, from this manufacturing base. That is a very important point in this debate. And third, we have the talent. We have the experience. We have the expertise. And we need to bring this together. We should not always look to China and to the US and say, oh, they are faster than we are and they have the better technology. That's not the case. We should team up. We need the right fighting spirit and the right mindset here. This is not a given, but the prerequisites, and we can see it in our company, the prerequisites are there. And it's now up to us to move together, see that we get the use cases right, and see this as a long-term play where we can also compete with those that have maybe more support from their countries or more support in terms of subsidies. I think we should team up here and see that we use the strengths that we have and further build the strengths, and then we can also compete. But when you always start something like this and say, oh, the others are better, that's not the right mindset. The mindset must be, let's work on our strengths and build that strength so that we can compete. Competing also means learning from others. And we as a company, we have deliberately said, this is not a European strategy. This is a strategy that is built on three main global regions. The one is China, the one is US, and the one is Europe. We have different companies for these markets, but we are certainly able to see what's going on in China, see what's going on in the US, and make sure that we understand best where others play, how they play, and what we can learn from this.
Klaus.
But I'm optimistic on Europe.
Good, so am I. I'm not sure if it's blind optimism, but I'm optimistic as well, Klaus. Just a quick one from me. You are in a privileged position to observe the trends on both sides of the Pacific. I know Europe's behind at the moment. Maybe we can close the gap. But when I look at the valuations of Tesla, for instance, and its Optimus offering, and then I look at the extraordinary Honor or Unitree or whoever the company are that are producing these amazing robots, I can't help see something quite marked, i.e. the Chinese look like literally they're racing away with this as well. But what do you think?
Well, yes, I mean, this Unitree is really impressive, and it shows if that valuation is a fair valuation, how much expectation is behind this. Because if you get an IPO that then becomes 6 times on the day of the first trading, that shows that there's obviously enormous demand for players like this. How that normalizes over the next weeks and months, I can't predict. But don't forget, we are in the beginning of a market that is building. I expect there will be more IPOs, and valuation is something that builds over time. And for sure, markets are very different in how they price this kind of expectation. For me, it's important that we do not decouple too much from what's actually happening on the ground. And what's happening on the ground is we have still a pretty limited number of humanoids in play, in factories. And the next years will show who is able to really play the scale game, who is able to industrialize. And again, coming back to us, that's where we want to play. We are interested not in 1,000 humanoids, we are interested in 1 million robots and more. And if you then think about the market that comes up there, that's interesting. But that scaling and how that works, whether we are in a hype cycle or whether this is more a linear curve, that is one of the big question marks that we have.
Okay. Klaus, thank you very much. Feels like a real glimpse into the future there. Klaus Rosenfeld, CEO of Schaeffler. Shares in Moderna surged 177% after an experimental skin cancer vaccine developed with Merck produced positive initial results in its first late-stage trial. Data showed the mRNA injection, along with Merck's immunotherapy treatment, met all key goals in phase 3 trials in more than 1,100 patients. Speaking to CNBC, Moderna's CEO, Stéphane Bancel, explained the nature of the treatment.
It's individualized, which is you will get a different drug. If you're diagnosed with melanoma today, and I'm diagnosed by the same doc, you and I will get a different chemical. But we're going to take a biopsy. We're going to sequence all the letters of the DNA of your cancer cell. We're going to do the same for your healthy cell of your body, most blood work. We're going to compare electronically where the mutations are. And we designed and we aim to improve an algorithm to pick 34 mutations that we believe are the most important in your tumor.
Very European, isn't it, to see something change in the world, to say, oh, it's going to affect us all, rather than looking at the positive side of things. I don't know, look at this story. ECB President Christine Lagarde, she's warned that the US pullback from leading Western security is eroding Europe's growth model. Can't it galvanise Europe's growth model in some ways? Anyway, Lagarde also urged leaders not to repeat mistakes from the dot-com era when it comes to AI, saying the continent cannot afford to miss out a second time. I mean, both those comments, and there's Aaron Annetta, who speaks to Lagarde on a regular basis. If the US pulls back from Western Europe defence, which it kind of is doing to a certain degree, maybe not fully, maybe not pulling out NATO, but it's quite rightly saying the burden should shift to European partners. Why is that denting Europe's growth model rather than potentially boosting growth model? Surely you can build up the military-industrial base in Europe as a growth opportunity as the US pulls back somewhat. And then on the second point as well, let me go back on my prompt on this one as well, because I just read what it said. It said that Europe cannot afford to repeat the mistakes from the dot-com era when it comes to AI, saying the continent cannot afford to miss a second time. But there were two parts to the dot-com era, wasn't there? There was the dot-com era and the dot-com bubble bursting. So, yes, we can't afford to miss out, but let's face it, we have one or two illustrious companies, the Mistrals of this world, but we are behind. We're way behind on those big US tech companies. We're way behind on the hyperscalers. We're way behind on AI development, aren't we, already? We have to admit that. So when you say Europe can't afford to miss out a second time, I think, to be fair, it's already happening. I don't know, maybe we can't afford it, but it's happening, it's a fact. Anyway, coming up on the show, Mr. Trump calls on Congress to pass the Clarity Act in a boost for cryptocurrencies. They all surged. Bitcoin is up several $1,000s. We'll have more on this after the break.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show. Squawk Box, streaming on CNBC Plus.
Never miss a moment.
We think there is a huge opportunity for AI in the UK and Europe because it is that middle ground between the United States and China.
Andy Burnham has committed himself to the Labour manifesto, so I don't think that that's going to change. I think
taking you at your word, sir. What happens next?
We're never going to see Iran have a nuclear weapon.
You know, for me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. You want to learn more about it. And I think CNBC allows our viewers to fulfill their passions. There's no doubt that the people who watch us care. I am very much focused on trying to land interviews where there is something at stake and asking them fair but tough questions in which their answers are important. I could not imagine covering anything else.
Fast Money is America's post-game show.
Basically, near all-time highs against the S&P.
Every single story that we pick is a tie back to the markets.
Those sort of revenue streams don't trade at a great multiple.
We want to arm people with the information to make great decisions.
Stock got whacked. I get it. People say they overpaid. I get that.
Fast Money is all about the chemistry. We've been successful for this long because we're a team.
Fast Money, CNBC, streaming on CNBC Plus.
OpenAI CFO, it's a lot of letters, forgive me. OpenAI CFO Sarah Fryer has told company employees the AI startup will be a public company by 2027 or sooner, according to sources. Kate Rooney spoke to two sources familiar with Fryer's comments and filed this report.
CFO of OpenAI, Sarah Fryer, telling employees that OpenAI will, quote, be a public company in 2027 or sooner. This is according to two sources who were in that room, attended the meeting earlier. Fryer, from what I'm hearing, did mention Anthropic, its rival in AI, said that there is a chance Anthropic does go public, maybe in September. She told employees, from what I'm hearing, that's okay. We are running our own race. She said the IPO is not a finish line. It's a milestone, called it another fundraise, and then pointed out that they raised $122 billion back in March, said that gives us flexibility. We will be a public company in 2027. She said we may go sooner if our business continues to, quote, inflect. But either way, we will do it on our own timeline. She also shared some new quarter-to-date revenue numbers. So revenue run rate up about 35%, pointed out enterprise revenue up 50% in the quarter. Codex, which is the enterprise side of the business, the coding side, 20 million users, up 3.5x, according to sources. This does coincide with OpenAI's latest model launching this summer and some of the momentum, and it does, Mel, as you mentioned, come as the Journal reported earlier on some of the second quarter numbers from earlier this year, noting widening losses at the AI giant and then slower revenue growth, at least compared to Anthropic.
But again, longer you delay the IPO, the more competitive the environment is going to be, right? I think we all agree. I spoke to a CFO a couple of weeks ago, and he was talking about the amount of agents he uses, the number of bots he uses, the number of AI models he uses. It was 58. I was amazed. I genuinely assumed it was going to be like 3 or 4. They were going to be using your Anthropics, your OpenAIs, and maybe 1 or 2 others. 58. And if the price is going down really, really aggressive, it's a point I was raising with Ben earlier this week. You always get a commoditization of product. The more you produce them, the more diffuse they become, you get commoditization. And if the prices are going down aggressively, and even on OpenAI's models, what was the story we had? It was GPT 5.6 Luna, which is its fastest and most affordable model. They were cutting the price by 80%. Not 5%, not 10%, 80%. And then you get a load of these Kimi K3 stories where the Chinese are producing nearly as good or as good product at a fraction of the compute cost. I just think the longer they delay on the IPO, the more competitive it's going to be and the more their margins are going to have been hit in the meantime. And they're going to rely on producing better and better models than the opposition. And that's not a given going forward. And the other point is they're sucking up cash aggressively in that period.
No, I remember the conversation we had about commoditized
Good, because it was only 2 days ago.
I know.
Mind you, I can't remember what I did an hour ago, so well done you.
But I was also thinking about, your point that once the product becomes commoditized, it's very hard to put the price back up.
Yeah, unless you improve the product.
Yeah, but I think I might have thought of an exception to that.
Yeah, go
on. Ride-hailing, car journeys.
Yeah.
You don't care which car, which model, generally speaking, which company is providing it, as long as they get you from A to B.
Right.
Are they not doing what Uber did with the ride-hailing market? They go in, they cut the price, they slash the price right down, and once they've squeezed out the competitors and they've made the market theirs, those same rides, not faster, not better cars, they can bring the price back up.
You're right.
No, you're saying you're right, but with the tone that's going to say, I'm going to totally pull the rug out from underneath your feet.
I'm going to try, of course.
Please do.
It's the nature of the beast.
I thought about it after we had the chat.
So can I tell you why I think that view is challenged? And I've only got 10 seconds, apparently, according to the director.
10 seconds, go on.
Monopoly. You're talking about ride-hailing, squeezing out the opposition and creating a monopolistic situation. Show me which one of these developers of a model of AI is going to create a monopolistic situation, and I'll show you pricing power.
Hang on, I know I've run out of time to
You have,
retort.
it's done. Coming up on the show, global government bonds get some much-needed relief. We'll do it later. Courtesy of the US Treasury announcing plans to double buybacks at the longer end.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC+.
The AI boom is reshuffling the global equity market rankings, with Taiwan and South Korea leapfrogging past long-established markets. Taiwan has climbed past Canada and India to become the world's 5th largest equity market, while South Korea has moved into 6th place.
All this happened within the span of just a few months, because last December, they were in the 9th and 11th places respectively. Now, such a shift is not unprecedented, but what is unusual is the speed at which these two have been climbing.
But this reordering isn't necessarily being driven by broad economic growth. Instead, it's about 3 companies at the heart of the AI hardware supply chain.
It's the AI theme which is driving things, so we have this a kind of perfect positive storm of industry fundamentals which are resulting in very, very rapid profit growth.
So what does this reshuffle tell us about how AI is changing global stock markets? And what are the risks?
For this edition of the CNBC Conversation, I'm joined here in Milan, Italy by the Prada Group CEO, Andrea Guerra.
There is fashion waves, there is political waves, but then there is reality. The reality says that younger generation are looking at you, not just to what you say, but how do you behave. The way you are behaving in the society, you are behaving with your own people and suppliers and stakeholders, and how you are behaving towards the planet are the 3 things that are part of our inner mission. So we are here to allow everything inside our group to be connected smoothly and positively towards planet, society, and our own people.
Prada Group CEO Andrea Guerra sits down for the CNBC Conversation.
A very warm welcome to Squawk Box Europe with Ben Boulos and myself, Steve Sedgwick, and these are your headlines. Global government bonds getting some much-needed relief, courtesy of the US Treasury announcing plans to double buybacks at the longer end. President Trump bemoaning the Fed for higher rates amid the rising debt burden.
We have interest rates that are they're actually artificially high. I think we have a very powerful country, and we're powering through these ridiculous interest rates. They're ridiculous.
President Trump threatens economic consequences against any country that helps or does business with Iran, adding the US is preparing crushing economic warfare. ECB Chief Christine Lagarde warns the US retreat from the global order is hurting Europe's growth trajectory, urging policymakers not to repeat the mistakes of the dot-com boom now in the era of AI.
All right, let's do the read, then we'll have a chat. The US Treasury has stepped in to try and stem the sell-off in Treasuries, announcing it will at least double, remember that, I'll come back to that, the size of the liquidity support buyback operations for its bonds dated 10 to 30 years. The announcement pushed the yield on the longer-dated debt sharply lower, with the 30-year Treasury yield down at around 5.18% this morning. That yield is closely tied to the rate Americans pay for things such as mortgages and car payments. So it's perhaps unsurprising the Trump administration has moved to try and push rates down, as its war in Iran has helped push gasoline prices to their highest level ever for August. The gasoline price surge has helped hold inflation at nearly 1.5 times the Fed target. Now, President Trump hit out at the central bank on Wednesday, suggesting members of the Federal Open Market Committee hike rates because of the politics, because they like the politics of it. That's why they're hiking rates, according to the president. The Fed hasn't actually hiked rates in more than 3 years and cut them 3 times in 2025. This is minutes from the FOMC's July meeting were released on Wednesday, with many officials saying a hike will be needed if inflation doesn't abate. But listen in to the president now. All right, there's a couple of things I want to get off my chest. Again, I did it a couple of hours ago, but there's a new audience now at 9 o'clock. But the US leader insisted rates are too high where they are.
We have interest rates that are they're actually artificially high. They raise them for no reason. And you can't go out to the market when you have a Fed that's raising interest. You can't say, oh, I want to pay 3 points less than what the Fed says you're supposed to be paying. So, no, I don't think so at all. I think we have a very powerful country, and we're powering through these ridiculous interest rates. They're ridiculous.
Let me ask a question to you, the audience, to the administration, to anyone watching. What do you think would happen at this moment if the Federal Reserve were to cut interest rates? Now, the president's saying they're ridiculous. They're politically motivated. They're way too high. What do you, the audience, or you, the experts out there, that's who you guys are, not me, what do you think would happen to the bond markets if interest rates were cut as aggressively as the president seems to be saying? You know, not 25, 50, 100, 150 basis points. If they were cut aggressively to unartificial levels, what would happen to the bond market? Do you think, A, the cost of money that the US has to pay in the bond markets, and I'll come to that later, would go down, the yields would go down, or would people be absolutely terrified that the Fed hasn't got a grip on the fundamentals of the economy, hasn't got a grip on inflation, which we mentioned is got a 3 handle and it should have a low 2 handle to be on target as well? Would interest rates that America, that you, that mortgage holders, that they pay, would they go up or down? Would people begin to worry that the Fed hasn't got control over the situation? I'm just asking that for a friend. So the other point is, bond yields have gone down this morning around the world because everyone's getting a little bit excited that Besen and the Treasury has come in and doubled the amount of support for that long end of the curve on some of the more illiquid stuff. Let me just talk to you guys about numbers, because I think you guys understand numbers way better than I ever will. You're in the market. The increase, the doubling, it was a big headline. Should I do my headline again? My headline, double. The Treasury steps in and doubles the buyback at the longer end. What do you think the numbers look like? They've doubled it from $2 billion to $4 billion, right? Okay, so if we're talking numbers, how about this number? Show this number, Rod. This is $40 trillion. This is the level that the national debt has got to. Now, on its own, it means absolutely nothing. But if I say to you that that level represents the biggest amount of debt America's ever had. In fact, in terms of the debt to GDP, we have to go back to pretty much war times, Second World War and elsewhere, to find the kind of levels of debt we've got now. Now, look, this is not a Republican problem. This is not about politics. It happened under Obama, it happened under Biden, it happened under Bush, it's happened under a lot of presidents. This isn't just about the Trump administration, but the speed with which the last $3 trillion has got there is pretty much at warp speed kind of levels as well. So let's go back to Bezen, calming the market with these $2 to $4 billion of extra support for the long end. Let's put that in context. One, $40 trillion of debt. Two, the spend through this fiscal year so far of US government spending is at $6.3 trillion. But it's only collected $4.9 trillion in revenue. So then we've got a deficit straight away, somewhere in the region of 6%. You know that figure. It's $1.8 trillion. So the deficit is another $1.8 trillion on top of what we already had as well. The interest bill is more than you spend on defense. It is more, it's $1 to $1.5 trillion, whatever you use as a measure, but it's going up quickly. In 10 years, it's going to be a two-handle. What country can afford those kind of debt levels as well? So the deficit is remaining at 6%. And we were told that if you have the big, beautiful bill, if you have the growth, and as the president quite rightly said, you've got very strong growth in the United States, then that would close the deficit. And don't even get me on about Doge. What happened to that? What happened about the government efficiency, cutting costs aggressively so that the deficit is halved in this presidency from 6% to 3%? If you've got the answer to any of those questions, my name is Steve Sedgwick, and it is steve.sedgwick@cnbc.com. Honestly, if I'm missing the point here, please tell me. All right, I'll talk about that $40 trillion figure. America's national debt has hit $40 trillion, more than doubling since Trump's first inauguration less than a decade ago. But it's on Biden's watch as well. Let's be apolitical. With more than a quarter of that $40 trillion coming under the president's watch, exacerbated by the One Big Beautiful Bill Act, which the Financial Times says is set to push debt up by more than $4 trillion by 2034. That $4 billion of support for the long end doesn't look so much compared to $44 trillion, does it? The swelling debt figure now means the government spends a record $1.37 trillion a year. $1.37 trillion a year just on servicing interest. That's more than the budget for the Pentagon. It's more than the year's outlay on Medicare. Now, earlier this month, a Reuters Ipsos poll found that Americans now see Democrats as better stewards of the economy than Republicans. That's for the first time in around a decade. But as I say, I will add that under Obama's watch and under Biden's watch as well, the debt load increased. Bond yields around the world are starting to pull back after the Treasury's intervention. Right, let's get to Ben Emmons, who is a Chief Investment Officer and founder of FedWatch Advisors. Ben, stop me being so doom and gloomy. Give me something to hold on to here. What have I missed?
Well, you summed up a lot, Steve. Good morning. This incredible surge in debt that we're experiencing. On the one hand, there's a benefit there. We are growing the economy. We're roughly running now, I think, real time, close to 6% real GDP on the Atlanta Fed measure. But the debt is growing so fast, it's actually clipping about double that growth rate. So I think it's really challenging to control it from here. Why this announcement of the debt buyback is just a band-aid, right? We're ultimately going to be facing higher interest rates. One, as the economy strengthens, the yields go higher, and this debt buyback is not really doing anything different. The debt doesn't change. Actually, it only continues to grow. It's just replacing old debt with new debt. So the deficit stays wider than what it otherwise would have been. So I think it's going to be very challenging, Steve, to keep rates in check. They are not artificially high. That's just following what the economy is doing and what the debt is doing.
Ben, I can't help but feel that we had an example, not even in the last months or years, but within the last few days and weeks, really, of how futile intervention in a macro situation can be and how short-lived it can potentially be unless fundamentals that have caused the situation in the first place are properly addressed. And what I've got in mind is what we saw with the intervention with the yen, to prop up the yen. Yes, it had the effect in the short term, it strengthened, but it has been giving up those gains fairly rapidly. Will we potentially see the same thing with this intervention from the Treasury because there is an absence of a clear plan to deal with the fundamental concerns that pushed the yields higher in the first place?
Yeah, I would agree with that, Ben, because, unless you are truly curbing the debt growth, and that means actually very painful decisions have to be made in Congress to cut spending and raise taxes at the same time. Only then you'll get lower interest rates, significantly lower interest rates, because what it means is that once this debt gets cut down, as in spending gets cut, the economy will slow down significantly. An example of that is 2011 debt ceiling crisis that put in motion this sequestration. It was like a mandatory spending cut, particularly on defense, but other items. And in 2012, the economy was basically growing at zero. While the 10-year yield that year touched 1.3%. So that was because of the economy going down, slowing down so much because you stopped spending. Yeah, we can't really do that in this country. We can't really curb it back, because back then they let the sequestration roll off and the economy came back, but we continue to spend. And I think until we make that really difficult decision to change the debt growth, change the spending, the fundamentals are just suggesting like you're going to go higher with interest rates, not lower. So this debt buyback is just a short-term measure to try to control the surge in interest rates, but you cannot stop the trajectory of going it higher.
Ben, I wonder if you can explain something for me, and forgive me if this is a silly question, but I haven't found the answer anywhere in anything I've read around this intervention. The US government has to borrow money because of the shortfall between what's coming in and what it's spending. They announce a doubling of the buyback of these long-dated bonds. But how are they funding that, if not with more borrowing?
That they are funding it with more borrowing, I'm afraid. What actually technically happens, Ben, is that so in this quarter, this upcoming quarter, we're going to borrow about 165 billion with low maturity securities. And then we're doing this debt buyback of about 65 billion in total, right? This is 4 billion for every I think every couple of weeks they do that. It's about 65 billion. That's not that we're borrowing a net amount, say, of 100 billion. We're just borrowing 168 billion of new bonds by replacing the old bonds. So nothing actually changes. And if anything, we're going to issue maturity bonds that are a little longer than the outstanding bonds. So there's also a bit of a duration effect on the market too. So I think that markets were yesterday overreacting to this news, perhaps misinterpreting it and thinking like this may look like QE or this may be yield curve control. That's not correct. It's just replacing existing debt with new debt, only adding more to the debt and not really changing that trajectory. As we talked, if you cut spending and raise taxes and bring that debt level really down, only then interest rates will go lower. So we're just stuck here with this situation.
Ben, it took 97 days for the president to start criticising the Federal Reserve under Kevin Warsh after his confirmation he got the job as well. What can the Federal Reserve do at this moment? It can't do much on interest rates, I guess. It's in pretty much wait and see mode. But what can it do in terms of what's happening to the longer end of the yield curve? Dare I say it, a Fed chair who promised a smaller balance sheet for the Federal Reserve is going to find it difficult to make it smaller and may find the pressure to make it larger.
Yeah, that's right, Steve. The pressure's there to increase the balance sheet again. That will be the way to have real impact on the long end of the curve. If they were to come out and do something like they did in 2011, this Operation Twist as an example, or just outright purchases. Well, if you actually do that in the current environment with inflationary pressures building and this conflict being so fluid that it could actually lead to another big oil price spike. Now, if you were to increase the balance sheet by buying bonds, you're going to actually push up interest rates, not lower them. Same thing if you were to cut rates now. To your earlier point in the segment, if you cut rates now down, say to 1%, while the low end of the curve will be over 6%. Right? It's the mechanics of that. So the Fed cannot do anything but sit still here and basically have a very, very hawkish message to try to control inflation expectations. But that's about it. They can't do anything else. If anything, the minutes from yesterday indicating that people are making a case they should hike rates right now, that insurance premium of this hike rates right now to try to control inflation expectations, that's actually what they can do to try to contain the long end of the curve by showing to the bond market like we are committed to bring inflation down by being so hawkish. So probably that's the only thing they can do, Steve, at this moment.
Ben, I just want to pick up on your previous answer, and I don't want to sound like a harbinger of doom, but when you were saying about they're funding those repurchases of bonds on the longer end through the shorter dated maturing bonds, does that not leave them very vulnerable to short-term shifts in interest rates? Effectively, it's like, to use a crude analogy, using your credit card to pay a bit of your mortgage off. And added to that, when we've had the FOMC minutes revealing a split on the committee, that many of the officials think rates may need to go up, the short-term interest rates may need to go up if inflation doesn't come down. Is this not just storing up, not even long-term problems, but short-term, medium-term problems, if that's the strategy of the Treasury?
I think that's right, Ben, because if you, again, analyze this, like, so you're not actually taking debt out of the market, right? You're just replacing old debt with new debt. And that is that credit card analogy of, like, I have a credit card debt and I'm actually taking out a personal loan to pay off that credit card debt, but I'm actually ending up with more, higher interest paying debt ultimately. And I think that is what this action ultimately will lead to, that the bonds you issue in the coming quarter will be, having higher interest rate, not lower, right? So it should only add to that. And as you do that, it pressures the interest rates across the yield curve, really, because it will be reflected also in 2-year notes, because those two will be, subject to this pressure from the long end. And then you have this issue hanging over the market that the Fed is willing to take, the next step in tightening policy, because it just doesn't see conclusive evidence that inflation is coming down more consistently, and that will only add more pressure to the curve, to interest rates. So I think you end up here with more debt paying a higher interest rate, and that sort of cycle cannot be broken unless you're making really dramatic changes on the fiscal side, which there's no appetite for that in Congress.
Okay, Ben, it's absolutely fascinating. It's really good to get your thoughts this morning. And I have to say, even when you're not on the show, we do read the notes that you send out. They're always great, with plenty of insight there. Ben Eamons, Chief Investment Officer and Founder at FedWatch Advisors. Still to come on the show, President Trump launches economic warfare against Iran, warning countries against offering Tehran a lifeline.
Interactive Brokers pays up to 3.14% on instantly available US dollars in your brokerage account. How much interest can your bank or broker pay? Interactive Brokers' conservative and prudent risk management uniquely positions us to pay up to 3.14% on uninvested, instantly available US dollars in your brokerage account. The best informed investors choose Interactive Brokers.
Squawk Box, streaming on CNBC Plus.
Listen to CNBC on the move with the CNBC app. A lot of strong numbers this morning. Breaking news.
We got a big IPO, something for the private markets. Could it be a rate cut scenario?
Real-time market updates.
A check now on how Europe is set to open the trading day ahead.
Your favorite programs live 24 hours a day.
Welcome to Squawk Box Europe.
Welcome to the China Connection, Squawk Box Asia.
Listen wherever in the world you are. Download the CNBC app now.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned, sponsors disappeared, fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
The Score, streaming now on CNBC.com and YouTube.
right, let's take a look at the European equity markets. We are varying from the flat line, with the DAX down in Germany, down 0.4%. The FTSE MIB over in Italy up by 0.2%. Sectors that are moving to the upside look like this. Autos and auto parts putting on 0.7%. Construction, utilities and real estate in the green. The losers, let's have a look at the losers. Basic resources down 0.8%. Telecoms down 0.8%. Travel and leisure and insurers also under a bit of pressure. Let's have a look at the futures for the US equity market. As we stand, that is a flat start to trading.
US President Donald Trump has said Washington will launch, quote, the most crushing economic operation ever taken against any country. He's targeting Iran, warning of tremendous consequences for any country helping Tehran evade sanctions. Dan joins us with more now. It feels like, not to dismiss it, but it feels like we have this rhetoric of the biggest, the worst, the most extreme ever seen. How does this latest threat go down with the region?
Well, Ben, 2 points. First of all, I think the primary question now is just how effective are these measures going to be? And the second point to make is that this is ultimately confirmation that the White House is now shifting its strategy to focus more on using its tools of economic leverage to bring about change inside Iran and its own negotiating position, as opposed to going back to military action. As you've just explained, President Trump turning up the economic pressure on Iran and also warning that countries helping Tehran could pay a price too. President Trump saying the US is going to launch what he calls the most crushing economic operation ever taken against any country, promising economic warfare and isolation on an unprecedented scale. Now, we still don't have the full details on that or the Treasury playbook here, but Trump says the focus will include oil smuggling, currency swaps, cash transfers, and other channels that Iran uses to move money around the global financial system. That also puts some of Iran's major trading partners in focus. The UAE was its biggest goods trading partner in 2025, about $14.5 billion in bilateral trade after converting the IMF data into US dollars. China and Turkey were next, and together the three account for more than 60% of Iran's goods trade in total. Now, the UAE has already suspended trade and financial dealings with Tehran after 2 ballistic missiles fired from Iran fell into waters off the Emirates. Of course, Iran denies it was responsible. And now Iran's Foreign Minister Abbas Araghchi is also firing back at President Trump, calling the so-called economic D-Day that the president announced a diversion from America's own debt and interest cost problems, and also warning that more sanctions will not force Iran to submit. And I think that's an interesting point here. The question being, can this new pressure really push Iran's economy towards a breaking point? Well, I asked Mehrdad Sepevand, he's a former advisor to Iran's central bank, live from Tehran this morning. Here's how he responded.
Over time, the economy has developed its own way of adapting to sanctions and operating under pressure. This doesn't mean that sanctions are not damaging. They clearly are, but it does mean that we should be a little bit cautious about the view that the Iranian economy is simply on the verge of collapse.
So that's just one view inside the country. Remember, there are others who will disagree with that. And of course, when you look at the impact here in totality, the people who hurt the most as a result of these new economic measures are average, everyday Iranians inside the country, perhaps less so the regime itself. Meanwhile, a significant development in the Strait of Hormuz. Axios also reporting today the US military has been quietly running a shipping corridor through a southern channel along the Omani coast for several weeks now. US officials saying around 10 to 20 tankers are moving in and out each night with American military guidance and air cover, including some empty tankers that are heading into the Gulf to load back up. Now, CNBC has not been able to independently verify verify those barrel movements, but if it's true, it would really signal that while Trump turns up the economic pressure on Tehran, the US is also now trying to limit the economic damage from the war itself back at home. It's back over to you.
Dan, I just want to go back to the point about the UAE severing commercial and trade and financial dealings with Iran. I wonder if this has the potential to be the pivotal moment, given the importance of the UAE to Iran as a trading partner compared to all others. There was that graph you showed a moment ago. This could be potentially the thing that puts such an economic squeeze that forces Iran back to the negotiating table, maybe?
Let's see to watch. We have to really watch and wait to see what happens next here, Ben. The UAE has, of course, already scaled back its own exposure to that Iran trade. The foreign ministry quick to point out yesterday that it was acting, of course, after we saw not just the renewed threat from the Iranians on the UAE, but also after President Trump and President MBZ held a phone call essentially in advance of these measures being announced. We have submitted around 30 questions to the UAE Foreign Ministry. We've contacted the financial companies and free zones around the country. We have submitted questions to try and find out exactly what type of impact this is going to have domestically, and also just how far the UAE is willing to scale back that additional trade as well. So again, we're waiting for more details on exactly what that looks like.
Thanks, Dan. I've no doubt you'll bring us the updates if and when you get answers to those questions you've sent out. Dan Murphy there for us. Coming up on the show, tariff refunds lift target earnings with the retailer raising its full year guidance. We will break down the numbers.
All-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC. Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
I think if I knew how complex was trucking, I think I would have thought again. So the unknown was very helpful.
Gaurav Biswas thought he had landed on a simple idea. Uber, but for trucks. There was just one problem. He had never moved a truck in his life. Then one day at dinner with friends, he saw a problem he had never thought much about.
He was constantly having to walk out of the restaurant, and we could see that he's arguing or shouting with somebody. I was like, hey, is everything okay? He's like, oh, I have 7 containers that have to go on the same vessel tomorrow. Then I said, hey, you should have an Uber of trucks.
That idea became Trucker, a digital freight platform that connects companies that need to move cargo with the truck owners and transporters that carry it.
Trucking is extremely important as a sector because whatever you touch and feel, consume, it's all touched a truck. Whether it's a seaport or an airport or a factory, the trucking is that connector.
A very warm welcome to Squawk Europe. I'm Steve Sedgwick with Ben Boulos, and these are your headlines. Global government bonds getting some much-needed relief, courtesy of the US Treasury announcing plans to double buybacks at the longer end. President Trump bemoaning the Fed for high rates amid the rising debt burden.
We have interest rates that are artificial. They're actually artificially high. I think we have a very powerful country, and we're powering through these ridiculous interest rates. They're ridiculous.
President Trump threatening economic consequences against any country that helps or does business with Iran, adding the US is preparing crushing economic warfare. And ECB Chief Christine Lagarde warns the US retreat from the global order is hurting Europe's growth trajectory, urging policymakers not to repeat the mistakes of the dot-com boom in the AI era.
Let's have a look in on the markets, and they have been turning lower as the session progresses. We're an hour and a half into the day, the trading day, and 3 of the 4 there on the board, all in negative territory. The Italian market, the only one just above the flat line, but not by a great margin. The losses being led by the German DAX there. Let's break it down for you sector by sector. And autos and parts, the big gainer this morning, up around 0.5%. Construction as well, advancing. Utilities up 1/3%. Oil and gas being helped by the rise in the oil price. We've seen that tracking about 3.5% on the week for Brent crude. To the losses, and this is where the sharpest falls are being felt. Basic resources down more than 1%. Telecoms off as well. Insurance giving up ground. Travel and leisure also 0.7% lower. One of the big fallers on the Stock 600 is the retailer JD Sports. Its shares currently down more than 13%. This is after it cut its profit outlook, citing a drop in US sales. We're going to touch more on retail in a moment, but before we do, a quick glance at US futures. And we're looking at a softer start to the trading day. This after a session in which all of the 3 benchmarks snapped a 3-day losing streak, closing modestly higher. Futures indicating they will give up some of those gains. So, retail. Target shares closed more than 4% in the green after the retailer saw a lift from tariff refunds in its quarterly earnings, raising its full-year guidance. Pippa Stevens filed this report.
Target beating top and bottom line estimates and raising full-year guidance, with the quarter helped by nearly $1 billion in tariff refunds. Net sales climbed 5.3%, while comparable sales grew 3.8%. And on the call, the CFO saying they're encouraged by how back to school and how back to college is going, noting they've lowered prices on more than 10,000 items in the last year, saying that matters to consumers right now, with additional price reductions planned over the remainder of the year. This all part of CEO Michael Fidelki, who officially took the reins in February's turnaround plan, which includes more fresh groceries, dedicated displays for higher-end makeup, and more sports merchandise as a way to entice shoppers back to the store. Target seemingly the standout of what we've heard from retailers this week, especially with the positive guide for the back half of the year. Walmart reporting tomorrow, offering another insight into the health of the consumer. Meantime, Target shares hitting a 2-year high.
Let's bring in Melissa Minko, who is Global Director of Retail Strategy at CI&T. Melissa, we've had several readings on the consumer sentiment, behaviour, print, whatever you want to call it, in the US. We've had Target, I think we've got Home Depot, and then later today we get Walmart. What is the picture that you glean from what we've had so far?
I always use the word interesting to describe today's consumer. Consumer sentiment is a bit down, but they're still spending. Target obviously doing really well. I predict Walmart will also have some good earnings to report. And I mean, Lowe's, even though they were struggling a little bit this quarter, they're still growing. That's kind of the takeaway message.
We saw in that graphic, that quote in the report just now, about how prices had been cut by Target. I think they said 10,000 items. JD Sports, in lowering their outlook for the year, cited a highly promotional market, which they said shows weaker consumer sentiment. Is this just a one-off for them, or are we seeing the consumer under pressure, and in order to keep sales volumes up, retailers in the US having to cut prices and run these promotions?
Yeah, price is now a sustainable competitive advantage. In our research, we repeatedly see that it's the #1 driver for loyalty with consumers. They're always looking for the best deals and discounts, and that's what they're using agentic commerce to achieve. So retailers need to deliver those good prices. Target was able to do that, and they won consumers back over.
Why? I mean, the most recent... Good morning to you. Lovely to see you. The most recent retail sales fell 0.6% month-on-month in July 2026. What does that represent to you? Because all we've talked about so far are some companies who are doing rather well. But if the headline figure is falling, is there a contradiction somewhere here, or is it what's going on?
Doesn't represent a whole lot to me because retail is a long-term game. Yeah. So 1 month is not really the whole picture. The whole picture, we've been on par for growth.
Yeah, so it's a robust underlying consumer environment as far as you're witnessing at the moment on a multi-month basis. So on that basis, this show, and you know, we do it in various ways. Some people like it, some people don't, but we try and kind of explain these stories quite with animation, with entertainment as well. Yeah. Why is it that the US consumer is holding up so well at the moment, and yet is having such extra drains on their cost because of the inflationary pressures and gasoline, for instance?
That is the big question, and it's because certain retailers have been able to deliver the best prices to this price-sensitive consumer. They're hyper-reactive to it. They are willing to spend more if they think they're getting a good deal. They repeatedly tell us that that's why they're leveraging technology, that's why they're excited to shop, because they feel like they can be strategic with their spend. So as long as retailers continue to deliver those great prices, the US consumer will snap them up.
And yet, it is just a bit like it's a market of stocks rather than the stock market. The individual names, is there anyone who you have concerns about at the moment, their performance in the sector, or you think that are actually more vulnerable to some form of slowdown if that July figure were to be repeated?
I really think it's just about dynamic pricing, making sure that you can continue to provide those best prices to the consumer and be resilient over the long term. So the retailers that are stocking up and trying to build this excess inventory rather than properly managing inventory and forecasting demand appropriately, those are the ones I'm worried about. They're the ones that really need to figure out how to forecast demand appropriately.
You mentioned agentic intervention, AI intervention in retail. How are customers using it? How are businesses using it in an effective way?
Yeah, so consumers are going to ChatGPT, they're going to Google Gemini, they're researching, they're asking it questions about which retailer is providing the highest quality at the best price for different categories of items. And that's why they're loving this technology, because it allows them to feel empowered and strategic with their finances. Retailers are using it to empower the sales associate so they can educate themselves on the products at hand and then offer both the best deals but also the best products for what the consumer is looking for.
You two carry on. I'm going to do that. I'm gonna
okay, do it. Yeah.
I'm going to do it. So I'm going to ask it the question. What is the
running shoes? It's going to be.
It has to be
running shoes.
Okay.
I you know.
Okay. As you were.
I call it now.
In a few moments' time. Okay.
Exactly.
But I suppose this summer period, the crucial thing for the industry is it the back to school market?
Yeah, back to school is a big one, and that's been interesting because in years prior, consumers were buying early and trying to snap up the early deals, but now, because of this technology, they know they can find last-minute deals really easily. And retailers are using AI agents to provide those deals as well and engage in dynamic pricing and better supply chain management too.
And then in terms of what seemed to be an absolute onslaught and relentless threat from the cut price Shein and Temu, given the moves to try and reduce the flow of those goods into the US, levying the taxes on the small value packages and things, is there any evidence that those moves have helped shore up US retailers?
I mean, consumers definitely don't want those prices passed on to them. So they will end up going with the retailers that are not creating some sort of higher ticket price point because they're shipping product to them. But it really just depends on which retailers can still deliver the best prices. It's really anyone's game. That's just who's mastering the technology to do that.
Okay, I did it. I put in which retailer offers the best running shoes, best price in UK. And it actually was a really interesting answer. And it kind of tallies into one of the other thematics we haven't mentioned about. It came up with 4 retailers. I won't name them. But all 4 of them are bricks and mortar. And I thought that was really interesting. And look, I'm not saying it's a hallucination, but my experience at the moment is that actually the online offering for running shoes, sports shoes, are probably cheaper net as well. So the competitive threat from online, we haven't talked about it in this segment today.
Right.
I presume it's as great as ever.
Well, so this is what's really interesting too, is these agents are the front door, right? That's how a consumer is going to discover a new retailer that maybe they hadn't considered previously, some of those brick and mortar, for example. It's all about then who wins the conversion, whether that's the digital last mile. So if you do then go look to online retailers to buy, if you don't want to go into a physical store, or the in-person last mile if you say, oh, I recognize one of those retailers being in my neighborhood.
Yeah, but it's really interesting. I would have expected it to come up with online retailers, because when I, again, look for a super shoe or whatever it may well be, it tends to be the online retailers. So I guess I'm asking, are the names that are at the front of the queue on AI there, are they buying their way to the front of the queue, as indeed perhaps they have done on traditional search measures?
This is the key. As of right now, they're not, and they shouldn't, because our research says that if consumers can tell that those search results are biased and paid for, they will stop using that technology. So what retailers need to do to increase discoverability is make sure that their product descriptions online are really good, and then those third-party agents will find them through their product descriptions on their websites.
Interesting.
Would you ever purely buy a shoe online?
Yes.
Without having worn it and tried it on? I might buy it online after I've been into the shop, tried it on.
Many times.
Really? Yeah. But how do you know if it's going to be comfortable? Or if it fits?
Well, you don't, because honestly, you don't know what any shoe's going to be like 20 miles into a race if you haven't, for trying on in the shop.
But the reason I ask is sometimes what I end up doing is going into to your point about the physical bricks and mortar store to try on the shoe or the trousers or the shirt, whatever.
Oh, I agree.
And then they say, oh, we don't actually have that in the right colour or the right size. And then so you go to order online. I always feel guilty about doing that, because that then probably registers as an online win for the store's metrics rather than a bricks and mortar purchase, whereas I probably wouldn't have got it if the bricks and mortar store wasn't there for me to try the shoes on and do that thing where you walk around the shop floor.
Let's say hypothetically that I was looking for a new shoe for an autumn race, for a marathon I'm running next month, maybe, hypothetically.
Should we cheer you on?
Hypothetically.
Which one is it?
Yeah, we're going to go cheer you on.
Oh, Berlin.
well, you might.
So let's say I was running the fastest marathon in the world, which is the Berlin Marathon. It won't be me running fast, but it is apparently the fastest. Okay. So let's say I was running that, and I'm looking for a new super shoe for that, which I am. For me to go to either Nike, Asics, New Balance, Adidas, or one of the other top brands at the moment, I've got to schlep on the train up to London, up to the West End, and try and find a store. And as you quite rightly say, find a store with the shoe in thing. Yeah. Whereas if I can just ping, buy it online, didn't like it, send it back, try the next one. I don't know. It's kind of it's 6 of one, half a dozen of the other, I guess. I don't know. I don't want to be that person because I'm a big fan of bricks and mortar, but I don't want to be that one. But it is kind of getting as easy now.
Yeah. No, fair point.
It's still good for brick and mortar, though, because there's this thing called the halo effect. So when you discover a brand online, it does then ultimately bring you into the physical store as well to do the return if you didn't like that product.
I should ask you then, are bricks and mortar, it has, because obviously the assault from online has happened for many, many years now. Are bricks and mortar now kind of back, or is it actually just, it's a one-way traffic?
Brick and mortar never left. Consumers have very much been shopping there still. The split is pretty 50-50. It's category dependent, especially for grocery, for example. Consumers prefer to go into brick and mortar, but consumers are still shopping brick and mortar. They're also shopping online. This is an omni-channel era, so.
Amazing.
I mean, in some ways, I'm their ideal consumer. If I buy something online and need to return it, I go into the bricks and mortar store, get my refund, and then by the time I've left, I've spent more than I got on the refund by spotting stuff and thinking, oh, I'll have that, I'll have that.
Ideal customer.
I mean, there we go. Single-handedly keeping retail afloat in London. Melissa, thank you so much. Really good to have you with us. Melissa Minko, Global Director of Retail Strategy, CI&T. OpenAI's CFO, Sarah Fryer, has told company employees the AI startup will be a public company by 2027 or sooner, according to sources. Kate Rooney spoke to 2 sources familiar with Fryer's comments and filed this report.
CFO of OpenAI, Sarah Fryer, telling employees that OpenAI will, quote, be a public company in 2027 or sooner. This is according to 2 sources who were in that room, attended the meeting earlier. Fryer, from what I'm hearing, did mention Anthropic, its rival in AI, said that there is a chance Anthropic does go public, maybe in September. She told employees, from what I'm hearing, that's okay, we are running our own race. She said the IPO is not a finish line, it's a milestone, called it another fundraise, and then pointed out that they raised $122 billion back in March, said that gives us flexibility. We will be a public company in 2027. She said we may go sooner if our business continues to, quote, inflect. But either way, we will do it on our own timeline. She also shared some new quarter-to-date revenue numbers. So revenue run rate up about 35%, pointed out enterprise revenue up 50% in the quarter. Codex, which is the enterprise side of the business, the coding side, 20 million users, up 3.5x. According to sources, this does coincide with OpenAI's latest model launching this summer and some of the momentum. And it does, Mel, as you mentioned, come as the Journal reported earlier on some of the second quarter numbers from earlier this year, noting widening losses at the AI giant and then slower revenue growth, at least compared to Anthropic.
All right, US President Donald Trump has called on lawmakers to pass a fair version of the Clarity Act as he met with top crypto executives at the White House. Bitcoin and other cryptocurrencies surged after Mr. Trump reiterated his support for the bill. Trump insisted the US is leading the field in the crypto sector.
We're ensuring that America remains the undisputed leader, not only in Bitcoin and crypto, but also technologies like prediction markets, artificial intelligence, and much more. And we're leading in every single one. And I will tell you, the AI, the artificial intelligence, we're way ahead of number two. Number two is China.
Coming up on the show, global government bonds get some much-needed relief, courtesy of the US Treasury announcing plans to double buybacks at the longer end. We've had some brilliant emails. Thank you, all of you. We'll leave you with a look at the global yields to break.
American soccer legend Landon Donovan. He'll explain how the 2026 World Cup could shape the future of Major League Soccer and the inner demons that drove him to greatness.
I was constantly chasing this insatiable desire to be noticed.
He's the man behind Apple's sports ambitions. In an exclusive interview, we talk about the tech giant's unique sports strategy and whether a blockbuster acquisition is on the horizon. This is CNBC Sport on the Record.
The day's top stories driving Wall Street. Up-to-the-minute developments. Kelly Evans, Brian Sullivan, Powerline, streaming on CNBC+.
The US Treasury has stepped in to try and stem the sell-off in Treasuries, announcing it will at least double the size of its liquidity support buyback operations for bonds dated from 10 to 30 years. The announcement pushed the yield on long-dated debt sharply lower, with the 30-year Treasury yield down at around 5.18% this morning. That yield is closely tied to the rate Americans pay for things like mortgages and car payments. So perhaps unsurprising, the Trump administration has moved to try and push rates down as its war on Iran helps push gasoline prices to their highest level ever for August. That gasoline price surge helped hold inflation at nearly 1.5 times the Fed's target.
Look, we've done this a few times in the show, and I think it's important to do, so we can do it one more time as well. President Trump hid out at the central bank on Wednesday, suggesting members of the Federal Open Market Committee hike rates because they like the politics of it. The president hasn't actually, the Fed hasn't actually hiked rates in more than 3 years and actually cut them 3 times in 2025. This as the minutes from the FOMC's July meeting were released on Wednesday, with many officials saying a hike would be needed if inflation doesn't abate. But the US leader insisted rates are too high where they are.
We have interest rates that are they're actually artificially high. They raise them for no reason. And you can't go out to the market when you have a Fed that's raising interest. You can't say, I want to pay 3 points less than what the Fed says you're supposed to be paying. So, no, I don't think so at all. I think we have a very powerful country, and we're powering through these ridiculous interest rates. They're ridiculous.
This as America's national debt hit $40 trillion. That's more than doubling since Trump's first inauguration less than a decade ago. But let's be brutally honest about it. It's happened under all presidencies this century. This isn't a Democrat or Republican thing. The speed of it may alter, but it's both sets of politicians have increased the national debt, and more importantly, the debt to GDP. $40 trillion on its own means nothing. It has to be measured against the size of the economy, of course. Now, with more than a quarter of that $40 trillion coming under the president's watch, though, this time round, exacerbated by his One Big Beautiful Bill Act, which the FT says is set to push the debt up by more than $4 trillion by 2034. The swelling debt figure now means the government spends a record $1.37 trillion a year just on servicing interest. That's more than the budget for the Pentagon and is more than this year's outlay on Medicare. Earlier this month, a Reuters Ipsos poll actually found that Americans now see Democrats as better stewards in the economy than Republicans for the first time in around a decade. Now, bond yields around the world are starting to pull back after the Treasury's intervention. Let's have a look at these. We've got the 10-year in the US trading at 4.67 and the UK 10-year paper 5.067. Look, I've had some brilliant emails. I know I'm going to be honest with you. Some of them like what we're doing here, some of them don't, and that's absolutely fine. You have absolutely... Abby, for instance, writes in, he's not happy with what the way we're explaining the story. Others, well, they're adding to the conversation as well and kind of joining in. So, James, I'll just read your email, a little parts of it, if you don't mind. It's a good long email. It says, look, you'll find that the $40 trillion equates to exactly the black hole that was missing from the super leveraged loans in the US banking system, which came to light in the financial crisis. What James is saying is get the banks to buy back the debt, which will create confidence and slowly reduce the debt over a longer period of time, making the banks public, making the public banks an effective extension of the Federal Reserve and help them out of the mess and closing the past favouritism. I hear you, James, and I think it's a valid point, but herein lies the issue. We talked a lot in the European sovereign debt crisis. We talk about the GFC now, but we also talk about the European sovereign debt crisis in that same period. And one thing I do remember is that the crisis at the time was exacerbated by what we called a doom loop. You'll see the phrase quite a lot if you put in European sovereign debt crisis. And the problem was that the debts that were the government's debts, the sovereign debt, were then also held by the banks, which meant that the banks were infected by the same problems, which meant that the confidence in the banking sector was diminished. And therein lies the problem about the doom loop. It's exacerbated that one set of debt is on the balance sheet of others as well, and it created a bit of a backlash thereafter. And that's why we've had this drive, of course, post-2010, 2011, to have higher capital buffers. Ben, do you want to jump in?
Yeah, I was just looking at we showed the current yields, and we said that they'd pulled back, they'd eased after that announcement from the Treasury. There was an awful lot of green on that board. I don't know if we still have it.
No, they began to pick up again.
They have picked up at least 4, by my calculations. The 30-year, which was the one that was causing concern, it looks like it's already up again about 4 basis points, which is roughly about half the cut that we had seen, that half the easing.
Look, what another correspondent wrote in, there's lots of great correspondents, I genuinely, thank you, was saying was that what Besant did, and quite rightly, pointing out to me and to everyone that it wasn't so much about the amount of money, doubling this long-end support in fear operations. It's actually about the signalling that the government, that the Treasury will not necessarily put up with the higher rates. But my point back at that would be, well, what can they do? What can they effectively do without increasing? And as you made the point, they're the ones borrowing, and yet they're the ones also supporting that long end of the market.
Yeah, and when we had Ben Eamons on, he addressed that point. Actually, if you're borrowing at the short end to increase the repurchases on the long end, you leave yourself very vulnerable, very susceptible to shifts and volatility in short-term interest rates. And coupling that with the FOMC minutes that were out yesterday from the July meeting, which showed that at least some of the officials, quote, many of the officials, feel that they may need to consider hiking interest rates if inflation doesn't start to ease. So to me, that sets out a set of circumstances that could spell turbulence in the months ahead if they go against the Treasury.
And the other point which we raise here is the President's bemoaning certain members of the FOMC, but didn't name Kevin Warsh, of course, as well. 90 days ago, 22nd of May, that was when he was appointed, I believe, as well. I think the process, you can argue about the whole confirmation process, but the fact of the matter is it's 90 odd days ago. Now, is Kevin Warsh now going to have a bit of the same treatment that Jay Powell had several months after he was appointed in 2017 and start being lambasted by the President? That is a question.
Maybe there'll be an understanding that he's facing an unusual set of circumstances and a big challenge.
Well, that is it for today's show. Thank you for your contributions from all of you, positive and less positive. I'm Steve Sedgwick with Ben Boulos. Morning Call is coming up next.
Have a great day.
From London, Paris, Munich, and Milan.
We've seen very strong demand all summer long.
End users are using our AI even more frequently.
Are you heading into a record Q4?
We are gearing up for the biggest IPO of the year.
Prime Minister, it's a pleasure to be back in Athens.
It's a pleasure to talk to you.
This is becoming a very competitive market in the EV space.
Parliament continues to stay very fragmented. This Bank of England decision certainly got more interesting over the last couple of months.
Here's what investors are watching this morning.
1 hour of added insight every morning doesn't just add up, it compounds. 1 extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC.
My earliest ambition was to be a teacher. Now I can teach you so that you can be as ambitious as you want about whatever you want to do. CNBC is my home. If you love your work, well, maybe it's life itself.
Listen to CNBC on the move with the CNBC app. A lot of strong numbers this morning. Breaking news.
We got a big IPO, something for the private markets. Could it be a rate cut scenario?
Real-time market updates.
I check now on how Europe is set to open the trading day ahead.
Your favorite programs live 24 hours a day.
Welcome to Squawk Box Europe.
Welcome to the China Connection, Squawk Box Asia.
Listen wherever in the world you are. Download the CNBC app now.
Kelly Evans with in-depth reporting and analysis. Strengthen your investment strategy on The Exchange. Streaming on CNBC Plus.
I built a legacy on the court, and now is the moment to build a legacy outside of the court. My main investments are in hospitality, in education, and sports. So I believe that's the future. I see my brand as in a growing perspective, and in some way building this new chapter.
You'd been managing a very rare condition in your foot for much of your career. At what point do you think you seriously started to think about life beyond tennis?
You need to have goals. I think it's very important in this life to have goals ahead of you, because that helps you to wake up every day with motivation and passion. I knew since a long time ago that I wanted to keep doing things and learning after my tennis career. I have 2 small kids, and that's the most important thing of my life, without a doubt. But I like to work. That's how I understand this life.
and this is your morning call. Good Thursday morning. Let's get a check on U.S. stock futures after all three indices snapped a three-day losing streak yesterday to finish higher, although well off session highs yesterday. You can see pre-market here that futures are poised to open lower again. S&P down 12 points, Dow poised to open down 105 points, and the NASDAQ about 19 points. So basically just fractionally lower here today. Breadth was very strong yesterday, and also the equal weight S&P 500 outperformed. So turning to treasuries and that surprise move that we saw by the Treasury Department to increase the size of government debt repurchases to, quote, at least double, altering its tentative buyback schedule that was released just 2 weeks ago, targeting longer dated debt here. You can see we're moving a bit higher here across the curve. 10-year U.S. 10-year Treasury yielding 4.67%, and the 30-year, which has been such an area of focus after hitting a 19-year high earlier this week, has creeped a bit higher here, although off the highs that we saw ahead of that Treasury announcement. We're at 5.22% right now. Fed sensitive 2-year is a bit lower, 4.17%. We've got to look at the ripple effects around that announcement. So you got the dollar hovering around 3-month lows here. If we could pull that chart up, dollar index 98.68 is the level there this morning. And let's get a check on precious metals because gold moved higher yesterday. It's actually hovering near its highest level since late May now. And you can see basically flat here this morning. $4,545 an ounce right now. Silver's up about 1.5%. Platinum slightly lower as in the meantime, though. Let's get a look at Bitcoin rebounding above the 70,000 mark yesterday. It was a huge move higher, up about 8%, in part around that Treasury action. President Trump also urging Congress to pass the Clarity Act yesterday. You can see the massive spike yesterday for Bitcoin. Worth noting here that you did see the biggest wave of short liquidations on record going back to 2021 in Bitcoin. A lot of folks were positioned short, and the move higher yesterday was exacerbated by that dynamic. But if you see for the year, though, Bitcoin is still down just under 20%. We're going to have more on crypto and all of this, because this is very much a macro story in just a moment. We got to check on energy as well, because President Trump saying the U.S. will launch what he calls, quote, the most crushing economic operation ever taken against any country. That will be against Iran. He's calling it economic D-Day, essentially. This comes after a huge blow to Iran's economy this week when the UAE announced that it is suspending financial and economic transactions with Tehran. UAE is really one of those key partners other than China when it comes to Iran. So a big move there. And you can see crude is higher this morning. WTI is up 2%, trading around $87.65 a barrel. Brent is also up more than 2%, trading around $93.60 a barrel. Let's see how Europe and Asia are faring. JP Yong is in Singapore. Steve Sedgwick is in London. And JP, let's start this with you.
Yeah, good morning. Again, we're calling it Operation Twist, the Scott Bessent remix out here. It's got all the traders up and moving so far in Asia throughout Thursday, and also giving a lot of these bond yields that we tracked yesterday room to actually ease. In fact, the Japanese 10-year bond yield there continued to put a little bit more distance between itself and that 3% mark that it last hit about 30 years ago. Of course, these easing bond yields also helping equity and stocks across the region. You can see not a bad session in Greater China, whether you're in Hong Kong or in Shanghai. And Japanese markets also getting a boost of confidence when exports in July proved stronger than expected, up by 23% thanks to that weaker yen, and also outsized demand for semiconductor materials, of which Japan is an outsized exporter and a big player in across that very critical global supply chain. Now, as well as the Nikkei 225 did today, it did not do as well as the Kospi, which was once again the runaway leader. Once again, surprise, surprise, another sidecar triggered in Seoul, this time thanks to a lot of these upside enthusiasm. And that's what happens when the other memory chip giant, Samsung, actually joins SK Hynix and announces a $72 billion share buyback program that really boosted their stock. And also SK Hynix also along for the ride, really pushing the Seoul benchmark up, but again, raising some of these questions about concentration risk. I do want to end by taking a look at the property stocks in Hong Kong today, because there was a momentous occasion in today's session. We had Hui Kayam, The founder of Evergrande, unfortunately, is convicted to life imprisonment because of charges related to embezzlement, bribery, and also inflating sales to the tune of about $71 billion. To put it into context, Morgan, we have to remember they once had liabilities the size of $300 billion, which is bigger than the GDP of many countries out here in Asia. And it also underscores just all the questions and all the worries that emanated from the Chinese property sector over the last couple of years. Will this be the end of it? Will this actually indicate a bottom? Only time will tell, but definitely a momentous occasion for who was once one of Asia's richest individuals. Back to you, Morgan.
Wow. Latest chapter in a story that's been playing out over a number of years now. Jay Pyong, thank you. Well, let's see how Europe is shaping up. We just heard about Asia. Steve Sedgwick is in London with early trading. Steve.
Hey, Morgan, good to see you. Yeah, European markets largely under pressure as well. Not that much to the downside, though. Early trade with investor sentiment just a little bit muted at the moment. Traders closely watching, of course, everything that the president is saying. Donald Trump's announcement of economic warfare on Iran and warnings of tremendous consequences for any country helping Tehran evade sanctions. That is gathering a lot of attention here. Now, the higher crude prices lifting oil and gas stocks in early trade. But by and large, the direction of travel is to the downside so far. Another area firmly in focus, of course, for the investors, the European bond markets as well. Bond yields around the world starting to pull back after the US Treasury, of course, stepped in to try and stem some of the sell-off in those treasuries, announcing, as you were saying, it will at least double the size of its liquidity support buyback operations for those 10 to 30-year bonds. But the European arena, well, this is where we are on the gilts, the UK-listed paper, 5.064. The Italian 10-year paper trading at a big discount to the pound, to the gilts, which is historically quite rare, 4.08. And the benchmark Bunds trading at 3.26, Morgan.
All right, Steve Sedgwick, thank you. Let's turn back to this rebound we've seen in crypto, specifically Bitcoins. Bring in Lynn Alden, founder of Lynn Alden Investment Strategy. Lynn, it's great to have you back in the show. We're going to start there, but you are such a macro investing voice. There's a lot to get to here. So before we actually do get to Bitcoin, I do want to get your reaction to what, as Jay Pyong just called it, Operation Twist Besant Remix. Should we be referring to this as Operation Twist? I mean, I've heard such extremes as yield curve control, quantitative easing, but I've also heard, assessments from Wall Street that really this is just largely symbolic.
I think it leans more symbolic, but symbols have power in the markets. It shows the intention of where they want to go. It's not the same as QE. This is not the Fed creating new base money to buy bonds, but it is the Treasury basically giving support to its longer duration securities, off-the-market securities, by being willing to issue more T-bills and buy back some of their long-duration debt, which does have some twist elements to it. It provides liquidity and support to that long end and signals basically that they're uncomfortable with current yields. It's an interesting action to be taken given that the yield curve is still not that steep. But overall, I think the administration is not broadly happy with how high yields are, both on the short end and the long end, and they're taking action here, which I think is giving a positive signal for hard monies, gold, Bitcoin, other assets.
Yeah, and of course the timing cannot be denied either when you have U.S. government debt surpassing $40 trillion mark earlier this week for the first time ever. I realize that doesn't necessarily change the dynamic versus, say, $39.9 trillion, but it's a big number, it's a round number, it's an emotional number, and we're less than 2.5 months away from midterm elections. So what does this mean for some of the other asset classes, including, by the way, the dollar, which we've seen weaken notably in the last 24 hours?
Yeah, so historically, when a country gets this indebted, various financial repression techniques are used, with the most extreme being like hard yield curve control. These are softer methods. And in general, they try to inflate the value of other assets relative to the currency and relative to bonds. And I think that's what we're seeing here. The Treasury's other action in recent weeks was supporting the yen. I think the administration is fine with a weaker dollar. It actually kind of benefits their, kind of trade goals. Longer term, even though it does put pressure on inflation potentially, depending on how weak the dollar gets. But basically, a lot of these actions just basically throw the currency under the bus to protect the value of other assets and to prevent the yield curve getting too steep. And these are pretty kind of classic actions when a country becomes this indebted.
So what does all of this mean for Bitcoin and the move higher we saw, the violent move higher we saw yesterday amid forced liquidation and a short squeeze?
Yeah, so Bitcoin, I mean, the sentiment's been very low. The fast money has long since moved out toward AI names. And as we saw, I mean, even a fairly small move in price and in Bitcoin terms caused kind of record liquidations, which shows just how bearish the sentiment and positioning was. I think that, while this could be another false breakout. I mean, May, we saw higher numbers and we rolled back over to slightly lower lows than we saw in February. So I don't think Bitcoin's out of the woods yet, but I do think that by almost every metric, Bitcoin is near the low end of its valuation and sentiment range. Fast money's washed out. Strategy already kind of recapitalized its dollar position, so it kind of took that overhang of potential kind of further selling off the market for a while. There's really not a lot of downside catalysts for Bitcoin left. And even relatively small upside gains at this point can attract new types of buyers. Once people see that the chart doesn't look bad anymore, you can get technical traders coming back in. If you get further momentum, say months from now, you could get more momentum traders back in. So I think, with a multi-year time frame, Bitcoin is positioned here, both just fundamentally from where money has gone, but also from the dynamics we just talked about, basically that they're going to do some version of financial repression between the Treasury and the Fed, potentially alternating, and the ultimate beneficiary of that is hard assets that are underowned.
In terms of what could trigger some of those upside gains, at least in the nearer term or maybe even in the longer term for Bitcoin, I mean, should we be talking about the reemergence here then of, say, a debasement trade, especially when you see gold, for example, now surpassing U.S. Treasuries as the world's largest central bank reserve asset?
I think long term, yeah. I think some of these trades got ahead of themselves. I mean, last year, gold had that 2-year very strong run that culminated at over 5,000. Bitcoin briefly got over 125,000. Strategy was trading at 3 times its net asset value. And so things were heated, and I think that the correction was warranted across a number of these assets. But I think the long-term story remains in place. That when a country gets this indebted, there's various techniques to basically gradually try to inflate away the bonds. That currency itself is generally what takes the hit. And if you own scarce assets, whether it's high-quality equities or hard monies in this case, as long as they are not too over-owned or overbought at the time, they tend to be beneficiaries. And right now, I think Bitcoin's kind of near the bottom end of its cyclical range, which I think looking back 2-3 years from now will be seen as having been a good buying opportunity.
So in light of all of that, what are you buying right now? What would you be buying right now?
I think Bitcoin is an attractive buy here. I think strategy, which basically levered Bitcoin, is a riskier but still interesting long-term buy here. I think the equal weight S&P 500 is still interesting from a multi-year perspective. I don't think it's particularly overvalued. I'm still bullish on global equities, Latin American equities. I think there's a lot of things out there to buy as long as you avoid the frothiest areas.
All right, Lynn Alden, great to have you on and to start the hour with you. Appreciate it.
Thank you.
We're going to hear more about all things crypto, and Coinbase CEO Brian Armstrong joins Squawk Box a bit later this morning. That's at 8:40 a.m. Eastern. In the meantime, though, you're going to hear a lot more here on Morning Call. Fed Chairman Warsh feeling the heat from President Trump when it comes to rates. We've got those details on the president's latest central bank comments, plus a new partnership in tech to tackle growing risks from cyber threats. The CEO of NTT Data is standing by about his partnership with Palo Alto. And later, the next big test for SpaceX. That's amid the ongoing rebound we've seen in the stock. A very busy hour still ahead when Morning Call returns.
The Bond Report is brought to you by PIMCO. The Bond Report is brought to you by PIMCO.
One of the world's largest private climate investment vehicles, Altera, aims to mobilize $250 billion by 2030.
What we're trying to show is that we can align those objectives and we can make money doing it.
Clean energy, emerging markets, even the AI boom. The opportunities are vast, but how do you pick the right investments?
We have people who specialize in these investments, and that's what makes Altera unique. That's our secret sauce.
Find out more on the next Managing Middle East.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned, sponsors disappeared, fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
The Score, streaming now on CNBC.com and YouTube.
Closing Bell, weekdays streaming on CNBC+.
Fast Money is America's post-game show.
Near all-time highs against the S&P.
We want to arm people with the information to make great decisions.
Valuations matter in a higher interest rate environment.
Fast Money, CNBC, streaming on CNBC+.
Welcome back to Morning Call. Companies and countries worldwide are grappling with a whole host of cyber threats, with more attacks now being driven by autonomous AI agents. The cost of all the global cyber crimes has now topped $10.5 trillion a year. You heard that right, with a T. Last week, I spoke exclusively with Booz Allen CEO Horacio Rozanski about how the cyber landscape is changing.
What's really interesting about it is the techniques that defeat an AI attacker will not defeat a human attacker, and vice versa. So we have to layer both. The old threat, you talk about expanding as opposed to evolving. The old threat has not gone away. Phishing is still here, and it happens to the best of us. But we now need to layer defenses against the new threat and the ones that are coming after this one.
Well, today, Palo Alto Networks and Japan's NTT Data are announcing a multi-year partnership combining Palo Alto's cybersecurity platform and threat intelligence with NTT's consulting and engineering services to help large companies modernize their infrastructure and securely adopt AI. So joining me now in an exclusive interview is NTT Data's global CEO, Abhijit Dubey. Abhijit, it's great to have you on the show. Let's start right there. What does this partnership entail?
Well, thank you for having me. You know, frontier AI effectively has changed the cybersecurity equation. On the one hand, the attacks have become exponentially more sophisticated, the surface area has increased, and the speed has increased exponentially. So when you have attacks that are operating at machine speed, you cannot have defense that is human speed. On the other hand, I think companies have realized that to get economic value from AI deployments, they have to deploy it in their core operations processes. And as agents therefore become more autonomous, there are legitimate concerns and challenges around how do you ensure governance, identity, access, privilege, what agents can and cannot do, and that's slowing down the adoption. So this whole partnership is sort of the next generation of our partnership with Palo Alto, where we are massively accelerating both the AI for security, where we help our clients move from reactive defense to proactive cyber resilience, that is business risk driven, as well as security for AI, where we are effectively building the confidence layer to accelerate the adoption of AI.
Yeah, I want to go into that a little bit more because, I mean, we've been hearing the reports, we've been seeing the disclosures. It's almost become, in a weird way, a bragging right in Silicon Valley. Bots escaping sandboxes or, you know, basically taking on a life of their own and, you know, engaging in processes or activities that they weren't programmed to do. So in terms of that internal threat or risk, I guess I should call it, for companies that are adopting AI and what it means for their own data and their own processes, how are you navigating that? How are you counseling those companies that are making these adoptions?
Yeah, I think what our fundamental counsel is that you have to do it securely from the beginning. So it has to be secure and trusted by design. So every time you build an agent, you deploy an agent, it has to be governed. The identity has to be governed. What systems and privileges that agent has, what data it can access, and how do you manage the entire life cycle of that agent, just like you would do human employees. Everything from the recruiting to the onboarding to the exit of an employee, you have to do the exact same thing for agents in an enterprise landscape.
You mentioned speed. You also mentioned surface area. I mean, I just go back to the sound that we played from Booz Allen's CEO from my exclusive conversation with him last week. When we talk about surface area and the expansion of that, what does that entail?
Well, right now, most cybersecurity postures in enterprises effectively are vulnerability detection oriented. So I look at where are my vulnerabilities and I go patch it or I fix it. In the future, and actually it's happening right now, it's all about exploitation driven. So what are attackers going to exploit? And that could be anything in your environment. And that massively accelerates the surface area. And that's why you have to respond in your defense with AI, just like the attackers are attacking with AI.
Okay. Abhijit Dubey, it's great to have you on the show. Appreciate it. CEO of NTT Data. Keep us updated as all of this continues to evolve.
Thank you.
As we head to break, a check on shares of Moderna, which are pulling back a bit today, down about 10% here pre-market, but 10% is nothing compared to the massive surge that we saw yesterday, with the stock closing up nearly 200%. That was after Moderna and Merck announced positive results from a late-stage trial of an experimental vaccine, experimental mRNA vaccine to treat melanoma. Morning Call. We'll be right back.
All right, let me tell you about ambition. To me, too much is not enough. You have only one life. So go all out. The only way you're going to accomplish all the big goals is if you have a vision. Find out what you want to do, set the goal really high, and go all out. And then you create another vision, and another vision, another vision. So that's being ambitious. Be useful. That's what my father always said. Don't just waste this life away. Be useful, help other people. This is what this is all about.
From the markets to the courts. Kick back and relax while we serve up the highlights. Tackle your weekend. This weekend, race to your screen. The adventure continues. Dive into the action with CNBC Sports. CNBC Sports, afternoons on Saturday and Sunday, only on CNBC.
Listen to CNBC on the move with the CNBC app.
A check on how Europe is set to open the trading day.
Real-time market updates. A lot of strong numbers this morning. Listen wherever in the world you are. Download the CNBC app now.
There were definitely a few times when there was no money in the bank.
Before Careem became one of the defining startup stories of the Middle East, Mudassir Sheikha was trying to keep it alive from one funding round to the next. He'd left a safe consulting job, and he and his co-founder had each invested $50,000 US of their own money into the company. In the early days, Careem wasn't an app that magically matched riders and drivers. It was the founders calling drivers themselves in the early hours of the morning.
It was radically basic. All we had was a website.
And 7 years later, Uber, the rival Careem spent years fighting, agreed to buy the company in a landmark deal for the region.
To do a deal with our biggest rival, the company that we thought was trying to kill us, was just very, very difficult for the organization.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC+.
Welcome back. We're checking some of the morning's latest headlines. President Trump expressing his frustration with the Federal Reserve and its interest rate policy. The president airing those grievances at the White House yesterday, insisting solid economic data shouldn't stop the Fed from adopting an easier policy stance.
We have interest rates that are they're actually artificially high. They raise them for no reason. And you can't go out to the market when you have a Fed that's raising interest. You can't say, I want to pay 3 points less than what the Fed says you're supposed to be paying. So, no, I don't think so at all.
Well, if we stick with the Fed, a group of Democratic lawmakers are calling on Chairman Kevin Warsh to disclose any conversations he's had with President Donald Trump since taking over the central bank in May. Now, this according to reports which say the request was made by Senators Chris Van Hollen, Jack Reed, Angela Brooks, and Elizabeth Warren. They're also seeking a written account from Warsh after the White House and President Trump gave differing accounts of recent conversations. OpenAI, meantime, CFO giving employees an update on when the startup may make its highly anticipated public market debut. Sources telling CNBC that Sarah Frier told employees during an all-hands meeting yesterday the company, quote, will be a public company in 2027, but that it could also debut sooner, quote, if our business continues to inflect. Also making some interesting comments about rival Anthropic and the fact that they are poised to come to market in the coming weeks, something investors will be watching for in terms of a possible prospectus. Well, China is firing the latest shot in the global space race. Startup Landspace recovering the first stage of its rocket yesterday. The Chinese company joined SpaceX and Blue Origin as the only private companies to land orbital-class boosters, narrowing China's gap with the U.S. when it comes to reusable rockets, which, as we know, drives down costs to go to space dramatically. Well, still on deck, some of Wall Street's biggest names tapping into the growing boom around defense tech. We're going to talk to the CEO of Castellion, who's here, taking the big money flowing into his firm as the U.S. looks to diversify its weapons lineup. Hypersonics, that's what's coming up after the break. Morning Call continues next.
Squawk Box is breakfast with the most interesting people in the world.
The ultimate pre-market morning news show. Squawk Box streaming on CNBC Plus. The day's top stories driving Wall Street. Up-to-the-minute developments, instant analysis, essential business news at the intersections of power and money. Kelly Evans, Brian Sullivan, Power Lunch streaming on CNBC Plus.
Welcome to Closing Bell Overtime.
Get the essential post-market edge.
A very busy overtime.
After-hours action and opportunities.
The economic impact is just beginning.
What happened today?
The market had to resort to defense.
We've got a developing story out of Washington.
What's moving in real time?
What did the numbers tell you, pro or con?
Be ready for tomorrow after the bell.
There's a wait and see about a lot of things for tomorrow, Mike.
Completely.
Melissa Lee, Mike Santoli, Closing Bell Overtime, CNBC.
The AI boom is reshuffling the global equity market rankings. With Taiwan and South Korea leapfrogging past long-established markets, Taiwan has climbed past Canada and India to become the world's 5th largest equity market, while South Korea has moved into 6th place.
All this happened within the span of just a few months, because last December, they were in the 9th and 11th places respectively. Now, such a shift is not unprecedented, but what is unusual is the speed at which these two have been climbing.
But this reordering isn't necessarily being driven by broad economic growth. Instead, it's about 3 companies at the heart of the AI hardware supply chain.
It's the AI theme which is driving things. So we have this kind of perfect positive storm of industry fundamentals which are resulting in very, very rapid profit growth.
So what does this reshuffle tell us about how AI is changing global stock markets? And what are the risks?
Fast Money is America's post-game show.
Basically, near all-time highs against the S&P.
Every single story that we pick is a tie back to the markets.
Those sort of revenue streams don't trade at a great multiple.
We want to arm people with the information to make great decisions.
Stock got whacked. I get it. People say they overpaid. I get that.
Fast Money is all about the chemistry. We've been successful for this long because we're a team.
Fast Money, CNBC, streaming on CNBC Plus.
Welcome back to Morning Call. Let's get a check on U.S. stock futures. After all three indices snapped three-day losing streaks yesterday to finish in the green, albeit at lows of the trading session, you can see it's a mixed picture here this morning. S&P is poised to open fractionally lower, down about 5 points. The Dow, 97 points, lowered by 97 points. The Nasdaq has actually turned positive here in the last little while, poised to open up 36 points, so a fractional move higher. If we turn to Treasuries and the surprise move by the Treasury Department to increase the size of its government debt repurchase by, quote, at least double, altering its tentative buyback schedule that was released just 2 weeks ago. If you take a look at Treasury markets right now, we're seeing yields creep higher again this morning, for the most part across the curve. U.S. 10-year Treasury yielding 4.67%, and the 30-year Treasury, after hitting a fresh 19-year high, the yield earlier this week, is also creeping slightly higher, but certainly not at those levels. It's at 4.22% right now. Fed-sensitive 2-year, 4.17%. Let's look at the ripple effects around that Treasury announcement to other asset classes. You got the dollar hovering right around 3-month highs right now, a bit lower this morning. 98.60 is the level for the dollar index currently. And let's get a check on precious metals, which have continued their rally here as the dollar has weakened. You can see gold is basically flat right now, $4,545 an ounce. Silver is up about 1.5% this morning. Platinum has just turned positive as well. Gold is hovering near its highest level since late May. Let's get a check on energy, too, as we see crude prices move higher this morning as well. You can see WTI is up to about 2.5%, trading right around $88 a barrel, and Brent crude is up 2.5%, trading just below $94 a barrel. President Trump saying the U.S. will launch what he calls, quote, the most crushing economic operation ever taken against any country in regards to Iran. What some are calling economic D-Day here. We're still a little light on details, but something to watch, especially as the UAE has pulled back on its economic relations just earlier this week with Tehran. Let's get a check on crypto. Bitcoin, that's rebounding. That continues its climb higher above the 70,000 mark this morning. You can see it's up another 5% this morning. It's trading just below 72,000 now. In terms of the move we've seen in Bitcoin, it's been pretty dramatic here in the last 24 hours. Yesterday, unleashing the biggest wave of short liquidations in records going back to 2021. So continue to watch what's happening there. President Trump, though, also urging Congress to pass the Clarity Act yesterday.
Now we need Congress to take the next step by passing the Clarity Act, a fair version of the Clarity Act, and this landmark structure legislation. It's a very, very powerful structured legislation which will keep us ahead of China, keep us ahead of everyone else, will open the door to the next wave of innovations and innovators.
All right, well, let's get a look at some of the stocks that are in the crypto space, because those are continuing to ride this new momentum this morning. You can see a lot of big gains this morning pre-market. Coinbase up 7%. Look at Strategy right now, but that's more of a move tied to Bitcoin, but that's up about 9.5% this morning. Circle, Bullish, Robinhood, all higher. Some of Wall Street's biggest names getting behind a missile-making startup Castellion, meantime. Defense tech. We're shifting to defense tech. The company announcing that it's closed a more than $1 billion funding round, a Series C, backed by the likes of Carlyle, J.P. Morgan, Andreessen Horowitz. The list goes on, highlighting continued interest around the growing corner of the defense industry. For more, we're joined exclusively by Castellion co-founder and CEO Brian Hargest. Brian, it's great to have you here on set. I mean, it's kind of amazing. We're talking about a $13 billion valuation for Castellion now. That's up from $2.8 billion back in December with your Series B funding round. You're in the business of hypersonic missiles. So what will this money go toward?
Well, thanks for having me back on. So the funding for this round is extremely, this is really exciting for us. So we're going to supercharge Blackbeard production, which is our first hypersonic weapon that we're delivering in 2027. We're going to be building thousands per year out in Albuquerque, New Mexico, a site we call Project Ranger. We're going to be looking for a second production site in the United States. And then on top of that, we're developing a longer-range weapon system as well as beginning development of defensive systems.
You're moving very quickly when it comes to missile production, and specifically when we're talking about, I realize we've been talking about hypersonic technology for, 2 decades, 3 decades now, but when we talk about actually fielding it, you're moving very quickly here. I mean, you're talking about fielding this first weapon as soon as next year. What's enabling that, and how quickly can you ramp production?
Well, it's really a back to the basics. So we're following a model of what the country used to do in the Apollo era. We build a lot of development hardware. We produce a ton of hardware in development, which helps us refine the manufacturing system, which is actually a really hard problem, especially if you don't go build early on. And we're doing that. We're doing the testing so that we can deliver this at a quantity that folks couldn't imagine possible.
We had the Undersecretary of Acquisitions and Sustainment for the Pentagon, Mike Duffy, on the show yesterday. He actually name-dropped Castellian when he was talking about, this need to get more missiles and munitions productions online, open the aperture in terms of who the Defense Department is working with and what those types of deals look like moving forward. So your thoughts?
Yes, I think the administration and the department are trying to clear the hurdles for new entrants such as ourselves by dropping some of the more bureaucratic processes. They're also clearing the way for testing, which is super important to the model I just spoke about. And they're making sure that funding flows to the new entrants, which is really important to get these large Wall Street names behind us.
Well, and that's exactly where I was going to go with you. The fact that we are seeing, a growing cadre of blue chip Wall Street names. It's not just in the venture world either. I mean, case in point, Todd Combs from JP Morgan now being involved in this funding round in a very meaningful way. How does it speak to investor appetite, growing investor appetite for this sector in a company like Castellian?
Well, I think it's a really exciting time for America. We're talking about reindustrialization. We're, of course, working on defensive manufacturing. But really, it's the strength of our business. So we have over $500 million in contracts in the past 18 months with more on the way. We're integrating to 2 major weapons platforms, F-18 with the Navy, HIMARS for the Army. And because of that, we ran a competitive process. We were able to select some of the best investors in the United States. We've got the world's largest bank, JP Morgan. We have Andreessen Horowitz, who shows that we have, venture-style returns that we can provide. And then we have Carlyle, who's been a, top backer of aerospace startups for decades.
You're also a SpaceX alum, and so are your co-founders here. So in terms of what investors need to understand about the street cred that brings when it comes to building hardware?
Well, it's really to that point I made about getting back to the basics of the Apollo era, of looking at your supply chain, making sure to take into account that your design for what you're building is sourceable, and to make sure that you have dual sources of supply, about vertical integration so that you can build the systems and iterate on them within a reasonable time frame, and then to do all that in a process that produces really complex systems at an affordable price in a time frame of relevance. And so we're bringing that to the missile market, which is what's so exciting.
Yeah, okay. You're gonna pardon my divergence here, but given the fact that you do have those SpaceX roots, we are seeing another lockup expiration for stock today, and you and I haven't spoken since that company's gone public. Want to get your thoughts on all of it?
I'm really excited. Over half of our company is former SpaceX, so I fear whenever it goes down because we probably lose productivity with people looking at the stock ticker. But
do you think people are selling, though? Do you think insiders are selling?
I know some folks are selling. I mean, they've held on for a very long time. They've taken tremendous risk, and it's meaningful money for folks, and this allows them to go buy a house, buy a car, and I'm really excited for them, as well as like my friends still at SpaceX. For me personally, it was exciting to be able to actually take the gains that I made at SpaceX, both with knowledge, but also with the stock to fund Castellian at the start.
All right. Brian Hargis of Castellian, it's great to have you here on set.
No, thank you.
Well, a lot more to come here on Morning Call, including we're bracing for Walmart. We get those results set to cross before the open, so just in a short while. What the options market is signaling about the potential stock reaction. We've got that and much more when Morning Call returns.
Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving? The biggest guests, the market action.
Right here.
Squawk on the Street, CNBC.
Never miss a moment.
We think there is a huge opportunity for AI in the UK and Europe because it is that middle ground between the United States and China.
Andy Burnham has committed himself to the Labour manifesto, so I don't think that that's going to change in the immediate future. I think our historic destiny is to be back in the European Union.
The world is taking you at your word, sir. What happens next?
We're never going to see Iran have a nuclear weapon.
Kelly Evans with in-depth reporting of the day's most compelling stories, market updates, and where to find opportunities now. Strengthen your investment strategy on The Exchange, streaming on CNBC Plus.
If you're watching CNBC, it's because you want to get an edge. You want to get ahead. It's our job to deliver that. My ambition is just to be the best that we can possibly be. More often than not, I kind of forget that the cameras are there, but when there's really a burning question, I'm thinking about what my mom would want to hear. I'm thinking about some of the investors I know who are watching. Those are the same questions we have. People always ask me what I want to do next, and I always think they're a little crazy. This is what I want to do. It's the best job you could possibly have.
Become a smarter investor with CNBC Pro. 24/7 access to market-moving news and interviews with 3 global live streams. Subscriber-only content from Wall Street pros like Josh Brown.
If you love the stock market as much as I do, you're going to love the best stocks in the market list.
Plus exclusive live events.
This is my first time at the stock exchange and it's been awesome.
To be on the floor, I just can't believe I'm here. Become a CNBC Pro. Go to cnbc.com/GoPro now.
I was 22 years old. I had never started a company. I had never had a full-time job. I was building a business at the intersection of hardware and software and data science and medicine. Hundreds of investors said no. And so every day I just tried to pick myself up and put one foot in front of the other and keep building.
In 2012, while studying at Harvard, Will Ahmed started building what would become Whoop. Built around a screenless wearable, the business is now valued at $10.1 billion and has been embraced by some of the world's top athletes, including LeBron James, Michael Phelps, and Cristiano Ronaldo.
There was a period in 2017, 2018 where Whoop had built, I think, a cool brand. It was used by the world's best athletes. The technology was very powerful, but we hadn't yet figured out how to make a real business out of it.
This is Founder Effect.
All right, let's get a check on shares of SpaceX. We just touched on it in our last conversation. You can see shares are down about 1.3% right now, trading around $137.80 a share pre-market. This, of course, as today we get more insider shares becoming available to sell in the second of a series of lockup expirations over the coming months. About 319 million additional shares unlocked today. That marks 70 days of SpaceX as a public company. Well, it's a smaller tranche than the nearly 912 million shares that became available on August 6th. Today's expiration still represents about 7% of restricted stock. And more unlocks are coming. Upwards of 700 million shares unlock in September, more than 650 million October. By year end, you're talking about 4.9 billion shares of SpaceX that will be available to trade, or roughly 70% of the stock that is not held by Elon Musk. Now, this on the heels of a Bloomberg report yesterday that SpaceX attempted to acquire AI coding startup Cognition. The report that Cognition's CEO quickly denied. SpaceX closed its $60 billion acquisition of Cursor. This is another AI coding startup last week. SpaceX has not responded to requests for comment, but SpaceX stock is up about 28% since hitting its lows right before earnings at the beginning of the month when it fell below 105. Meanwhile, investors preparing for Walmart results. Those are out before the open. The stock is down more than 10% since its latest results. And our next guest says options markets are pointing to a big move in the stock once earnings cross. And you can see shares are popping about 1% here pre-market ahead of that. Brent Kachuba is the founder of Spot Gamma, which analyzes options flows. It's here on set. It's great to have you on the show. Welcome, welcome. Let's start with Walmart.
Yeah, nice job on my last name, by the way. You got it. So.
Yes.
Yeah, so with Walmart, it's interesting. It's a 4.5% implied move for earnings today, which is pretty typical of the stock. Target last night, they reported good earnings. They're up 4.2% last time I checked, so a good pulse there. And now Walmart has missed 4 out of the last 5 earnings, so they've had negative reaction, is what is typical. And I think what is different this time about earnings is that the stock has a bullish lean in the options market. We call this a call skew. And so investors are looking for a pop here, or at least the option traders are looking for a pop in the stock here. And that's a bit different because in May, as you mentioned before, there was a bearish lean in the options market, and the stock actually dropped 7% after that May earnings report. So a different tone here this morning, and options market is definitely looking a little more bullish, I would say, into this earnings report.
Okay, cool. We'll have to see what we got the print here in just a short while. In the meantime, we just talked about SpaceX. I do want to get your thoughts on what we're seeing there.
Yeah, there's the 300 million share lockup, as you alluded to today. And I think the key thing here is to reiterate that these are shares that are becoming available to trade. They're not new shares, so it's not dilutive. And there's a lot of talk about the 9 million shares from earlier this month. And actually, the stock, as you mentioned before, it made its all-time low on August 5th. That bigger lockup was August 6th. And so the stock's just traded up since then. And a lot of people were nervous that new supply would keep the price down, but it's not. It's actually the stock has done pretty well. Now, the key thing to watch from the options market is that 150 level. That's a key resistance line because when we see that stock move up that level, option traders have been selling calls at or above that strike, that 150 area. And so that we see as a key kind of resistance or ceiling level at this point.
Interesting. Every time the stock's tried to breach it, it's bounced back lower again, to your point. Okay, I do want to talk about what else we're seeing in the market more broadly here. Let's start with VIX expiration, because there's been some chatter that this has potentially, this dynamic has potentially tamped down some of the volatility and some of the demand we've seen.
Yeah, and if you were to just look at a chart of the VIX over time, you can actually mark the lows in the VIX at expiration, which was yesterday. So yesterday, 40% of VIX contracts expired. And the argument there is that the contracts reduce volatility because traders are selling VIX or selling volatility into these expirations, and that helps to support stock and kind of keeps volatility quiet. And at expiration, positions unwind, which allows volatility to expand. It's kind of like breathing in and out a little bit. And so what's kind of key about this is that the VIX expiration happens yesterday, tomorrow's options expiration. And so you're allowing the market to potentially move a bit more now. Really big event next week. We have PCE, corporate next week. We have 6 weeks, and of course, the timing of volatility starts with positions rolling off yesterday and a bunch of these events next week, I think is really critical for investors to take note of. Okay, a lot here going into the final week of trading for August next week. No summer slowdown here. That's
Frank
right.
Kashuba, great to have you on.
Thank you so much.
Well, straight ahead, we've got the Morning Call crew teeing up the trading day ahead.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC+.
I built a legacy on the court, and now is the moment to build a legacy outside of the court. My main investments are in hospitality, in education, and sports. So I believe that's the future. I see my brand as in a growing perspective, and in some way building this new chapter.
You'd been managing a very rare condition in your foot for much of your career. At what point do you think you seriously started to think about life beyond tennis?
You need to have goals. I think it's very important in this life to have goals ahead of you, because that helps you to wake up every day with motivation and passion. I knew since a long time ago that I wanted to keep doing things and learning after my tennis career. I have 2 small kids, and that's the most important thing of my life, without a doubt. But I like to work. That's how I understand this life.
As the Asia trading day begins, join me for Squawk Box Asia. What are you watching? Nobody would be thinking that level of a benchmark is possible. We're live across the region, covering what you need to know from here and around the world that would shape the business day.
We know there's 2 winners in AI. It's going to be China, US.
Let's stay away from these companies that are selling it at 40, 50 times sales.
Join me for Squawk Box Asia, only on CNBC.
on market-shaping industries. We are watching the six little dragons, the first to be listing in the Hong Kong market, supply chains, and global momentum.
Do you feel pressure to create the next Labubu soon?
This really is a business-first pivot, despite the geopolitical strains. The China Connection, weekdays.
The trade heads are gathering against the backdrop of the global energy crisis.
CNBC.com and the app anytime. Let's get to your headlines. Only on CNBC, connecting you with China.
Welcome to Closing Bell Overtime.
Get the essential post-market edge.
A very busy overtime.
After-hours action and opportunities.
The economic impact is just beginning.
What happened today?
The market had to resort to defense.
We've got a developing story out of Washington.
What's moving in real time?
What did the numbers tell you, pro or con?
Be ready for tomorrow after the bell.
There's a wait and see about a lot of things for tomorrow, Mike.
Completely.
Melissa Lee, Mike Santoli. Closing Bell Overtime. CNBC.
Welcome back. Alibaba results are out and shares are lower, about 4% right now. The China-based e-commerce giant saw revenue come in above analyst estimates, but the bottom line was slightly short of forecasts. Baba did say that growth in cloud revenue accelerated 45%, and AI-related product revenue grew at a triple-digit pace for the 12th consecutive quarter. Kind of a similar dynamic, arguably, to what we saw with Baidu when they reported earlier this week as well, that acceleration in cloud and AI. Well, time for your call sheet, where we look at the topics driving the trading day ahead. Crew members today, Jay Woods of Freedom Capital Markets, Hardika Singh of Fundstrat, and Stephanie Link of Hightower. Jay and Stephanie are both CNBC contributors. All right, I keep waiting for summer slowdown. We're not getting it. So, of course, I'm going to start right there with, and Jay, I'm going to put this to you. The Treasury announcement we got yesterday, some folks referring to it as Operation Twist. We can, debate how symbolic it is versus actually, fundamentally meaningful to the market. Regardless, big moves in asset classes. What does it mean for the bond market? What does it mean for rates? What does it mean for everything else?
Yeah, well, it's tempered the long end, so that is something that the Trump administration had been watching closely. But I would look at it from the equity point of view, from the commodity point of view. Where do you go? Where's the new strength? And we've always looked at Bitcoin, like, where is it correlated to? Gold was going up, Bitcoin was going down. Well, we finally found a correlation, at least for the time being. But Bitcoin technically just broke out. It looks like it's on a run to 77, 80,000. And then gold. When you look at gold and now copper, Freeport-McMoRan individually, on the verge of a major breakout, this is where the strength is. And then, the home builders, for a short-term play, we've got a nice little floor under there. So I like Toll and Lennar in the home building side.
Yeah, you could also argue that this actually lifted Lowe's shares yesterday, despite, print yesterday morning that was not necessarily the best here. It was certainly a little disappointing if you compared it against Home Depot. I want to get your thoughts on all of this, Hardika.
I think at the end of the day, it doesn't really change anything, right? I don't see how Besant could continue this buyback going at a greater scale. For starters, $4 billion is not a large amount. And then secondly, I just think that if he wants to continue buying back longer dated bonds, he's going to have to issue more short dated. And that's just going to make this whole growing deficit problem worse. We hit $40 trillion for the U.S. debt yesterday. That's a big, round, juicy number. And I think that if we have more shorter dated bonds issued, I think that's going to hurt the prices and yields are going to go up. And again, that's just going to keep increasing the deficit. So it fails to solve the underlying problem, which is that the deficit keeps growing and investors are losing hopes that it'll ever get paid back.
Yeah. Stephanie, I want to get your thoughts on this. And yes, $40 trillion, it's a big, alarming, juicy, to use the word Hardika just used, number. How do you take that? How do you take corporate debt issuance? How do you take, what we've seen with the Strait of Hormuz and geopolitics and energy? How you put it all together, and also the role that central banks can or cannot play in all of this when you talk about things like supply shocks. You put it all together, what does it mean? How do you navigate it as an investor right now?
Well, the Treasury is absolutely watching yields between what they did with Japan and then what they did yesterday. And I think they're prepared to do more. That being said, maybe it stabilizes the 10-year and the 30-year temporarily, but it doesn't change the tidal wave of hyperscalers and their issuance of debt. and doesn't change the deficits. It doesn't change the elevated inflation. And I would also add, I think the bond market also, at least the long end, was rising. Yields were rising because the economic growth is better than expected. And so I think there's a lot of things that are in play in the bond market at this moment in time. What I care about mostly is what is the economy growing at? And right now we're growing something around 4.5%, according to the Atlanta Fed tracker. And we know there's an AI boom that's continuing to help the economic growth. The consumer is consuming, as we got data points from Target and Estee Lauder yesterday. Housing is obviously struggling. It will continue to struggle. But I think adding it all up, I think earnings growth is going to continue to grow in the double digits, and that's positive for equities.
What does it mean for Walmart, Jay?
What does it mean for Walmart? We're going to find out in a little while. I think that Target report was unbelievable, and I think that's more a testament to what the new CEO, Michael Fidelke, has done there. Stock up over 60%. Now, watch 160, 165, major resistance over the long-term base, but that turnaround has been nothing short of spectacular. Walmart is going to give us a real good look into the consumer. TJ Maxx a little disappointing, but Walmart is struggling right now, but near term going into this number, it's been starting to come back. So let's see if we can get back above key levels. 118 is the level I'm watching. If we can recapture that, then maybe we make a run back to the all-time highs. But it will give us more of an idea of what that consumer is doing and how the economy has been affecting them. And so far, we haven't seen any real negative effects.
Yeah, and right now we're trading pre-market here up about 0.5%. I think 114.80 is the level, to your point, in Walmart ahead of this print. The other piece, and we talk about grocery, we talk about consumer with Walmart. The other piece of Walmart is how much it's been spending to deploy AI. I think it's sort of a good early test case of, productivity gains and, how the technology is going to grow tentacles and reach into different parts of different businesses. So in light of that, what should we be looking for when it comes to that? And by the way, I'd make a similar case for Deere, which is also reporting this morning.
I agree. And I think companies like Walmart, Deere, Caterpillar, they have really been the beneficiaries of this AI boom. And if you take a step back, this is what AI was supposed to do all along. AI was supposed to benefit companies outside of the tech industry as well. And I think with Walmart, they have just really benefited from this K-shaped economy, where we have this lessening middle class, and then we have lower income class that is looking to spend more and more, or even higher income consumers who are flocking to Walmart for its deals. Whereas in Target's case, for example, I'm just not sure who their consumer base is. So their stock coming back up is potentially reflecting this middle class that's coming back to spending on discretionary goods. With Deere's case, I think that, it's a great manufacturing boom at the end of the day. And it's reflective of this data center boom that we're seeing across the country play out.
Yeah. Okay. Deere, Walmart, also SpaceX with another lockup expiration. Today we got 30 seconds. Stephanie.
I like SpaceX. I would be buying it on weakness. I think there's many ways that they can win. It's either AI, it's connectivity, it's space. The last quarter was phenomenal. So it's, I think for the long term, I think you want to be buying it.
All right. Look at that. We're on time. Thank you to our call crew. Appreciate it. And if we take a check at futures right now, I believe it's a mixed picture here, although, yeah, it's a mixed picture. S&P and Dow poised to open lower, the NASDAQ slightly higher. Thank you to our morning call crew, and Squawk Box starts now.
Good morning. President Trump shifting his threats on Iran from military back to economic, saying the country is in for an economic D-Day. Meantime, the U.S. is said to be secretly guiding oil tankers through the Strait of Hormuz to bring millions, of barrels of crude to the market. And retail earnings roll on. We're expecting second quarter numbers from industry bellwether Walmart. It's Thursday, August 20th, 2026. And Squawk Box begins right now. Good morning and welcome to Squawk Box here on CNBC, live from the NASDAQ market site in Times Square. I'm Kelly Evans. Joe and Becky are off today. U.S. equity futures at this hour, as Morgan mentioned, a little bit of a mixed picture. We see the Dow dropping about 100 points, the S&P down 6, the NASDAQ rising, though. Take a look across the other parts of the markets like energy, where we can see there The reaction in oil prices, or lack thereof, a little bit. WTI up nearly 3% after the president's threats about economic action against Iran. Brent 94 up 2.5%. RBOB gasoline down a bit. Nat gas too. For Treasury yields, again, here's a focus. Yesterday, after that big announcement from the Treasury, we saw the 10-year yield decline about 4 basis points on the session. 467 today, so a slight uptick there. The 2-year 418, let's call it. The 30-year 522. Bitcoin, Ether, and other cryptocurrencies were certainly jumping after the president he urged Congress to pass the Clarity Act and after the actions by Treasury yesterday. But on the Clarity Act front, Bitcoin is now across 70 to 71,000, another 5% this morning. Ether, 8.5, Solana, Ripple. For those who are following, those are jumping as well. We'll talk more about it with Coinbase CEO Brian Armstrong at around 8:40 a.m. Eastern. President Trump announcing he's ramping up economic pressure on Iran. In a Truth Social post, the president called the move an economic D-Day, and in his words, quote, the most crushing economic operation ever taken against any country. He said, I am also announcing that any country that allows its financial institutions, businesses, airports, or government entities to provide any type of lifeline to Iran will itself face tremendous economic consequences. Now, Iran's foreign minister rejected the president's threat, calling it a diversion from America's own mounting debt problem and rising interest costs. And the U.S. military has reportedly set up a shipping lane along the coast of Oman and is helping guide oil tankers into and out of the Persian Gulf through the Strait of Hormuz. An Axios report says in recent weeks, 15 to 20 tankers have entered and exited the strait each night, bringing about 10 to 20 million barrels of crude oil to the market daily. If you've been wondering, as many of us have, why the oil price is so well behaved during this time. According to the Axios report, the military has been helping the ships enter the strait in one big line to pick up oil and exit in another big line. Prior to the Iran war, remember, about 20% of the world's daily oil supply moved through the Strait of Hormuz, Andrew.
It's pretty crazy.
Yeah.
We are at a pretty crazy time.
But that's significant. I mean, that much oil on the market is a big deal. Potential progress also being made on a tariff standoff between the United States and Canada. Reports say the U.S. is considering lowering tariffs on Canadian steel and aluminum exports to 25% from 50% and cutting car tariffs to 15% from 25%. The developments follow President Trump's announcement Tuesday night that he was pausing tariffs for 3 days. Yesterday on X, Canadian Prime Minister Mark Carney said there had been, in his words, significant progress in trade negotiations.
And then there's this. We got to talk about this because this is the story. U.S. government debt climbing above $40 trillion. That's according to the Treasury Department. Meanwhile, years of escalating budget deficits, as you know, juiced by government stimulus during COVID, have caused ever more government red ink. 10 years ago, public debt was about half of what it is now. U.S. finances are $1.8 trillion in the hole so far this year. And then, of course, there is the Besant move about what to do about our debt. And there's so many people who seem to have so many views. Some people who think he's Alexander Hamilton and this is genius. Other people who think that this is ruinous.
Right.
And I actually am not sure I have come up with a view yet.
Well, let's put it this way. If you were in his position, you could understand why he's doing what he's doing, because in some ways his job is to try to keep, yields down, so that's fine. Will it work?
Well, and this is the question.
I don't know.
Not
a big reaction in the markets.
Famously a trader. That's what he's done.
Yeah.
And this is a trade move of sorts. By the way, people have done things like this. You go back.
It started with
in
Yellen.
history. Well, actually, when I went back and looked, Larry Summers
because we were running
doing
surpluses.
Some of this
yes, at the
time. Back at the beginning of the century, because we were running surpluses.
Yes.
I shouldn't say the beginning of the century. I'd say the beginning of 1990. I want to say in the 90s.
Probably turn of the century. I think that's when we started.
Was
to
that
see
when?
I think so. Yeah.
Because we started to see that the deficit was actually getting better, and there was a worry about just the liquidity in the marketplace on the other end.
Yeah.
So it is fascinating, but.
Unfortunately, now this is under very different circumstances. And again, when Yellen, if you go back and look, maybe we can quickly show the 10-year yield going back to sort of been the end of 23, maybe the beginning of 24. So maybe they announced it in November of 23.
Right.
They were going to do this. And you saw a drop in the 10-year yield all the way. They implemented it starting in May of the following year. And yeah, we went from, it made a difference. So then it's been taken up at various times since then. And look, again, it's undeniable that by shifting, well, all they're doing is they're going to retire, buy back the longer term debt, issue to match the, they're issuing shorter term debt to replace it. That will make us more vulnerable to moves in interest rates. If that's to the downside, great. If it's to the upside.
Well, and that's the question. But it seems like in this moment that this is like trading a 30-year mortgage at a decent rate for a 5-year ARM.
Yeah.
That might
maybe
look
a 90-day ARM.
Right.
Yeah.
That might look better in this moment, but when the ARM part starts, things get complicated.
This is why those who would defend the say it makes a certain amount of sense. Because from a pure taxpayer trade, fine, it saves money. But if it backfires, because we're papering over the real problems, and I thought the whole point of Warsh's Fed was to let yields go to their long-term kind of resting point in order to force kind of the fiscal discipline.
We'll discuss a lot more of this. We've got 3 more hours of conversation pretty much about this topic. We're basically doing a special on this. But President Trump also calling on Congress to lay out clear-cut rules for the crypto industry at a White House gathering that included the CEOs of Coinbase, Robinhood, and others. The president saying lawmakers should pass the Clarity Act, which would define which types of cryptocurrencies are securities and which are commodities. It would also delineate who's in charge of regulating crypto. We should give a shout out to Adina Friedman there from the NASDAQ, also on the screen. The legislation currently stalled in the Senate, though. One potential stumbling block, lawmakers who are nervous about President Trump profiting off of his crypto ventures. And we're going to speak with Coinbase CEO Brian Armstrong in today's 8 a.m. hour all about this. So it's a conversation you do not want to miss.
And then there was this. The Fed eyeing possible interest rate hikes as it monitors the price of U.S. goods. This was in the release of the minutes yesterday from the central bank's meeting last month. Officials said they would need to raise rates soon unless they saw more progress on bringing down inflation. A summary of the meeting stated that some participants commented that financial conditions might not currently be sufficiently restrictive to facilitate a return of inflation to 2%. The Fed voted 9-3 to keep the federal funds rate steady. The minutes noted last month's dissenters wanted a 0.25 percentage point rate hike and said they judged that doing so, quote, would likely help forestall the need for a steeper and potentially more costly sequence of tightening moves at a later stage.
A little color to add to this. I was out at this Aspen Economic Group summit that took place a couple weeks ago, and there were a whole number of FOMC members there. You might remember Neil Kashkari came on our air, along with a whole bunch of Treasury secretaries as well. And this was right as this had just happened. And you could tell, just in the air, without giving away sources or what have you, that there was much more dissension on the board than just those 3. That there was a much greater view to increase interest rates. And I was trying to get some of those people to sort of say that on the air. They wouldn't, but what I'm suggesting is that there seemed to, and I think part of it is that, Kevin Warsh got into this job, has the mandate, public mandate that he's at least discussed publicly, and there's a little bit of a honeymoon period, I think, for him, in that there were, I think, some people who might have even been willing or wanting to vote for higher rates last time and felt like,
we'll give him another meeting.
We're going to wait this out a little bit.
Yeah.
So I think it's going to be just very interesting to see how quickly things turn. And I think, by the way, they are waiting for the data. They're all praying for the data to turn to be in a positive direction, so they don't have to.
Well, he's got pressure on both sides now because the president pushing again on lower rates. The rest of the committee may be pushing for higher. Did you see also? They might pare back the number of meetings. And this I'd be curious to talk to our guests about today. But I think from 8 to 6, like Rebecca Patterson was saying yesterday, as long as it's at least 6, they don't need to go to Congress. I do not like fewer Fed meetings. And this is why I want people's point of view on this. But it seems to me that it'd be better to let the funds rate move around a little bit more than to leave it pegged at whatever it's pegged at for a longer period of time. That's just me. I don't know.
Look, my sense of it, and I was sort of actually persuaded out in Aspen about this, is that you could put 6 on the books, and you could always do 8. You could always do 9.
But if you have an intermeeting, the bar is so high.
Yes, if you do have if you have an extra meeting, that's also typically a problem.
Yes.
A lot more to come on that and more. We're going to go inside the U.S. bond rout that's being felt across the globe. The U.S. Treasury is attempting to bring down yields. A top fixed income portfolio manager from J.P. Morgan is going to join us next. We're going to get into all of this to really dig into what's going on. And ahead of all that, we are paying attention to shares of Walmart because second quarter results due out from the retail giant. That's happening at 7 a.m. Eastern time. We've got a big morning, folks. We're going to bring you those numbers and analysis. Do not go anywhere. Squawk Box rolling on after this.
From London, Paris, Munich, and Milan.
We've seen very strong demand all summer long.
End users are using our AI even more frequently.
Are you heading into a record Q4? We are gearing up for the biggest IPO of the year.
Prime Minister, it's a pleasure to be back in Athens.
It's a pleasure to talk to you.
This is becoming a very competitive market in the EV space.
Parliament continues to stay very fragmented. This Bank of England decision certainly got more interesting over the last couple of months. Here's what investors are watching this morning.
American soccer legend Landon Donovan. He'll explain how the 2026 World Cup could shape the future of Major League Soccer and the inner demons that drove him to greatness.
I was constantly chasing this insatiable desire to be noticed.
He's the man behind Apple's sports ambitions. In an exclusive interview, we talk about the tech giant's unique sports strategy and whether a blockbuster acquisition is on the horizon. This is CNBC Sport on the Record.
Kelly Evans with in-depth reporting and analysis. Strengthen your investment strategy on The Exchange. Streaming on CNBC Plus.
Football needed cash, crypto needed credibility.
Blinded by the check.
Together they created a sponsorship gold rush. Then the market turned, sponsors disappeared, fan tokens plunged.
So I kind of made us the rebel anarchist Bitcoin team.
Regulators started asking questions, but crypto never left football.
I'm interested in both. I'm a Bitcoiner and I'm a football supporter.
The Score, streaming now on CNBC.com and YouTube.
Welcome back this morning, and let's focus in again on Treasury yields. 467 is the 10-year this morning. We pulled back a little bit yesterday after the Treasury Department said it would increase the size of its government debt repurchases. For her insights on the bond market action and on the Fed minutes, let's bring in Kelsey Barrow, fixed income portfolio manager at JP Morgan Asset Management. It's great to see you, Kelsey, again. What happens when announcements like this come down for you? Are you just like, how big of a deal is this?
So it was a surprise. So to take a step back, typically what happens when the Treasury wants to make a change, either to their issuance program or their buyback program, they're going to make that announcement at a quarterly refunding. We just had a quarterly refunding in August. We don't have another one until November. So no one was coming in and saying this is something that was on our bingo cards. Now, that being said, there has been a lot of talk over the last few weeks about what could possibly stabilize the long end of the yield curve.
Because everyone's watching the 30-year go to 533. Again, not that the 30-year is like the most important thing in the world, but it just tells you where, things are getting a little illiquid.
Right, exactly. And so I would say, so the way that these buybacks work is there's really two purposes that have been stated: cash management and liquidity support. This was under the guise of liquidity support, but really we weren't seeing a lot of liquidity issues within the bond market. We're seeing a material repricing higher in long end yield that's been happening, I would say, fairly gradually over a number of weeks and months, not necessarily liquidity concerns.
People just don't want to own it at these levels.
What it signals is that the Treasury is looking at the yield level.
Right.
That's obviously what is influencing that decision. So I think what we need to do is we need to think about what got us to these yield levels and what could the catalyst be to stabilize yields, and will this announcement from the Treasury be enough to stabilize yields? As it relates to what drove us here, I don't think that it should be lost on people that what really started this regime shift was the war in Iran.
Right.
It was the closure of the Strait. It changed the risks and the balance of risks around inflation. Now, even this morning, I've been looking at oil prices, and they're actually starting to climb higher again. So we're not out of the woods from that situation. The other thing that has changed over the summer is we got a new Fed chair. And this would be a difficult environment for anyone, even if we had continuity in leadership. But we have it. We have a new Fed chair. The market is still understanding what his reaction function is, and that has also injected a lot of term premium into the market. Now, what
you think there's term premium? So I'm surprised by.
So I would say yes for term premium, and there are a couple reasons why. When you look at the repricing, a few things really stand out to me. One, inflation expectations remain extremely well anchored. So this move higher really hasn't been, at least according to the bond market pricing, a fear around runaway inflation. The second thing is the pricing of the terminal rate. So how high the Fed funds rate is going to get in this cycle, that has actually stayed fairly stable. So if the market was really sending a signal that the economy was overheating, the Fed policy rate was in the completely wrong place, I would expect market pricing of the terminal rate to come up a lot. That's why when you eliminate those two things, you get to this term premium type of discussion that we're having. Now, how do you stabilize yields, right? I heard you guys.
How would you, by the way, explain what to me? When I think of term premium, I think as people don't want to hold this stuff, as much as they. How would you explain it in sort of lay terms?
I mean, I think that's fair. What you're getting at, in essence, is the additional compensation that investors require to hold longer dated bonds. And it's that additional compensation. Why do you need that additional compensation? Well, there's a variety of factors. It could be the uncertainty around the geopolitical environment. It could be the uncertainty around the Fed framework. It could be the deficits, the corporate supply. Term premium can incorporate a lot of different things.
Some argue that it's because we have so much issuance of AI debt that people don't want to own long-term treasuries. I'm not sure that I buy that, but that may be the case. I don't know. In which case, this is a totally different discussion than anything that has to do with the deficit.
So one thing that is different, I would say, about this move higher in yields relative to last year around Liberation Day is that when these yields are moving higher, you're seeing incremental demand within the fixed income market. So people are looking at these higher yields and they are saying, actually, these are attractive. So the flows are continuing to be positive within fixed income. And that is something that is different from last year when you saw a lot of concerns around Sell America and the dollar debasement trade. This is a bit of a different flavor, and it has to do with the fact that the underlying growth fundamentals of the U.S. economy have been very strong. We just got through an earnings season where people really couldn't poke holes in the results that we got from corporate America.
So when you look at this situation and what the administration announced yesterday, long term, do you think that this instills confidence? Because you say to yourself, we've got a great Treasury Secretary who is a trader with expertise, who's going to manage our bills better? Or do you say this is a administration, and I don't know if it's an administration, but you could take the politics out of it, but we are now in a situation where we are involved and engaged in financial engineering, and that not only is not going to instill confidence, that it is going to undermine confidence longer term?
So the Treasury has a set of tools in their toolkit. This is not a new tool. They've been doing buybacks since 2024. They've opened the door to do more, I think, in a way that can instill some near-term stability. But ultimately, these yields or lower yields can't be sustained unless it's supported by the fundamentals. And that's why you have to get back to what is the trend for growth, what is the trend for inflation, what is the framework for the Federal Reserve. That's what's going to ultimately drive yields. And if you look at October 2023 and that period of time where you had the move higher in yields, the Treasury stepped in. It wasn't just the Treasury. It was also the fact that the data came in softer, the Fed shifted their communication. It's never just one thing.
Yeah, you need a lollipop. Let me ask you before we go quickly, what is your theory or philosophy of Fed funds rates move? I think it'd be nice for the Fed funds rate to move a little bit more, up and down. That this is a pipe dream. Maybe it's silly. But I ask because if there's fewer Fed meetings and the Fed funds rate is left where it is for longer periods of time, even just a couple weeks here and there, is that a big deal to you? Is that appropriate?
So I noticed that in the FOMC minutes, which also came out yesterday, but they really felt like a sideshow, to be fair. All of the price action came on the Treasury announcement. It didn't come on the FOMC meeting minutes. I would say the 8 meetings make sense to me. If you remove some of them, the current structure makes sense to me. If you remove some of them, the market's still going to want information between meetings. And instead, they'll listen to whoever will speak in between.
Kelsey, really appreciate it. Thanks. We'll check back in. That's so eventful for a fixed income strategist. Kelsey Barrow.
Coming up, President Trump weighing in on the data center boom that's seeing facilities pop up around the country. One of the reasons that some people are saying so much money might be moving there instead of Treasuries. Another part of that debate. We're going to bring you the president's remarks after the break.
Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving? The biggest guests, the market action.
Right here.
Squawk on the Street, CNBC.
Edge just opened up in Europe with a French government cooperation agreement as well. How significant is that deal for Edge and for Abu Dhabi?
Europe is where the next budgets are. We would like to contribute to the security of Europe. We feel that we have a value. We feel that Europe have recognized this value by accepting us into Europe. These are facts. We have a very nice footprint in Europe, and this would have not been possible if the UAE wasn't accepted in Europe as a partner, knowing and trustworthy with NATO and the way we firewall things. Plus, you need another player in Europe. Even the big players today, we're working with them. There is always these collaborations, but they only start when you put your ego aside. There is always someone better than you. And you need to be on this learning curve forever.
From the markets to the courts, kick back and relax while we serve up the highlights. Tackle your weekend. This weekend, race to your screen. The adventure continues. Dive into the action with CNBC Sports. CNBC Sports, afternoons on Saturday and Sunday, only on CNBC.
Fast Money is America's post-game show.
Basically, near all-time highs against the S&P.
Every single story that we pick is a tie back to the markets.
Those sort of revenue streams don't trade at a great multiple.
We want to arm people with the information to make great decisions.
Stock got whacked. I get it. People say they overpaid. I get that.
Fast Money is all about the chemistry. We've been successful for this long because we're a team.
Fast Money, CNBC, streaming on CNBC Plus.
You know, for me, ambition and passion go together. One fuels the other. You love something, you want to get better at it. You want to learn more about it. And I think CNBC allows our viewers to fulfill their passions. There's no doubt that the people who watch us care. I am very much focused on trying to land interviews where there is something at stake and asking them fair but tough questions in which their answers are important. I could not imagine covering anything else.
Welcome back to Squawk Box. President Trump weighing in on data centers being built across the country. The facilities have sparked intense debate in communities worried about tech companies using local resources and causing potential electricity price spikes. Here's what the president said yesterday about it.
We're building the biggest plants anywhere in the world. And I can say if I were the mayor of a town or the governor of a state and I had a chance to get a big plant in, an AI plant or a data center, I would absolutely want it because the jobs are enormous and the money paid, the taxes paid are just enormous. And if you don't take it, you're going to be left behind because there are plenty of places that want it.
We're going to talk a lot more about the politics of data centers and the potential impact on the midterm elections with well-known pollster Frank Luntz in the next hour.
A lot to ask
A lot to talk to him about.
Including the polls in the Midwest. So anyway, we're watching Merck and Moderna after those positive initial trial results for their experimental cancer vaccine. That caused shares of Moderna to soar yesterday. 177% higher is where it ended the day. Meanwhile, Merck, a Dow component, was up 12.5%. The mRNA-based shot, in combination with Merck's immunotherapy called Keytruda, met key goals in a trial of patients with higher risk or advanced melanoma, whose detectable cancer had been removed through surgery. We'll talk more about this with an analyst in the next half hour, but finally, just such a great feel-good story. No one come up with a bad thing to say about this, just all good news. Coming up, President Trump threatening Iran with economic ruin as the war with that country nears 6 months in length. We'll have more after a break, but first, a look at yesterday's S&P 500 winners and losers.
You can master your strategy, but performance could be limited by your instrument. Precision trading starts with the right instrument. Over the past 3 years, Interactive Brokers clients outperformed the S&P 500 on average. Like returns, trading costs compound. Interactive Brokers is built to lower costs through smarter execution. Access stocks, options, prediction markets, and more across 170+ global markets. The best informed investors choose Interactive Brokers.
Squawk Box, streaming on CNBC Plus.
One of the world's largest private climate investment vehicles, Altera, aims to mobilize $250 billion by 2030.
What we're trying to show is that we can align those objectives and we can make money doing it.
Clean energy, emerging markets, even the AI boom. The opportunities are vast, but how do you pick the right investments?
We have people who specialize in these investments, and that's what makes Altera unique. That's our secret sauce.
Find out more on the next Managing Middle East.
I built a legacy on the court, and now it's the moment to build a legacy outside of the court. My main investments are in hospitality, in education and sports. So I believe that's the future. I see my brand as in a growing perspective and in some way building this new chapter.
You'd been managing a very rare condition in your foot for much of your career. At what point do you think you seriously started to think about life beyond tennis?
You need to have goals. I think it's very important in this life to have goals ahead of you, because that helps you to wake up every day with motivation and passion. I knew since a long time ago that I wanted to keep doing things and learning after my tennis career. I have 2 small kids, and that's the most important thing of my life, without a doubt. But I like to work. That's how I understand this life.
Good morning and welcome back to Squawk Box. We are live here at the NASDAQ market site in Times Square. Checking the futures, a bit of red on the screen this morning. Dow was down triple digits, now down 74. S&P only down a couple points. The NASDAQ, Andrew, still in the green, about a 46-point gain.
Meantime, President Trump threatening Iran with an economic D-Day. Eamon Javers joins us with the latest on that. Good morning, Eamon.
Yeah, good morning to you, Andrew. President Trump declared economic warfare last night. Islamic Republic, that said to make a deal than me. Tragically for them, they have failed to take it. Therefore, today I am announcing the most crushing economic operation ever taken against any country. This will be economic warfare and isolation on an unprecedented scale. Their navy is gone, their air force is destroyed, their military factories are now rubble, their currency is worthless, and their country is hanging by a thread. Today I am also announcing that any country that allows its financial institutions, businesses, airports, or government entities to provide any type of lifeline to Iran will itself face tremendous economic consequences. Oil smuggling, swap lines, cash transfers, exchange houses, ship registries, front companies. It all needs to stop now. That's the president on social media last night. Now, the challenge for the president, Andrew, is that Iran already is one of the most heavily sanctioned economies in the world, and it has been for years, and those sanctions have not been enough so far to change the decision-making of Iranian leaders. And we saw a response last night from Iran. Iran's foreign minister had this to say overnight on social media. He said, the so-called economic D-Day is a diversion from America's own crisis. Unprecedented debt and surging interest costs, doubling down on failed policies will only bring further defeat and enmity of Iranians. U.S. economic terrorism threatens global economy and sovereignty worldwide. So, Andrew, some tough words from the Iranians. And in that social media post from the Iranians overnight, they linked to a series of Western media articles about the U.S. soaring debt hitting $40 trillion. So the Iranians are saying, you know, look, if you want to play economic warfare, we can do that too. And of course, the irony in all of this is that the Iranians have largely been waging an economic warfare campaign against the United States for the duration of this war, choking off the Strait of Hormuz. Not really a military or strategic effort. It is an effort to clamp down on the global economy and have economic consequences for the U.S.
Eamon, how much of that link do you think has been made? We just had a bond analyst on the broadcast really talking about interest rates and in particular what Scott Bessent did yesterday in terms of trying to bring down that rate on the long end. And I'm just not sure how much in Washington that conversation is happening, this sort of link between what the war in Iran has done to this economy and how connected these things are.
Yeah, I don't think that conversation is happening in Washington, at least not publicly. Washington is
pretty good at putting the blinders on, right? And when it comes particularly to the national debt, both parties have continued to spend when they're in power, even if they rail against spending when they're out of power. The history shows that the spending goes up dramatically each term, no matter who's in power. It's just easier for politicians to spend money and give away goodies to political groups than it is to tighten the reins and disappoint people, right? I mean, if you're a politician, you're campaigning for votes, you don't want to disappoint anybody. The easiest way to do that is to spread the money around. And so as a result, what you don't hear is any real serious effort to deal with the debt and to try to rein in some of these things that are concerning the bond market. The Iran war, you know, a lot of the conversation about the Iran war has been in terms of the depletion of military supplies, missiles and that sort of thing, and some of the impact that the Iranians have had by hitting American supply depots in the Middle East strategically, but not really about the economic cost of this war and whether it's sustainable over the long term. At some point, though, if there is a pain point, Washington will respond. You know, the benefit of being this big global superpower is that there hasn't been a pain point so far, and so they haven't had to respond. At some point, that will be coming if this path, you know, is sustained, and it's going to hurt for a lot of people.
It's in the bond market, according to our last guest, you know, and that obviously we'll see if that's why we're seeing more pressure come. Eamon, thanks very much for now. Appreciate it. Eamon Javers.
You bet.
Coming up, OpenAI scaling back training of its newest AI models as the industry focuses more on security. Meantime, its CFO is updating employees on its IPO plans. We'll talk about it all when Squawk Box comes right back.
One hour of added insight every morning doesn't just add up, it compounds. One extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC.
Never miss a moment.
We think there is a huge opportunity for AI in the UK and Europe because it is that middle ground between the United States and China.
Andy Burnham has committed himself to the Labour manifesto, so I don't think that that's going to change in the immediate future. I think our historic destiny is to be back in the European Union.
The world is taking you at your word, sir. What happens next?
We're never going to see Iran have a nuclear weapon.
I grew up a news junkie. It's really the only thing I ever wanted to do. I like holding people to account. You can't just show up and say, I like XYZ stock, because I'm going to ask you why. And then if you say you sold it, I'm going to say, well, why'd you sell? Get away from talking your book and tell me the real story. Ambition is a fuel and a fire. They call me the judge for a reason. I'm supposed to make people squirm as long as I get the goods at the end of the day. We're talking about people's money. I feel the weight of that, the responsibility, and I love it.
From the markets to the courts. Kick back and relax while we serve up the highlights. Tackle your weekend. CNBC Sports, afternoons on Saturday and Sunday, only on CNBC.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell, weekdays streaming on CNBC Plus.
Welcome back. The private fintech giant Stripe says it plans to acquire OpenRouter. The New York Times put the cost of the deal at $7.5 billion. Less than 3 months ago, OpenRouter raised money at a $1.3 billion valuation. What is OpenRouter? It helps businesses route and optimize AI token usage. It has become more popular with developers looking to use free, non-proprietary AI models. And in many ways, Andrew, represents this whole back and forth between is it Anthropic, is it OpenAI? OpenRouter helps it be all of the above. Fascinating to me that Stripe moved on this yesterday, and that it's Stripe, and they kind of gave an explainer as to why. I'm not sure I fully followed, but something about the singularity in the next phase of the internet.
So this is a fascinating deal. There's a number of companies that are trying to do things like this, like what OpenRouter is. There's a version of it, Ramp, for example.
Made that acquisition last night.
Is trying to effectively use its, Ramp tracks financials inside enterprise, and they're looking and saying, okay, you're token maxing, you're spending too much.
Right.
You should be using a different model for this kind of question.
Genius, brilliant.
So I think there's a whole, by the way, Perplexity on the consumer side, that's kind of what it is trying to do now. It's trying to move you between models depending on the question that you're asking. So the only thing that I can't figure out about all of this longer term is whether all of these sort of layers on top of these models will have value, or whether the model makers themselves will somehow do a lot of this.
I imagine it bails out OpenAI to some extent. And again, it sounds like, and we'll talk about this, it sounds like their revenue picking up a little bit, but to the extent that some third party is routing you around to everybody, the only thing I wonder about is where do the Chinese models fit in if they're a little bit cheaper? And that's the only thing I wonder about, Well,
that's going to be a part of it, right? And then the other piece of it is going to be the memory piece. So there is a big question about how all of these kind of layers deal with memory. You can have your own data sets behind it, but the memory, so every time you ask a particular kind of question, if you're using Anthropic specifically or OpenAI, it's remembering your own preferences. It's learning in the moment as well about what you asked before. It's much more complicated to capture the memory if you're doing it and moving people from model to model.
Yeah, true.
So
it's a great point.
Meantime, OpenAI's CFO giving employees an update on when the startup may make its highly anticipated debut on the public exchanges. Sources telling CNBC that Sarah Friar told employees during all-hands meeting yesterday the company will be a public company in 2027, but it could also debut sooner if, in her words, our business continues to inflect. OpenAI confidentially filed an IPO prospectus in June, and all of the source checking that I've had suggests sometime early
2027.
In 2027. I have not heard about plans that would get you there that much sooner, unless the Anthropic transaction is so enormous and successful. And as she said, there's sort of such an inflection in the OpenAI business.
That's the place to watch. They've had a terrible no good week and month, and with the financials, their revenue growth in Q2 versus Anthropic's. But it does sound like in that same town hall, according to Kate's reporting, that she was saying I think their overall revenue growth was running up 35% quarter to date, enterprise up 50%. That's a much better narrative to tell if you still want to get out with a strong debut.
Joining us on this and so much more, author of the Sources newsletter, Alex Heath. He spoke at length with OpenAI CEO Sam Altman. You want to weigh in on the IPO story before we get into the Sam of it all?
I think you're spot on, Andrew. I think they go out maybe early next year. Anthropic, I'm hearing September most likely.
And so your sense of what's happening inside of OpenAI, though, right now, in terms of their efforts to try to really ramp the enterprise to compete with Anthropic, where do you think they really are?
I've been spending time inside OpenAI recently. You mentioned I spoke to Sam about their slowdown in research training, which they announced earlier this week. I think they had a pretty great July. I don't think Q1 or Q2 were very good. What happened at the end of June is they released Sol, their latest frontier model. And I think that has really gone well for them. And Codex, their coding agent, is also ramping dramatically, as you all reported, to 20 million users from zero less than a year ago. So I think they're on this upswing, but it's very recent.
We were talking about this OpenRouter transaction. Do you think that helps in OpenAI?
It's interesting. I was listening to you guys talk about that. I think enterprises will want to pick models. I really don't know if one model provider is going to win enterprise, especially when you think about the data and provisioning and needing things to respect the boundaries of an enterprise. That's where the routing, I think, makes a lot of sense. I think Anthropic and OpenAI will keep going at their own API businesses, but I have to believe that, you know, companies want to control their own destiny. If you think models are essential for building a company, you're going to want to have choice there.
In terms of just the build out, the revenue numbers, you know, OpenAI has made a number of massive commitments to a number of big data centers. Do you look at this and think the math adds, the maths?
The math is complicated and it's changing rapidly, because another thing that OpenAI especially is doing right now is they're really trying to drive down the cost of delivering tokens. They have their own inference chip going into production later this year. They're trying to invest in the full stack, essentially become their own hyperscaler, like an Amazon or a Google.
And you think that's different than Anthropic?
I don't think Anthropic's there. I think Anthropic's behind OpenAI on those efforts. They're doing their own chip efforts, but they're behind. They've been really focused on coding in the enterprise API business, and OpenAI has been expanding in a lot of different other ways. And it's why the margin profile of Anthropic looks really good right now, because of that focus that they have. But then I think you have a little more optionality long term with all the bets that OpenAI has made.
You know, we had Dylan, who's the CEO of Figma, on the broadcast yesterday, and he made some very positive comments about OpenAI. And he didn't make a dig at Anthropic per se, but we were talking about trust, and there's lots of questions and perceptions about trust, and you know, between New Yorker articles and other things that have really tried to place questions around OpenAI, and yet in the Figma case, they had partnered with Anthropic. I think they felt that they were blindsided by a partnership that has gone a little twisted. And I'm curious whether you think that the trust story has changed.
Well, I think the trust story is moving towards the capability of these models and how they're starting to hack things, right? I think the Hugging Face incident, which I think was part of the response we saw from OpenAI earlier this week, which, by the way, I don't think the market has fully internalized what's happening, which is that a frontier lab is intentionally slowing down frontier training. It's like if Mercedes said we're going to stop making cars for a while. That's what happened earlier this week. And so the trust is moving to this layer of, can we actually secure the capabilities of these models as we continue to invest in them? I mean, Sam Altman told me they're seeing, quote, various degrees of misalignment in their frontier models that they're developing, and so they had to pause.
But Alex, so what does that mean, though? So A, if they're pausing, does that have an implication for data center build-outs? We haven't heard Anthropic say they're pausing. I don't think XAI or Meta says they're pausing. Now, maybe they're not in the same place. I don't know. But what does it mean longer term? And could an OpenAI slow down, get some, and I don't know if you get credit for slowing down, but meanwhile Anthropic doesn't, and that hurts them in the marketplace?
I think at worst, it suggests maybe Anthropic's reckless and they're not focusing now on safety, even though they're the quote-unquote safety AI company, right? Like OpenAI is, which I have to imagine. I don't think it's the first intention, but I think it's a nice byproduct of this decision, is that it casts that doubt on Anthropic ahead of an IPO. And at best, it maybe just suggests that Anthropic doesn't have the capabilities that OpenAI has if Anthropic doesn't need to slow down. So look, I think this was a very research team-led effort at OpenAI. Again, I've been spending a lot of time there.
Right.
And I think the researchers are genuinely freaking out at what they're seeing, which is the capabilities of these models progressing and not being able to contain them. But at the same time, yeah, it's a wrinkle, I would say, as Anthropic's about to go out, given Anthropic's position in the market.
I got one final question that's maybe unrelated to both of those companies, but very much in the AI space, which is you also have been covering very heavily Meta. And we oftentimes think about Meta and what Mark Zuckerberg's doing as quote-unquote behind, just in terms of the race. And yet, you know, it's a public company. We have a lot of folks who are watching us right now who can already invest in that company, trying to understand the long-term economics of what they're doing. And I feel like you've had a real insight over the past couple months, because I read you very, very closely about what they are doing and how the economics may be better than people understand. And I'm not taking a position on it, but I just want to put it to you.
Yeah, no, it's interesting. I talked to Mark Zuckerberg for the newsletter last week because he put out that long op-ed manifesto, I guess you could say, about AI, being pro-AI. And he told me, which again is something I'm not sure the market has internalized, that the reason he wrote that is he wanted to state the values he has before Meta releases much more capable models in the near future. And that he was worried about, the public essentially not understanding the company's view on these issues we've been talking about when Meta has models that really put it at the frontier. That to me was a pretty definitive statement that he thinks that's going to happen in the near future. And you've seen them catch up pretty quickly over the last year. Now they're not at the frontier. They still have to prove that. They're getting very close, and they've done that in about a year.
Do you think they have to be at the frontier? Like, I know we're going to go, but does a Meta or a Google have to be at the frontier or not? And the reason I ask is there's, I think, one of two views. Either there's a view that somehow an Anthropic or somebody is so light years ahead of folks, even by 3, 4, 5, 6 months, that somehow they will hit AGI and there'll be this inflection point where it'll have recursive learning, and not only will they be 6 months ahead, but all of a sudden they'll be 2 years ahead, and then nobody can ever catch up again and the game is over. Or you believe that there really are going to be 5, 6 different models and they're all going to work.
It depends if you believe what you guys were talking about earlier about Stripe saying the singularities here. There are people who do believe RSI, recursive self-improvement, which you just mentioned, is already happening. People call it takeoff. People call it a lot of things. But people in the AI community think the world is about to look a lot different in the next 6 to 9 months. If you believe that and you need to be at the frontier, then a company like Meta and Google can't afford to be that far behind. Now, in the current setup of model progress, maybe it's okay to be 6 to 9 months behind because they can just ride everything. They have great businesses that give them cash flow. If you think, there's some kind of godlike thing that happens in 6 to 9 months, then yeah, you want to be at the frontier, but we don't have that yet.
Alex Heath, I feel like we're at the frontier with you. That's what I think.
Thanks, Andrew.
Thanks for waking up early. Appreciate it.
He's bringing us there. Coming up, Prince Harry and his wife Meghan reportedly deciding to move back to Great Britain after several years here in the U.S. We'll tell you what we know next. But first, the AccuWeather forecast with meteorologist Bernie Rayner.
Drenching showers and thunderstorms today, pushing toward New York City, Philadelphia, Washington, D.C. A couple of showers in Boston late in the day. AccuWeather says nice day in Chicago, hot Texas, spotty thunderstorms across Florida. In the west, it's just dry and hot, travel delays. Philadelphia, New York City, Washington, D.C., some major delays. Elsewhere, we should be good. AccuWeather for Business delivers proven superior accuracy with often earlier site-specific warnings that reduce false alarms and costly disruptions so your business stays best prepared. Visit business.accuweather.com.
Be there for the opening bell.
Welcome to Squawk on the Street.
What's moving? The biggest guests, the market action.
Right here.
Squawk on the Street, CNBC.
As the Asia trading day begins, join me for Squawk Box Asia. What are you watching? Nobody would be thinking that level of a benchmark is possible. We're live across the region covering what you need to know from here and around the world that would shape the business day.
We know there's 2 winners in AI. It's going to be China-US.
Let's stay away from these companies that are selling it at 40, 50 times sales.
Join me for Squawk Box Asia, only on CNBC.
American soccer legend Landon Donovan. He'll explain how the 2026 World Cup could shape the future of Major League Soccer and the inner demons that drove him to greatness.
I was constantly chasing this insatiable desire to be noticed.
He's the man behind Apple's sports ambitions. In an exclusive interview, we talk about the tech giant's unique sports strategy and whether a blockbuster acquisition is on the horizon. This is CNBC Sport on the Record.
China is the world's second largest consumer market behind the US. In 2025, the country's total retail sales of consumer goods exceeded about 50 trillion yuan, or about $7.2 trillion US dollars. up by 3.7% year-on-year. With a population of 1.4 billion people, the market has long been a cash cow for global brands. But today, success is no longer a given, with some Western brands struggling and even scaling back operations in the country.
When you think about live streaming and social media, the hottest new thing is going to bubble up overnight and you have to have it the next day.
The number one thing that you will see is how little loyalty Chinese consumers are because of the brands and how fast they innovate and how quickly they push things out. Consumers are very used to being hit by new concepts, new designs.
So what does it take to win in China?
Listen to CNBC on the move with the CNBC app.
A lot of strong numbers this morning.
Breaking news.
We've got a big IPO, something for the private markets. Could it be a rate cut scenario?
Real-time market updates.
A check now on how Europe is set to open the trading day ahead.
Your favorite programs live 24 hours a day.
Welcome to Squawk Box Europe.
Welcome to the China Connection, Squawk Box Asia.
Listen wherever in the world you are. Download the CNBC app now.
6 years, and that might be significant here in the U.S. According to published reports, they say the couple's children, Prince Archie and Princess Lilibet, will begin school in Great Britain next month, but that Harry and Meghan won't resume working roles within the royal family. The couple gave up their royal duties and moved to California more than 6 years ago as relations with the rest of the royal family soured. Recently, Harry has expressed interest in reconciliation. Guys, there's so much to talk about.
We have a lot to.
Is it a tax thing? Were they a flop? Were they living above their means?
Well, no. The biggest issue, though, the actual biggest issue, has always been about if they return to the UK, whether they'd be entitled to security in the country. And Harry had long fought this. They'd gone to court over the security issue. And the question, which I don't think is fully resolved, or I don't know how it's going to work out when they're there, is whether they're going to have security that's paid for by the government or whether they're going to have their own private security.
It's a homecoming, nevertheless.
Yes.
Whether
and by the way, it's going to provide lots of ink for the tabloids there.
They must be
endless.
Drooling. Squawk Box will be right back.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC+.
Ambition doesn't always look like you think it might look. I've just always been super fascinated by what's happening in financial markets and what is that telling us about where the world is going. That's what drives me. I love being part of this.
Never miss a moment.
We think there is a huge opportunity for AI in the UK and Europe because it is that middle ground between the United States and China.
Andy Burnham has committed himself to the Labour manifesto, so I don't think that that's going to change in the immediate future. I think our historic destiny is to be back in the European Union.
The world is taking you at your word, sir. What happens next?
We're never going to see Iran have a nuclear weapon.
Welcome back. Top of the hour. We have the second quarter earnings out from Walmart, and they came in at 81 cents a share, which includes a benefit from tariff refunds. Revenue was above forecasts, and Walmart also raised its outlook for fiscal 27, which ends in January. Same-store sales for the U.S. came in below estimates, with the retailer citing headwinds in the health and wellness category. Andrew, that is a GLP-1 reference, I believe.
Yes.
Don't miss a First on CNBC interview with Walmart's CFO on Squawk on the Street, 10 a.m. Eastern time, and the shares are moving lower by about 2%. Going into the quarter, I can say this with confidence. The analysts were warning that because of a little bit of a repayment issue around GLP-1s, there could be some pressure on their U.S. comps. I think they said if you add that back in, add maybe a point for that headwind. Nevertheless, obviously, everyone following the stock knows that already, and the shares are now moving down about 4%. So even with that cautionary baked in, you could call it a little bit of a disappointment.
It is just after 7 a.m. on the East Coast. You are watching Squawk Box right here on CNBC. I'm Andrew Ross, working along with Kelly Evans. Among today's top stories, President Trump turning up the pressure on Iran, announcing an economic D-Day. The president called the move, in his words, the most crushing economic operation ever taken against any country. Iran's foreign minister rejected the president's threat, calling it a diversion from America's own mounting debt problem and rising interest costs. Take a look at oil prices right now, because you're looking at WTI crude. We're now moving into 88.23. So we should probably show a chart of where this has gone, because it has moved up. Brent, you're now at 93.89. Potential progress made on a tariff standoff between the U.S. and Canada. Reports saying the U.S. considering lowering tariffs on Canadian steel and aluminum exports to 25% from 50%. Also cutting car tariffs to 15% from 25%. I didn't see what the latest is on the hockey sticks. Meantime, the U.S. government debt climbing above $40 trillion. That's according to the Treasury Department. And that's a function of years of escalating budget deficits produced by government stimulus during COVID, having caused ever more government red ink. 10 years ago, public debt was about half. And this is just unbelievable to even consider. It's half of what it was today. And this is why, talk about hockey stick, the thing about debt is it really does go like this. It really does. It does. It's not like a straight line. Yeah. It's not something that you can sort of flatten out on its own.
If we had 40 trillion back when we were running surpluses, it wouldn't be probably a 40 trillion. Right. We're running a deficit. I think it's more than Medicare and more than national defense is what we're spending on interest so far, fiscal year to date.
And the conundrum is, you know, we have a strong economy. Let's just say it. We have a strong economy, and we are running massive deficits today.
Right. And when we hit a slowdown and revenues
you can't live in a world where if you have a strong economy and things are going great, that you're not paying down the debt.
No, it's
otherwise it doesn't work.
These 7% budget deficits used to be like an economic emergency, a war, you know, a global financial crisis. Now it's just standard.
And then the question is, and look, this is the question that Pete Peterson, who's no longer alive, co-founded Blackstone with Steve Schwarzman, used to talk about the debt all the time, and whether there's an invisible line in the bond market that turns into a red line. Now, I would have thought, I think he thought 20 years ago that we had crossed that line.
Yeah.
Maybe we haven't crossed that line yet.
Well, negative rates didn't help. We had negative rates, you know, I'm talking about some of other parts of the global bond market, right up until COVID hit.
Right.
So a lot of this was happening and happening and happening. But when you have negative rates, everyone goes, who cares? What's the big deal? And then it exploded. Now here we are. Moderna shares have soared on the announcement that its personalized mRNA cancer vaccine developed with Merck succeeded in a late-stage melanoma trial. The company's CEO joined us yesterday and explained how they're thinking about the cost of a personalized treatment.
We do not use your own cells to make the product, which from a manufacturing standpoint is very much complex and very expensive.
Right.
So yes, it's going to be individualized, so it's not going to be the same price that's going to make a COVID shot for everybody the same, obviously. But it's not using cells, so it's a process that we can shrink down, and we think we can get it to a price.
Joining us now to talk more about this is Miles Minter. He's a research analyst at William Blair. Miles, it's great to see you. And I mean, we could talk a little bit about the cost or the way in which people should expect to pay for this. What's it going to mean for Moderna's bottom line? And then what's the bigger kind of opportunity now for the idea of vaccines against cancer?
Yeah, sure. Thanks for having me. So basically, I think the pricing of this product in terms of being a personalized vaccine for cancer tailored to the patient, the company has been talking in the realms of sort of cell therapy, but obviously it's much easier to manufacture and get to the patient, and also quite honestly a safer drug. So, we do expect pricing to be around that cell therapy price range. It's about $400,000 or above per year. Again, that's not an issue, I think, in the oncology setting. I think for Moderna's sort of business,
and just explain that.
Important.
Yeah, just for a second, Miles. So when you say $400,000, and for those who are unfortunately in these situations, I mean, imagine a large, if not all of that, is covered by insurance. How does it generally work?
Sure. So, like, if you are covered by insurance or Medicare in this country, that would obviously be, a significant portion of that covered by your healthcare insurance or the Medicare eligibility there. The company itself can also, provide rebates to help there in coverage. The reason why I said that this is not, out of the norm here, obviously cell therapy is priced here, but also Keytruda, which is, a $31 billion product a year for Merck, which we'll talk a little bit about later. That's obviously covered through healthcare plans, and that comes in at around about the $200,000 a year mark as well. And obviously what we're seeing with this trial, which we can talk about later, is additional benefit on top of that product. And so that's how we're kind of thinking about pricing right now. And then back to your first question, just on Moderna's on business. I think that's really important here and why the stock is moving how it is. Traditionally, this company has been based on infectious disease vaccines, which have obviously been waning as a business since the COVID pandemic. So they're a solution there. As the COVID pandemic has obviously waned here and vaccine sentiment has declined, investors have really been looking for Moderna's next big growth driver. And this franchise in oncology, which is in a 50-50 profit share with Merck, which is the eminent player here in the field, could be a sort of gateway back to that exponential growth trajectory for the company, which investors are getting excited about.
Merck, Moderna, we saw BioNTech up yesterday. Who else could be experiencing tailwinds here from the success of this trial?
Sure. I think we've had a little bit of a resurgence in the immuno-oncology names. So you mentioned BioNTech there. They're another mRNA player. I cover a little small cap called Arcturus Therapeutics as well that was up, which is doing a self-amplified mRNA. But anyone that can actually develop these personalized cancer vaccines and leverage this mRNA technology, you did see shares up there. And then I'd just comment from a sector in particular. Biotech is at all-time highs here if you look at the XBI and the NASDAQ here. And I think it is from data sets yesterday that are potentially changing the treatment paradigms and increasing quality of life for patients. We're seeing that here. And then obviously the way our sector works is that for big pharma like Merck, which is about to lose Keytruda off patent here, I believe in 2028, we are seeing increased M&A activity in the space. And so these sort of new companies that are developing major breakthroughs in large markets do get bought up by big pharma to replenish those pipelines moving forward. And that really gets our sector going, and you're seeing that reflected in the indices.
It is getting going. I mean, some even say biotech is the new AI, not even directly, but, we all can see where this is going. Arcturus, you mentioned 300 million market cap, but up 25% yesterday. Miles, thanks so much. Appreciate it.
No worries.
Okay, coming up, Treasury Secretary Scott Bessent making that big move to lower bond yields. Steve Leisman is going to be with us, the professor, to break it all down and what comes next. Don't go anywhere.
The greatest thing about Squawk Box is we get to talk to some of the brightest, some of the smartest, some of the most important people on a daily basis.
This is not just good content, this is good business. It's more entertaining than any other morning show, but you actually might get some useful information.
Generative AI has the chance to transform every customer experience.
For me, Squawk Box is breakfast with the most interesting people in the world.
I'm with Becky. This is the greatest show on earth.
Squawk Box, streaming on CNBC Plus. Breaking news, market moves. Scott Wapner from the NYSE, Closing Bell. Weekdays streaming on CNBC Plus.
The AI boom is reshuffling the global equity market rankings, with Taiwan and South Korea leapfrogging past long-established markets. Taiwan has climbed past Canada and India to become the world's 5th largest equity market, while South Korea has moved into 6th place.
All this happened within the span of just a few months, because last December, they were in the 9th and 11th places respectively. Now, such a shift is not unprecedented, but what is unusual is the speed at which these two have been climbing.
But this reordering isn't necessarily being driven by broad economic growth. Instead, it's about 3 companies at the heart of the AI hardware supply chain.
It's the AI theme which is driving things, so we have this a kind of perfect positive storm of industry fundamentals which are resulting in very, very rapid profit growth.
So what does this reshuffle tell us about how AI is changing global stock markets? And what are the risks?
Fast Money is America's post-game show.
Near all-time highs against the S&P.
We want to arm people with the information to make great decisions.
Valuations matter in a higher interest rate environment.
Fast Money, CNBC, streaming on CNBC Plus.
Welcome back to Squawk Box. I'm Pippa Stevens with a look at some of this morning's biggest movers. Shares of Samsung are jumping 9% after a report from Money Trade said the company will announce a more than $72 billion shareholder return program, spending 50% of its free cash flow. The report says the South Korean memory chip maker will hold a board meeting at the end of August to approve the program. It comes as Samsung has seen record profit from AI chip demand, shares more than doubling here year to date. Meantime, oil prices are rising this morning after President Trump vowed economic warfare on Iran and financial penalties for its supporters last night. The UAE halting trade with Iran after it said the country launched 2 ballistic missiles towards UAE territory. Names like Exxon, Mobil, Chevron, ConocoPhillips, Shell, and BP all up better than 1% this morning. Finally, Bitcoin is trading above $70,000 after President Trump called on Congress to lay out clear-cut rules for the crypto industry at a White House gathering with the CEOs of Coinbase, Robinhood, and others. The Clarity Act would define which types of cryptocurrencies are securities and which are commodities. Crypto names like Coinbase, Robinhood, Strategy, Circle, and Bullish all trading higher this morning on the back of that, all up at least 5%. And don't miss an interview with Coinbase CEO Brian Armstrong in the 8 a.m. hour. Kelly, I'll send it back to you.
Do you know what would happen if I tried to pull off those sleeves, Pippa? It would.
Lots of blue this morning.
It's beautiful. Take it. Looks great. Pippa, thank you very much. Pippa Stevens. Treasury yields are, and this is important following what you just talked about with oil. As we talked about last hour, going back to before the Iran war broke out, the 10-year was below 4%. The upward moves in energy prices even this morning, pushing that yield back up a couple of basis points, 468, 521, let's call it, on the 30-year. This all comes a day after Treasury Secretary Scott Bessent surprised markets with an unscheduled announcement. Senior economics reporter Steve Leisman is here with a look at his bond yield battle. Steve.
Yeah, this is part of something that's been going on for a while now. Scott Bessent, the Treasury Secretary, taking another action to try and drive down long-term bond yields by doubling the Treasury's intervention in the long end of the bond market. But analysts are skeptical, and it could complicate the job of Fed Chairman Kevin Warsh. The 10-year yield just 2 basis points lower this morning following the unscheduled announcement that between September and November, the Treasury would increase its purchases of off-the-run securities to at least $4 billion from $2 billion per operation. The move seems to support Bessent's longstanding goal to drive down 10-year yields, which have risen nearly 70 basis points since the beginning of the Iran war. The yield on the 30-year hasn't been this high since 2007. In addition to increased off-the-run buybacks, that's a bond whose term is less than the original issue, so a 30-year bond with a 23 years left on it, that's an off-the-run. But that comes on top of this yen intervention he was involved in, Argentinian intervention, plans more short-term issuance in part to pay for these purchases on the intervention. Greater reliance on short-term bills is at odds with recommendations of the Treasury Borrowing Advisory Committee, a private sector group that advises the Treasury. They wanted to keep down the percentage of short-term debt. It also could make life more difficult for Kevin Warsh, the Fed chairman. More short-term debt raises stakes for rate hikes because it's much more sensitive to the Fed and their rate. Lower long-term bond yields could boost growth and inflation, and Treasury intervention distorts market signals. Warsh said he wanted those signals to guide policy. For now, the move worked somewhat down a couple basis points, but the surprise announcement raised questions about whether markets could trust the Treasury to keep its promise to be reliable and predictable, and if such a move will work without real fiscal reforms.
Activist Treasury issuance. That term was coined in 2024 by Rubini and Stephen Myron when Yellen did this. And at the time, they wrote and warned that her move, they're now doubling what she began, that her move was equivalent to lowering rates by a full point. Myron, of course, would go on to become Trump's key advisor and then on the Fed himself. So I think, according to them, these moves do have a big economic impact. And perhaps we shouldn't overlook, and this has been going on since 2024, on and off, on and off, on and off. It's been going, and so I just wonder, again, I don't want to see us become Japan, have a situation that they're in now, but the extent of intervention on yields, high debt and so forth, it feels a little bit like we're drifting in that direction.
Let me separate out what happened yesterday, because there's the technical aspect to this and there's an overall policy aspect to this. People have been asking for a long time for the Treasury to do just what it did yesterday. This idea of off-the-run securities that trade sometimes 70 cents, 40 cents, it makes sense for the Treasury to buy them, take it off the balance sheet of the dealers, let the dealers go into the on-the-runs, the 30, the 10s, the 20s, and that could lower yields over time. That's a good thing. The way it was done, 2 weeks after the refunding announcement, on the morning of a 20-year issuance, it really surprised the markets.
By the way, Barry Knapp said yesterday they should just have gotten rid of the 20-year. He said, who needs it? No one needs it.
That's another story.
Just get rid of it.
Agreed. I mean, I don't know if I agree with that, but that's another story that we could talk about. But the way it was done, seemingly after the press made all of this talk, had all this talk about bond yields being high and being a challenge to the economy, and then they come in and they do something like this in a way that is not reliable and predictable.
Well, so that's the question. Does it bring confidence longer term to the bond market, to the investor class? Or, I mean, I made the analogy that this is a little bit like getting, buying out your 30-year mortgage with a 5-year arm. And that could work out really well for you or could not, depending on what you think happens to rates.
What's wrong with your analogy is it's a 6-month arm.
Yes.
Okay, and that makes it very sensitive and puts the pressure on Kevin Warsh if he needs to raise rates all of a sudden. Now, it's only a small portion. And by the way, it's a big part of the issuance, but not a part of the outstanding debt in the long term. So I think that's really the way to think about this. The way that makes it really difficult is this whole $40 trillion, $32 trillion outstanding to the public of debt is a confidence game. And you cannot lose the confidence of the people buying your debt. interesting question as to whether or not Scott Bessent is super smart about these things, but maybe super smart from a position of buying and selling them, not necessarily running the show, right? So he's a hedge fund guy. The hedge fund guy is supposed to game the government guy. The government guy is supposed to be out there to be gamed.
So it's interesting because you're talking about Myron on one end who didn't like this idea, but then if you remember, I think Scott Bessent and maybe Stan Druckenmiller used to talk about the opposite, sort of trying to be more trader-like around our bonds, right?
Right.
And so,
but it has been the policy.
It
has been the policy of the government and successive treasuries. Now, Yellen did some of this too, to not do that, to not be opportunistic.
Right,
that you go in and you buy bonds and you know the government is not going to game your purchase, for example, on the day of a 20-year auction.
But she started it with this twist towards bill issuance, and it's just continued.
Right, and who, by the way, who criticized it? Scott Bessent's criticized it. Who criticized it? Kevin Warsh criticized it. And now they're doing the same thing, but in much bigger proportions right now.
It might work because we rarely see bond markets trying too hard to fight these government. I just mean in the very long, the fullest sense of the long run, like what we're seeing in Japan right now.
Yeah. Look, they have to do the intervention. That makes sense to do this, to take these off the runs off. You save money that way. It's a good idea. Do it in a reliable, predictable way. Explain yourself to the public. That makes sense. You could gain the confidence of the bond market. But this doesn't necessarily seem like the best way to gain trust in a market where you desperately need.
So we can all agree the 20-year needs to go away. I'm glad that that's why Steve.
Okay, Steve, thank you. Coming up, remember when the biggest AI worry was about it taking your job? Well, this might top that. We're going to speak with a former White House Homeland Security advisor who's warning now about AI making it easier to create bioweapons. If you want to worry yourself, stick around. And then we're going to talk to political strategist Frank Luntz about how AI data centers have now turned into the big issue for the midterms, and I think he suspects an even bigger issue in 2028. Do not go anywhere, folks. Squawk Box rolling on right after this.
Time now for today's Aflac Trivia.
Abu Dhabi has now been branded as the capital of capital. There really are few places in the world where the concentration of sovereign wealth funds and smart investors.
It's a great place to work and live. I mean, living in Abu Dhabi, it's a very safe, secure city.
I love it so much, I don't think I'll ever leave.
Any company that's looking to grow and expand, really look at the Hub 71 Accelerator Program, the ADGM ecosystem. We couldn't have found a better home.
Everything is there for you to succeed here.
All right, let me tell you about ambition. To me, too much is not enough. You have only one life, so go all out. The only way you're gonna accomplish all the big goals is if you have a vision. Find out what you want to do, set the goal really high, and go all out. And then you create another vision, and another vision, another vision. So that's being ambitious, be useful. That's what my father always said. Don't just waste this life away, be useful, help other people. This is what it's all about.
Real money, real debate. Scott Wapner, live from the New York Stock Exchange. Halftime Report, weekdays streaming on CNBC+.
Hyrox is on track to deliver around $270 million in revenue in 2026, and the Middle East has quickly become one of its clearest expansion priorities.
Basically, our global expansion strategy always entitled having Hyrox events. Our dream was in the 150 urban metropolitan cities in the world. Abu Dhabi, Dubai, these were all cities that were part of the list. It's always clear that the Middle East are a very, very important part of our business.
The global demand creates a new problem. The race can be replicated city to city, but the experience cannot be overcrowded. The result is a business that benefits from both scarcity and repeatability.
The tickets are very hard to get. That's what keeps people coming back and keeps people looking into opportunities to maybe even fly to another city or travel to another city to participate in. This is highly relevant and important for us as well.
Welcome back to Squawk Box. What happens when AI and biotechnology come together? Well, a new foreign affairs essay, our next guest argues as these two technologies come together, they make it easier for bad actors to develop biological weapons. She's calling on the U.S. to be better prepared for those threats. Joining us right now is Elizabeth Sherwood Randall, a former White House Homeland Security advisor, now a senior fellow for Harvard Belfer Center. We've been talking about AI safety. I mean, it's become the issue du jour for a long time. We've also talked about sort of what are the worst things that could happen. Bioweapons, maybe, at least in this moment, the closest?
Good morning, Aaron. Good morning, Kelly. Yes, thank you for giving me the chance to talk about this with you. It is true that we are worrying about a wide range of threats from artificial intelligence, and AI-enabled biology is a very powerful and compelling capability that is creating huge upside potential for us in medicine, in energy, in agriculture. It's supercharging biology. It's also creating immense new risks. And what we are looking at now is a landscape of possibilities that we are not prepared to meet. And so this report that has been published this week by the Belfer Center at Harvard and the accompanying foreign affairs piece argue for a national strategy to address the emerging threat from supercharged biology, which is being enabled by the AI capabilities that are emerging, being fielded, and evolving.
Okay, so let's talk about what does that mean? Let's sort of walk through this article. What would you do if you were king for the day?
If I were queen for the day. So I would begin by rallying the private sector to work closely with the government to ensure that we build in the guardrails we need around the emerging biotechnology capabilities that are being powered by artificial intelligence. We have to work together because, importantly, the capabilities that are being fielded by the private sector are also the capabilities that we need.
But what does that mean? What does that mean in practice?
It means that the government and the frontier laboratories and the biotechnology sector in this country need to come together to understand the nature of the threats that are emerging and to build the capabilities to protect the most risky of the...
I hear you, but I hear you and I don't hear you, and I'll be very straight with you. The conundrum, I understand the idea that everyone should come together and talk it out, but in a universe in which we live with open weight models, we live with Chinese models, we live with model makers who are all over the world doing all sorts of things that are not regulated, controlled, or otherwise. I'm trying to understand how you're going to get everybody in a room and somehow solve it that way.
So, Aaron, we need to start with the American ecosystem. We have a vibrant ecosystem involving the frontier labs and the biotechnology sector. We need to come together as a nation to field the solutions to the threats that are being generated. And while we have the capabilities emerging for the upside, what we're not doing is leveraging that same innovation ecosystem to produce the solutions that will protect the American people from the emerging bio threats. That's what I'm arguing in this work that we have done, which is that there are ways we can tackle this. We can do it through prevention, but most importantly, we will do it by building national resilience. What we do not have is a system in place for responding to what we cannot prevent. And as you just said, we will not be able to prevent all bioweapons threats because of the way these technologies are being radically democratized, because access is now not just in secret government laboratories or among trained bioscientists. Many individuals will have the capacity to generate novel pathogens. And so we need to be much better prepared as a nation.
Yeah, to jump in and say that it's Kelly here, just as kind of a final comment, is hopefully people will read your piece and think about really smart ways to do so. What I don't want to see, is headlines like this get taken as a reason why people should oppose data centers and why we're just talking about curing cancer.
It's the opposite. It's the opposite. We need investment in our bioeconomy in the United States of America to ensure we have the data centers, that we have the capabilities to fuse the intelligence and the information that we're gathering from a national monitoring system, which we do not have in place. Just like an early warning radar for missiles, we need early warning of emerging pathogens in our country.
I would love that.
That information needs to be fused. We need to use the data centers to rapidly process the information and then take that and use our biotech sector in a warm start mode with pre-established contracts to develop the diagnostics, the therapeutics, and vaccines that will protect our citizens.
Okay, Elizabeth, I want to thank you for the conversation. It is fascinating. I'm going to have Aaron write a film all about a bioweapon war. I think it would be a very interesting screenplay. Maybe I'll write it with him.
Waiting to happen. That should be what you do.
We'll talk about it.
Coming up, ECB Chief Christine Lagarde is calling for better integration across Europe if countries want to compete in the AI race. We'll get into that topic, plus President Trump's promise of an economic D-Day for Iran. That and much more with Council on Foreign Relations President Emeritus Richard Haass. Squawk Box returns in a moment.
The day's top stories driving Wall Street. Up-to-the-minute developments. Kelly Evans, Brian Sullivan, Power Line, streaming on CNBC+.
Welcome to Closing Bell Overtime.
Get the essential post-market edge.
A very busy overtime.
After-hours action and opportunities.
The economic impact is just beginning.
What happened today?
The market had to resort to defense.
We've got a developing story out of Washington.
What's moving in real time?
What do the numbers tell you, pro or con?
Be ready for tomorrow after the bell.
There's a wait and see about a lot of things for tomorrow, Mike.
Completely.
Melissa Lee, Mike Santoli, Closing Bell Overtime, CNBC.
Never miss a moment.
We think there is a huge opportunity for AI in the UK and Europe because it is that middle ground between the United States and China.
Andy Burnham has committed himself to the Labour manifesto, so I don't think that that's going to change in the immediate future. I think our historic destiny is to be back in the European Union.
The world is taking you at your word, sir. What happens next?
We're never going to see Iran have a nuclear weapon.
From the markets to the courts. Kick back and relax while we serve up the highlights. Tackle your weekend. This weekend, race to your screen. The adventure continues. Dive into the action with CNBC Sports. CNBC Sports, afternoons on Saturday and Sunday, only on CNBC.
One of the world's largest private climate investment vehicles, Altera, aims to mobilize $250 billion by 2030.
What we're trying to show is that we can align those objectives and we can make money doing it.
Clean energy, emerging markets, even the AI boom. The opportunities are vast, but how do you pick the right investments?
We have people who specialize in these investments, and that's what makes Altera unique. That's our secret sauce.
Find out more on the next Managing Middle East.
Let's look at some stocks on the move this morning, beginning with Advance Auto Parts, down 15% despite better than expected quarterly earnings. But investors are focusing on an unexpected drop in same-store sales for the auto parts retailer. Perhaps a sign people are cutting back, at least there, on spending, down 15% over the past year as well. Going the other way is Deere, the heavy equipment maker, beating street forecasts on both the top and bottom lines and raising its full-year forecast after reporting its first year-over-year rise in quarterly profit in nearly 3 years. Now, it's just a fractional gain, but again, looking at the inflection points and up 18% now over the past year.
Okay, coming up, the AI boom getting political. Debates over data centers have become a critical issue in the midterms and primaries. The GOP even warning that AI companies, that it could hurt the chances for their candidate in the Ohio Senate race. We're going to get into all of this and what it means. Pollster and political strategist Frank Luntz, he's been spending a lot of time thinking about this. He joins us more on how this particular issue is now picking up a lot of steam with voters. Don't go anywhere. Squawk Box coming right back.
The day's top stories driving Wall Street. Up-to-the-minute developments. Kelly Evans, Brian Sullivan, Powerline, streaming on CNBC+.
If you're watching CNBC, it's because you want to get an edge. You want to get ahead. It's our job to deliver that. My ambition is just to be the best that we can possibly be. More often than not, I kind of forget that the cameras are there, but when there's really a burning question, I'm thinking about what my mom would want to hear. I'm thinking about some of the investors I know who are watching. Those are the same questions we have. People always ask me what I want to do next, and I always think they're a little crazy. This is what I want to do. It's the best job you could possibly have.
A market shaping industries. We are watching the six little dragons, the first to be listing in the Hong Kong market, supply chains, and global momentum.
Do you feel pressure to create the next Labubu soon?
This really is a business-first pivot, despite the geopolitical strains. The China Connection, weekdays.
The trade heads are gathering against the backdrop of the global energy crisis.
CNBC.com and the app anytime. Let's get to your headlines. Only on CNBC, connecting you with China.
We're building the biggest plants anywhere in the world. And I can say if I were the mayor of a town or the governor of a state and I had a chance to get a big plant in, an AI plant or a data center, I would absolutely want it because the jobs are enormous and the money paid, the taxes paid are just enormous. And if you don't take it, you're going to be left behind because there are plenty of places that want it.
That was President Trump weighing in on AI data centers being built across the country. Data center construction has become a flashpoint for midterm elections around the country, and support for opposition don't fall neatly along party lines. Joining us right now to talk a lot more about this is Frank Luntz. He is, of course, the FIL Inc. pollster and political strategist. I thought this would become a flashpoint in 2028. It sounds like it's a flashpoint right now.
Where you are in the country, what the economic conditions are, and how much people really want the jobs. Andrew, do you remember the movie Cool Hand Luke? In the key moment, Strother Martin says, what we have here is a failure to communicate. People who want to build these data centers are not explaining how the populations will benefit. They simply assume that they just offer it and the public says yes. It can pay for all sorts of stadiums. It can pay for healthcare. It can pay for tax decreases. It can make such a meaningful, measurable difference in the quality of life of the communities, but the people who want to build them aren't explaining it. And so some populations across the country, Ohio, for example, the public is turning against it.
So I'm curious if you were, well, let's take two sides of this. You could be a politician on one end, or you could be Mark Zuckerberg on the other, who's made a lot of public statements about AI recently. How would you be articulating the message, since you were in the messaging business?
The first thing I'd say is imagine. It's the most important word.
Hold on. Who are you, Mark Zuckerberg or the politician at this point?
I don't care.
Okay.
I'm either. And I'm doing imagine the impact. And that's the key word. What is the impact on the average individual if this data center is built? If I'm Mark Zuckerberg, imagine the jobs. Imagine the opportunities. Imagine what we can do for this community right now, right here. Versus the politician who says, Imagine the consequences, which is the negative way of putting it, of electric shortages, of water shortages, of the pressures on the infrastructure. The word imagine allows you to personalize it to yourself, and allows you to take these numbers, these opportunities, and make them meaningful and measurable. And neither side is particularly doing it all that well. And I actually think that this is not going to be the flashpoint for 2026. This is going to be explosive for 2028.
And what gets it from not a flashpoint today, but explosive by 28?
People have to experience it. They have to see it in their communities. They have to hear the horror stories about those who experienced the construction, those who experienced the pressure on the infrastructure, versus what happens to the community if they turn down, as the president said, if you're left behind. What happens at the community that's maybe 10 minutes away from you is bustling and booming because they added a data center, versus your community that doesn't get any of the benefits and only has themselves to blame.
Well, but here's the thing that I can't understand, and the reason I mentioned Mark Zuckerberg is he has recently talked about, and there's other companies that have talked about creating these funds where effectively not only would you be building a data center in a particular state or town, but there'd be additional funds that would be provided to firemen and policemen and members of the community. Now, a cynic says this is just an effort by Silicon Valley to buy off a community on a short-term basis. Somebody else might say that this is a great economic boon to these towns and to jobs.
They're both correct. It is an effort to buy them off with benefits that you couldn't get otherwise. Imagine the impact of being able to say to your community, with this data center, we will not need to raise property taxes for a decade. Imagine the benefit of being able to offer health care to people who don't have it, and then you don't have to raise taxes for it. Imagine the opportunity to build schools, but on the same token, if you don't communicate it, the public doesn't know, and it is more susceptible to the negative stories, the horror stories that have been put out. And Andrew, the best example of this is Amazon. When Amazon wanted to build more of their supply chain units, let's say, take New York, when AOC said, absolutely not. We're not putting one in my district. The progressives said, this is great because these are not good jobs. They don't pay enough. And the public said, what the hell are you doing? We want these jobs. We want these benefits. We want this economic growth, a healthy economy. So it really does depend on how it's communicated, and it really does depend on where that community is dealing with employment right now.
Frank, to that point, it's Kelly here. I wanted to ask you about this last week, and now they're kind of dovetailing. The polls that we saw about the outcome of, was it Michigan, where the Democratic Socialist candidate was polling? There were like 4 different polls, all giving this person a 20-point lead, ends up not happening. Is it something specific to progressive candidates? Is it something specific to polling in some of these states where maybe it's less sophisticated? I don't know. And when we're trusting these polls, and people in elections going into the midterms are going to be trusting polls to say whether their messaging is on point, if that poll is off by 20 points, then we could be out there, kind of running a campaign based on nothing.
You are absolutely correct. And pollsters and primaries should, frankly, shut the hell up. When you have a 15 or 20% turnout and you're measuring the entire electorate, either Democrats or Republicans, both sides have gotten it wrong this election cycle. And both sides should know that statistically, you cannot project an election if your turnout is 15 or 20%.
So are you saying that we should ignore all the polls for the next couple of months into the midterm? Which ones are trustworthy and which aren't? Should we ignore things for like governor?
You should not ask me. And actually, this is my declaration on your show. Don't ask pollsters to project elections when the turnout is less than 20%. We can't.
So just for primaries? Do you think it would be
Just
better than
context.
20% for the, like in the midterms? Do you think the turnout should be above 20%?
In the midterms, it'll be 40s, 50s. It'll be much higher, and it's much more accurate. But the key in all of this is not just determining who you're voting. These are good questions. They're not only figuring out who is going to vote, how they're going to vote, but you have to guess turnout, because in the end, there's more heat on the ends of the political spectrum. More people, more likely to vote.
We got to go. We got to go. But I got to ask you this, because Mick Mulvaney made a very important point/question that I want to ask you about. It gets to the different sides of the sort of the political aisles, which is he made a point. We were talking about the DSA, and originally he made the point that Democrats liked when MAGA emerged because they thought that MAGA was so out there that it was beatable, and didn't take it seriously enough in some ways. And now he's suggesting, we were making the point, well, this DSA just make Republicans think that that this is a better argument for their crowd. And he suggested maybe there's something much bigger happening across the country. And so I wanted to understand your sense of that debate and whether the DSA is a much bigger threat. Threat's the wrong word. Importance than we're giving it credit for right now.
I appreciate the way you tried to ask that question, because you're not trying to show judgment. And I absolutely listen to Mick Mulvaney because he's an astute political observer. The Republicans are going to be shocked when so many of these DSA people get elected. The state that I'm watching for all of this is Texas. Texas is thought as solidly Republican. It is not, or it is not right now. And you can have the Democratic candidate who's much more progressive than he's presenting himself. He could win that race, and that could be the balance in the U.S. Senate. I think it's much more important to understand where the electorate is right now. The number one issue is affordability. And when the president says that affordability is a hoax, he undermines his own credibility and the success of Republican candidates, because nothing else matters if you cannot afford to put food on your plate, if you cannot afford to live in the house that you want to live, and you cannot afford to live the American dream. This really matters. DSA, those socialists, Democratic socialists, are talking about issues that the American people care about.
So interesting that you mentioned this, because the DSA is talking about affordability, and the sort of mainstream Democrats, I don't know if you put an Ossoff in a mainstream Democrat kind of category, but that group has just spent a lot of time talking about this administration, criticizing this administration. Whereas the DSA spends most of their time
Medicare for all,
just talking about. It's a very interesting dynamic here right now.
Can I give you 4 words? How? It's going to be 5 words. How does it benefit me? How does it benefit me? Those are the words that the American people will think about as they walk into the voting booth. And the DSA is onto something. I may not agree with it, but their messaging is getting better and better with time.
Frank Luntz, thank you, sir. Appreciate it.
Speaking of affordability,
yeah.
Walmart is the latest retailer to join the earnings parade. It's down 6% this morning. We'll break down the quarter with an analyst next. And before the break, check out Bitcoin crossing above 71,000 after the White House meeting involving several big executives yesterday. Coinbase's Brian Armstrong is with us in the next hour. And a lot of volume on Kalshi on where Bitcoin will be at year end. $32 million in this contract and counting, and a pretty even split between kind of 60 and 80K. More Squawk Box 2 minutes away.
One hour of added insight every morning doesn't just add up, it compounds. 1 extra hour every morning delivers exponential value and a pure investing advantage. That's the compounding edge. The all-new Morning Call.
I'm Morgan Brennan, and this is your Morning Call.
CNBC.
I built a legacy on the court, and now is the moment to build a legacy outside of the court. My main investments are in hospitality, in education, and sports. So I believe that's the future. I see my brand as in a growing perspective, and in some way building this new chapter.
You'd been managing a very rare condition in your foot for much of your career. At what point do you think you seriously started to think about life beyond tennis?
You need to have goals. I think it's very important in this life to have goals ahead of you, because that helps you to wake up every day with motivation and passion. I knew since a long time ago that I wanted to keep doing things and learning after my tennis career. I have 2 small kids, and that's the most important thing of my life, without a doubt. But I like to work. That's how I understand this life.
Breaking news, market moves. Scott Wapner from the NYSE. Closing Bell. Weekdays streaming on CNBC Plus.
Shares of Walmart are under pressure this morning. It's in the Dow, right? It's going to put some,
yes,
anyway.
Yes, sir. Yes,
should
ma'am.
be putting some pressure on the blue chips. Despite better than expected earnings and revenue, same-store sales fell short. This was the key metric. And the retailers' forecast underwhelmed Wall Street. Let's bring in Michael Lasser, senior analyst over at UBS. Michael, it's good to see you. And we knew that there might be this issue with kind of, you would say better than me, reimbursement for GLP-1s, and that was going to subtract from U.S. same-store sales. But there's the comp, 2.6%. I think it's about a point, below estimate. So even if you add that back in, that and the forecast, what's going on here?
So what's going on here, Kelly, is that the sales are slowing. Clearly, the piece of the sales slowdown were from this health and wellness issue. But even beyond that, Walmart's seeing a bit of a moderation in its same-store sales growth. Now, if we put this in perspective, what has driven the stock over the last year and a half to this all-time new level at a premium valuation is threefold. One, a stable core business where Walmart sells 1 out of every 5 grocery dollars in the United States. 2, automation and technology that's going to make the business that much more profitable. And 3, rolling in new revenue streams that are a very high margin. The second 2 points were evident this quarter. Now, the question will be, does it have to take some of the profitability from those latter 2 points and invest in the first, meaning maintain the stability of the core business?
Right, and a lot of people are asking if Target's on an upswing. It's up 50% this year. It's still very small compared with Walmart. It's had a lot more struggles. But is that possibly where some of its U.S. traffic is going? Is this... I mean, you know how this is going to be played, which is just it's going to say the U.S. consumer soft, under pressure, and so on and so forth. So is it competitive? Is it core consumer behavior?
Kelly, I think it's the latter. I don't think it's a competitive issue. In the last 4 to 8 weeks, we have seen a growing number of data points to suggest the low-income consumer is feeling the collective burden of a variety of pressure points, including these elevated gas prices. We're going to hear that message from Walmart today on the conference call.
What else would you point to, Michael, for the last 4 to 8 weeks? I'm interested because that would be an inflection point. We saw them holding up better kind of in the late spring, even during the oil price spike. But you're saying now in the last month or two, you're seeing more pressure on the low-income consumer. Based on what?
Based on what we're going to hear from Walmart today, as well as another retailer that reported this morning, Advance Auto Parts, clearly called out in the last 4 weeks more challenge in its do-it-yourself business that is serves that lower income demographic. The other notable point that we're going to see is very likely that the dollar stores, Dollar General, Dollar Tree, are going to have accelerated their growth from the first to the second quarter. These are all signals that the consumer is changing the behavior to try and deal with what is a more difficult situation for that cohort.
All right, and again, we're down, but you still have a buy on the stock. You're not saying there's anything to really worry about here, but
no, absolutely not. Like I said, the elements of the constructive case on this stock are well intact. Its e-commerce grew 24% in the U.S. Its advertising business grew 38% business in the U.S. These are very comfortable growth levels that continue to support the bull case on this stock.
And I'm glad you mentioned that about Advance too, and talking.
Dust blows softly through this tired southern town. Old pickup trucks and faded signs breaking down. Neon buzzing outside the corner store, like memories I can't escape anymore. My boots feel heavy from these endless miles. Too many heartbreaks hidden behind smiles, and every cigarette burns slower tonight underneath this lonely yellow light. Dust and bones blues running through my soul, like an old black river nobody can control. Oh Lord, can't you see what these old roads did to me? Every dream I lose turns into dust and blues. Old bartender says the night's still young, but these tired lungs have sung enough songs. Train whistles echo somewhere far away, like ghosts begging me to stay. My guitar strings hum with a cracked old sound, like a worn-out man still drifting around. And every note beneath this southern sky feels like one more slow goodbye. Dust and bones blues, heavy as the rain, like cold scars hiding deep beneath the pain. Every road I still leaves me stranded with these dust and blues. Midnight train rolling through the rain, steel wheels crying like human pain. Coffee grows colder beside my hand as I watch the storm move across the land. Cheap motel glowing beside the road, another lost town carrying heavy souls. Old radio singing soft and low, songs about places I'll never know. Lonely train blues tonight, rolling through my soul like an endless highway, with nowhere left to go. Oh Lord, hear that sound as the rain keeps falling down. Every passing tune sings these lonely blues. Dusty suitcase lying by the door. I've seen too many towns before. Every neon light starts looking the same. Every heartbreak carries your name. My old guitar still understands the things this world never planned, and every chord beneath the moonlight sky feels like one more long goodbye. Lonely train blues tonight, slowly drifting on, like the whistle of a train just before the dawn. To these lonely blues. Rain keeps falling on the Mississippi road. Old guitar singing like a weary soul. Smoke from my cigarette fades into the night, while neon shadows dance beneath the pale light. Cheap whiskey burning slowly in my chest, trying to calm a heart that never rests. Every passing train sounds lonely and low, like memories from a life long ago. These midnight river blues keep pulling me down slow, like muddy southern water where broken dreamers go. Oh Lord, hear me tonight underneath this pale moonlight. Every road I choose leads back to these blues. Dusty boots walking through an empty town. Every lost soul keeps looking down. Oh, jukebox crying in the corner bar, playing songs for hearts left scarred. Through the southern trees, like ghosts whispering old melodies, and every note my guitar plays tonight feels like holding on to fading light. These midnight river blues run deeper every year, like thunder in the distance, slowly drawing near. Oh Lord, hear my cry beneath this endless sky. Every dream I lose turns into these blues. Neon signs glowing through the midnight rain. Every small town highway starts to look the same. Cheap whiskey bottle resting by the sink, while lonely hearts sit quietly and think. Old jukebox lounging in the corner bar, playing songs for people carrying scars. Smoke hangs heavy underneath the light, like broken souls hiding from the night. Neon Whiskey Road, take me far away, past the empty bars, memories that stay. Oh Lord, let me roam till this tired soul feels home. Every road I choose turns into these blues. Cold wind whispers through the motel screen about all the things that could have been. Train tracks shining underneath the storm like old ghosts trying to stay warm. My guitar keeps singing soft and slow, things this world will never know. And every chord beneath the southern sky feels like one more long goodbye. Neon Whiskey Road, stretching through the night like a lonely river, disappearing out of sight. Every dream I lose, every town I roam, still searching for a place this heart can call home. Rain falls gently on a Delta town tonight. Streetlights flicker in the fading light. Old men drinking slowly at the bar, talking about dreams that never got far. Smoke rises softly through the quiet room, like tired flowers trying hard to bloom. And every lonely blues song on the radio sounds like somewhere I used to know. Rain on the Delta tonight, cold against my skin, like old broken memories coming back again. Oh Lord, hear my cry underneath this southern sky. Every love I lose turns into these blues. My guitar rests heavy against the wall, like it already knows the rise and fall of every lonely soul that passes through, searching for something real and true. Wind moves softly through the pinewood trees, carrying old forgotten melodies. And somewhere down the darkened railway line, another lonely heart is losing time. Rain on the Delta tonight, slowly washing through like muddy river water, pulling me from you. Every road I roam, every dream I chase, still leaves these old blues written on my face. Smoke hangs heavy in this old blues bar. Street lights shimmer from passing cars. Bartender pouring another round slow as old train whistles echo below. My guitar hums with a tired sound, like a lonely soul still wandering around. Every broken memory comes alive tonight, under neon glow and candlelight. Smoky Delta night, burning low and warm, like an old blues record spinning through the storm. Every lonely mile, every faded sign still brings me back to the ghosts inside my mind. Rain taps softly on the window pane, trying hard to wash away the pain. But every melody still calls your name, and every midnight feels the same. Southern wind moves through the trees so slow, like secrets only lonely hearts know. And somewhere far beyond this town, another tired sun is going down. Smoky Delta night, hold me till the dawn, like the last old memory before it's gone. Every road I ride, every dream I chase, still leaves your shadow in this empty place. Cold wind blowing through the Delta night, rusty street lamp barely shining light, old six-string crying by the motel sign, like a broken prayer lost somewhere in time. River keeps rolling dark and slow, carrying secrets only drifters know. Every heartbeat echoes through the rain, like an old freight train full of pain. These crossroads after midnight keep calling out my name, through empty southern highways and neon-colored rain. Oh Lord, can you hear this old guitar and fear? Every road I ride leaves another scar inside. Bartender wipes the dust from empty glass, watching lonely shadows slowly pass. Jukebox humming low in smoky air, playing songs for souls beyond repair. Moonlight falling on these worn-out boots, while silence hangs beneath the roof. And every chord I play tonight alone searching for a place called home. Train wheels crying near the riverside like the ghosts of dreamers left behind. Smoke keeps dancing underneath the blue, while this old world keeps breaking in two. These crossroads after midnight still pull me through the storm, like distant thunder rolling before the night is gone. Oh Lord, stay near tonight beneath this fading light. Every dream I knew turns back into the blue. Standing at the crossroads, late at night alone. Cold wind blowing through flesh and bone. Street lights trembling underneath the rain, like tired hearts learning how to break again. Oh, black guitar hanging by my side, full of songs I've always tried to hide. Every mile behind me feels the same. Every broken town still knows my name. Crossroads, midnight blues, calling out my soul like a dark old river, too deep to control. Oh Lord, hear my prayer floating through the southern air. Every road I choose leads into these blues. Smoke drifts slowly through the neon light, while lonely strangers drink away the night. Bartender says some wounds don't heal, and tonight I finally know how that feels. Train tracks humming underneath the storm, like tide ghosts trying to stay warm. And every note my guitar softly cries feels like one more beautiful goodbye. Crossroads, midnight blues, hold me till the dawn, like a fading echo of an old sad song. Every dream I chase, every love I lose, still leaves me standing Delta moon hanging low above the river tonight. Silver reflections dancing in the pale light. Old wooden poles creaking underneath my feet, while distant thunder rolls through the summer heat. My cigarette burns slow beside this rocking chair. Southern wind moving softly through the air, and every lonely cricket singing in the dark feels like another memory inside my heart. Delta moonlight blues, soft and low tonight, like an old forgotten prayer floating through the night. Oh Lord, hear my soul trying hard to stay whole. Every road I choose leads back to these blues. Rain clouds gather slowly over county lines, like old regrets buried deep in time. My guitar hums with a worn-out sound, like a tired man still drifting around. Oh, radio playing from the room inside, songs about lovers who never survive. And somewhere far beyond the riverbed, another lonely night begins again. Delta moonlight blues, rolling through my veins like muddy southern water after endless rain. Every dream fades slow, like smoke beneath the moon. Still singing these blues to an old forgotten tune. Dust blows softly through this tired southern town. Old pickup trucks and faded signs breaking down. Neon buzzing outside the corner store, like memories I can't escape anymore. My boots feel heavy from these endless miles. Too many heartbreaks hidden behind smiles, and every cigarette burns slower tonight underneath this lonely yellow light. Dust and bones blues running through my soul, like an old black river nobody can control. Oh Lord, can't you see what these old roads did to me? Every dream I lose turns into dust and blues. Old bartender says the night's still young, but these tired lungs have sung enough songs. Train whistles echo somewhere far away, like ghosts begging me to stay. My guitar strings hum with a cracked old sound, like a worn-out man still drifting around. And every note beneath this southern sky feels like one more slow goodbye. Dust and bones blues, heavy as the rain, like cold scars hiding deep beneath the pain. Every road I ride, every town I choose, still leaves me stranded with these dust and blues. Midnight train rolling through the rain, steel wheels crying like human pain. Coffee grows colder beside my hand as I watch the storm move across the land. Another lost town carrying heavy souls. Old radio singing soft and low, songs about places I'll never know. Lonely train blues tonight, rolling through my soul like an endless highway with nowhere left to go. Oh Lord, hear that sound as the rain keeps falling down. Every passing tune sings these lonely blues. Dusty suitcase lying by the door. I've seen too many towns before. Every neon light stops looking the same. Every heartbreak carries your name. My old guitar still understands the things this world never planned. And every chord beneath the moonlight sky feels like one more long goodbye. Lonely train blues tonight, slowly drifting on, like the whistle of a train just before the dawn. Every road I take, every mile I lose, still leads me back to these lonely blues. Rain keeps falling on the Mississippi road. Old guitar singing like a weary soul. Smoke from my cigarette fades into the night, while neon shadows dance beneath the pale light. Cheap whiskey burning slowly in my chest, trying to calm a heart that never rests. Every passing train sounds lonely and low, like memories from a life long ago. These midnight river blues keep pulling me down slow, I choose leads back to these blues. Dusty boots walking through an empty town. Every lost soul keeps looking down. Oh, jukebox crying in the corner bar, playing songs for hearts left scarred. Through the southern trees, like ghosts whispering old melodies. And every note my guitar plays tonight feels like holding on to fading light. These midnight river blues run deeper every year, like thunder in the distance, slowly drawing near. Oh Lord, hear my cry beneath this endless sky. Every dream I lose turns into these blues. Neon signs glowing through the midnight rain. Every small town highway starts to look the same. Cheap whiskey bottle resting by the sink, while lonely hearts sit quietly and think. Old jukebox humming in the corner bar, playing songs for people carrying scars. Smoke hangs heavy underneath the light, like broken souls hiding from the night. Neon whiskey road, take me far away, past the empty bars, memories that stay. Feels home. Every road I choose turns into these blues. Scream about all the things that could have been. Train tracks shining underneath the storm, like old ghosts trying to stay warm. My guitar keeps singing soft and slow, things this world will never know. heart can call home.
Rain falls gently on a Delta town tonight. Street lights flicker in the fading light. Old men drinking slowly at the bar, talking about dreams that never got far. Smoke rises softly through the quiet room, like tired flowers trying hard to bloom. And every lonely blues song on the radio sounds like somewhere I used to know. Rain on the Delta tonight, cold against my skin, like old broken memories coming back again. Oh Lord, hear my cry underneath this southern sky. Every love I lose turns into these blues. My guitar rests heavy against the wall, like it already knows the rise and fall of every lonely soul that passes through, searching for something real and true. Wind moves softly through the pinewood trees, carrying old forgotten melodies. And somewhere down the darkened railway line, another lonely heart is losing time. Rain on the Delta tonight, slowly washing through like muddy river water, pulling me from you. Every road I roam, every dream I chase, still leaves these old blues written on my face. Streetlights shimmer from passing cars. Bartender pouring another round slow as old train whistles echo below. My guitar hums with a tired sound, like a lonely soul still wandering around. Every broken memory comes alive tonight, under neon glow and candlelight. Smoky Delta night, burning low and warm, like an old blues record spinning through the storm. Every lonely mile, every faded sign still brings me back to the ghosts inside my mind. Rain taps softly on the window pane, trying hard to wash away the pain. But every melody still calls your name, and every midnight feels the same. Southern wind moves through the trees so slow, like secrets only lonely hearts know. And somewhere far beyond this town, another tired sun is going down. Smoky Delta night, hold me till the dawn, like the last old memory before it's gone. Every road I ride, every dream I chase, still leaves your shadow in this empty place. Cold wind blowing through the Delta night, rusty street lamp barely shining light. Old six-string crying by the motel sign, like a broken prayer lost somewhere in time. River keeps rolling dark and slow, carrying secrets only drifters know. Every heartbeat echoes through the rain, like an old freight train full of pain. These crossroads after midnight keep calling out my name, through empty southern highways and neon-colored rain. Oh Lord, can you hear this old guitar and feel every road I ride leaves another scar inside. Bartender wipes the dust from empty glass, watching lonely shadows slowly pass. Jukebox humming low in smoky air, playing songs for souls beyond repair. Moonlight falling on these worn-out boots, while silence hangs beneath the roof. And every chord I play tonight alone feels like searching for a place called home. Train wheels crying near the riverside, like the ghosts of dreamers left behind. Smoke keeps dancing underneath the blue, while this old world keeps breaking in two. These crossroads after midnight still pull me through the storm, like distant thunder rolling before the night is gone. Oh Lord, stay near tonight beneath this fading light. Every dream I knew turns back into the blue. Standing at the crossroads, late at night alone, cold wind blowing through flesh and bone, street lights trembling underneath the rain, like tired hearts learning how to break again. Oh, black guitar hanging by my side, full of songs I've always tried to hide. Every mile behind me feels the same. Every broken town still knows my name. Crossroads, midnight blues, calling out my soul, like a dark old river, too deep to control. Oh Lord, hear my prayer floating standing in these midnight blues. Delta moon hanging low above the river tonight. Silver reflections dancing in the pale light. Old wooden poles creaking underneath my feet, while distant thunder rolls through the summer heat. My cigarette burns slow beside this rocking chair. Southern wind moving softly through the air, and every lonely cricket singing in the dark feels like another memory inside my heart. Delta moonlight blues, soft and low tonight, like an old forgotten prayer floating through the night. Oh Lord, hear my soul trying hard to stay whole. Every road I choose leads back to these blues. Clouds gather slowly over county lines, like old regrets buried deep in time. My guitar hums with a worn-out sound, like a tired man still drifting around. Oh, radio playing from the room inside, songs about lovers who never survive. And somewhere far beyond the river bend, another lonely night begins again. Delta moonlight blues, rolling through my veins like muddy southern water after endless rain. Every dream fades slow, like smoke beneath the moon. Still singing these blues to an old forgotten tune. this tired southern town. Old pickup trucks and faded signs breaking down. Neon buzzing outside the corner store, like memories I can't escape anymore. My boots feel heavy from these endless miles. Too many heartbreaks hidden behind smiles, and every cigarette burns slower tonight underneath this lonely yellow light. Dust and bones blues running through my soul, like an old black river nobody can control. Oh Lord, can't you see what these old roads did to me? Every dream I lose turns into dust and blues. Old bartender says the night's still young, but these tired lungs have sung enough songs. Train whistles echo somewhere far away, like ghosts begging me to stay. My guitar strings hum with a cracked old sound, like a worn-out man still drifting around. And every note beneath this southern sky feels like one more slow goodbye. Dust and bones blues, heavy as the rain, like old scars hiding deep beneath the pain. Every road I ride, every town I choose, still leaves me stranded with these dust and blues. Midnight train rolling through the rain, steel wheels crying like human pain. Coffee grows colder beside my hand as I watch the storm move across the land. Cheap motel glowing beside the road, another lost town carrying heavy souls. Old radio singing soft and low, songs about places I'll never know. Lonely train blues tonight, rolling through my soul like an endless highway with nowhere left to go. Oh Lord, hear that sound as the rain keeps falling down. Every passing tune sings these lonely blues. Dusty suitcase lying by the door. I've seen too many towns before. Every neon light starts looking the same. Every heartbreak carries your name. My old guitar still understands the things this world never planned, and every chord beneath the moonlight sky feels like one more long goodbye. Lonely train blues tonight, slowly drifting on, like the whistle of a train just before the dawn. Every road I take, every mile I lose, still leads me back to these lonely blues. Rain keeps falling on the Mississippi road. Old guitar singing like a weary soul. Smoke from my cigarette fades into the night, while neon shadows dance beneath the pale light. Cheap whiskey burning slowly in my chest, trying to calm a heart that never rests. Every passing train sounds lonely and low, like memories from a life long ago. These midnight river blues keep pulling me down slow, like muddy southern water where broken dreamers go. Oh Lord, hear me tonight underneath this pale moonlight. Every road I choose leads back to these blues. Dusty boots walking through an empty town. Every lost soul keeps looking down. Oh, jukebox crying in the corner bar, playing songs for hearts left scarred. Through the southern trees, like ghosts whispering old melodies. And every note my guitar plays tonight feels like holding on to fading light. These midnight river blues run deeper every year, like thunder in the distance, slowly drawing near. Oh Lord, hear my cry beneath this endless sky. Every dream I lose turns into these blues. Neon signs glowing through the midnight rain. Every small town highway starts to look the same. Cheap whiskey bottle resting by the sink, while lonely hearts sit quietly and think. Old jukebox humming in the corner bar, playing songs for people carrying scars. Smoke hangs heavy underneath the light, like broken souls hiding from the night. Neon whiskey road, take me far away, past the empty bars, memories that stay. Feels home. Every road I choose turns into these blues. track shining underneath the storm like old ghosts trying to stay warm. My guitar keeps singing soft and slow, things this world will never know. And every chord beneath the southern sky feels like one more long goodbye. Neon Whiskey Road, stretching through the night like a lonely river, disappearing out of sight. Every dream I lose, every town I roam, still searching for a place this heart can call home. Rain falls gently on a Delta town tonight. Streetlights flicker in the fading light. Old men drinking slowly at the bar, talking about dreams that never got far. Smoke rises softly through the quiet room, like tired flowers trying hard to bloom. And every lonely blues song on the radio sounds like somewhere I used to know. Rain on the Delta tonight, cold against my skin, like old broken memories coming back again. Oh Lord, hear my cry underneath this southern sky. Every love I lose turns into these blues. My guitar rests heavy against the wall, like it already knows the rise and fall of every lonely soul that passes through, searching for something real and true. Wind moves softly through the pinewood trees, carrying old forgotten melodies. And somewhere down the darkened railway line, another lonely heart is losing losing time. Rain on the Delta tonight, slowly washing through like muddy river water, pulling me from you. Every road I roam, every dream I chase, still leaves these old blues written on my face. Smoke hangs heavy in this old blues bar. Street lights shimmer from passing cars. Bartender pouring another round slow as old train whistles echo below. My guitar hums with a tired sound, like a lonely soul still wandering around. Every broken memory comes alive tonight, under neon glow and candlelight. Smoky Delta night, burning low and warm, like an old blues record spinning through the storm. Every lonely mile, every faded sign still brings me back to the ghosts inside my mind. Rain taps softly on the window pane, trying hard to wash away the pain. But every melody still calls your name, and every midnight feels the same. Southern wind moves through the trees so slow, like secrets only lonely hearts know. And somewhere far beyond this town, another tired sun is going down. Smoky Delta night, hold me till the dawn, like the last old memory before it's gone. Every road I ride, every dream I chase, still leaves your shadow in this empty place. Cold wind blowing through the Delta night, rusty street lamp barely shining light, old six-string crying by the motel sign, like a broken prayer lost somewhere in time. River keeps rolling dark and slow, carrying secrets only drifters know. Every heartbeat echoes through the rain, like an old freight train full of pain. These crossroads after midnight keep calling out my name, through empty southern highways and neon-colored rain. Oh Lord, can you hear this old guitar and fear? Every road I ride leaves another scar inside. Bartender wipes the dust from empty glass, watching lonely shadows slowly pass. Jukebox humming low in smoky air, playing songs for souls beyond repair. Moonlight falling on these worn-out boots, while silence hangs beneath the roof. And every chord I play tonight alone feels like searching for a place called home. Train wheels crying near the riverside, like the ghosts of dreamers left behind. Smoke keeps dancing underneath the blue, while this old world keeps breaking in two. These crossroads after midnight still pull me through the storm, like distant thunder rolling before the night is gone. Oh Lord, stay near tonight beneath this fading light. Every dream I knew turns back into the blue. Standing at the crossroads late at night alone, cold wind blowing through flesh and bone, street lights trembling underneath the rain, like tired hearts learning how to break again. Oh, black guitar hanging by my side, full of songs I've always tried to hide. Every mile behind me feels the same. Every broken town still knows my name. Crossroads, midnight blues, calling out my soul. Like a dark old river, too deep to control. Oh Lord, hear my prayer, floating through the southern air. Every road I choose leads into these blues. Smoke drifts slowly through the neon light, while lonely strangers drink away the night. Bartender says some wounds don't heal, and tonight I finally know how that feels. Train tracks humming underneath the storm, like tide ghosts trying to stay warm. And every note my guitar softly cries feels like one more beautiful goodbye. Crossroads, midnight blues, hold me till the dawn, like a fading echo of an old sad song. Every dream I chase, every love I lose, still leaves me standing in these midnight blues. Delta moon hanging low above the river tonight. Silver reflections dancing in the pale light. Old wooden porch creaking underneath my feet, while distant thunder rolls through the summer heat. My cigarette burns slow beside this rocking chair. Southern wind moving softly through the air, and every lonely cricket singing in the dark feels like another memory inside my heart. Delta moonlight blues, soft and low tonight, like an old forgotten prayer floating through the night. Oh Lord, hear my soul trying hard to stay whole. ever slowly over county lines, like old regrets buried deep in time. My guitar hums with a worn-out sound, like a tired man still drifting around. Oh, radio playing from the room inside, songs about lovers who never survive. And somewhere far beyond the riverbed, another lonely night begins again. Delta moonlight blues rolling through my veins, like muddy southern water after endless rain. Every dream fades slow, like smoke beneath the moon. Still singing these blues to an old forgotten tune. Dust blows softly through this tired southern town. Old pickup trucks and faded signs breaking down. Neon buzzing outside the corner store, like memories I can't escape anymore. My boots feel heavy from these endless miles. Too many heartbreaks hidden behind smiles, and every cigarette burns slower tonight underneath this lonely yellow light. Dust and bones blues running through my soul, like an old black river nobody can control. Oh Lord, can't you see what these old roads did to me? Every dream I lose turns into dust and blues. Old bartender says the night's still young, but these tired lungs have sung enough songs. Train whistles echo somewhere far away, like ghosts stay. My guitar strings hum with a cracked old sound, like a worn-out man still drifting around. And every note beneath this southern sky feels like one more slow goodbye. Dust and bones blue, heavy as the rain, like cold scars hiding deep beneath the pain. Every road I ride, every town I choose, still leaves me stranded with these dust and blues. Midnight train rolling through the rain, steel wheels crying like human pain. Coffee grows colder beside my hand as I watch the storm move across the lane. Cheap motel glowing beside the road, another lost town carrying heavy souls. Old radio singing soft and low, songs about places I'll never know. Lonely train blues tonight, rolling through my soul like an endless highway with nowhere left to go. Oh Lord, hear that sound as the rain keeps falling down. Every passing tune sings these lonely blues. Dusty suitcase lying by the door. I've seen too many towns before. Every neon light starts looking the same. Every heartbreak carries your name. My old guitar still understands the things this world never planned, and every chord beneath the moonlight sky feels like one more long goodbye. Lonely train blues tonight, slowly drifting on, like the whistle of a train just before the dawn. Every road I take, every mile I lose, still leads me back to these lonely blues. Rain keeps falling on the Mississippi road. Old guitar singing like a weary soul. Smoke from my cigarette fades into the night, while neon shadows dance beneath the pale light. Cheap whiskey burning slowly in my chest, trying to calm a heart that never rests. Every passing train sounds lonely and low, like memories from a life long ago. These midnight river blues keep pulling me down slow, like muddy southern water where broken dreamers go. Oh Lord, hear me tonight underneath this pale moonlight. Every road I choose leads back to these blues. Dusty boots walking through an empty town. Every lost soul keeps looking down. Oh, jukebox crying in the corner bar, playing songs for hearts left scarred. Through the southern trees, like ghosts whispering old melodies, and every note my guitar plays tonight feels like holding on to fading light. These midnight river blues run deeper every year, like thunder in the distance. signs glowing through the midnight rain. Every small town highway starts to look the same. Cheap whiskey bottle resting by the sink, while lonely hearts sit quietly and think. Old jukebox humming in the corner bar, playing songs for people carrying scars. Smoke hangs heavy underneath the light, like broken souls hiding from the night. Neon whiskey road, take me far away, past the empty bars, memories that stay. Oh Lord, let me roam till this tired soul feels home. Every road I choose turns into these blues. Cold wind whispers through the motel screen about all the things that could have been. Train tracks shining underneath the storm like old ghosts trying to stay warm. My guitar keeps singing soft and slow, things this world will never know. And every chord beneath the southern sky feels like one more long goodbye. Neon whiskey road, stretching through the night like a lonely river, disappearing out of sight. Every dream I lose, every town I roam, still searching for a place this heart can call home. Rain falls gently on a Delta town tonight. Street lights flicker in the fading light. Old men drinking slowly at the bar, talking about dreams that never got far. Smoke rises softly through the quiet room, like tired flowers trying hard to bloom. And every lonely blues song on the radio sounds like somewhere coming back again. Oh Lord, hear my cry underneath this southern sky. Every love I lose turns into these blues. My guitar rests heavy against the wall, like it already knows the rise and fall of every lonely soul that passes through, searching for something real and true. Wind moves softly through the pinewood trees, carry no forgotten melodies. And somewhere down the darkened railway line, another lonely heart is losing time. Rain on the Delta tonight, slowly washing through like muddy river water, pulling me from you. Every road I roam, every dream I chase, still leaves these old blues written on my face. Smoke hangs heavy in this old blues bar. Street lights shimmer from passing cars. Bartender pouring another round slow as old train whistles echo below. My guitar hums with a tired sound, like a lonely soul still wandering around. Every broken memory comes alive tonight, under neon glow and candlelight. Smoky Delta night, burning low and warm, like an old blues record spinning through the storm. Every lonely mile, every faded sign still brings me back to the ghosts inside my mind. tap softly on the window pane, trying hard to wash away the pain. But every melody still calls your name, and every midnight feels the same. Southern wind moves through the trees so slow, like secrets only lonely hearts know. And somewhere far beyond this town, another tired sun is going down. Smoky Delta night, hold me till the dawn, like the last old memory before it's gone. Every road I ride, every dream I chase, still leaves your shadow in this empty place. Cold wind blowing through the Delta night, rusty street lamp barely shining light, old six-string crying by the motel sign, like a broken prayer lost somewhere in time. River keeps rolling dark and slow, carrying secrets only drifters know. Every heartbeat echoes through the rain, like an old freight train full of pain. These crossroads after midnight keep calling out my name, through empty southern highways and neon-colored rain. Oh Lord, can you hear this old guitar and fear? Every road I ride leaves another scar inside. Bartender wipes the dust from empty glass, watching lonely shadows slowly pass. Jukebox humming low in smoky air, playing songs for souls beyond repair. Moonlight falling on these worn-out boots, while silence hangs beneath the roof. ice cold home. Train wheels crying near the riverside like the ghosts of dreamers left behind. Smoke keeps dancing underneath the blue, while this old world keeps breaking in two. These crossroads after midnight still pull me through the storm, like distant thunder rolling before the night is gone. Oh Lord, stay near tonight beneath this fading light. Every dream I knew turns back into the blue. Standing at the crossroads, late at night alone. Cold wind blowing through flesh and bone. Street lights trembling underneath the rain, like tired hearts learning how to break again. Oh, black guitar hanging by my side, full of songs I've always tried to hide. Every mile behind me feels the same. Every broken town still knows my name. Crossroads, midnight blues, calling out my soul like a dark old river, too deep to control. Oh Lord, hear my prayer floating through the southern air. Every road I choose leads into these blues. Smoke drifts slowly through the neon light, while lonely strangers drink away the night. Bartender says some wounds don't heal, and tonight I finally know how that feels. Train tracks humming underneath the storm, like tide ghosts trying to stay warm. And every note my guitar softly cries feels like one more beautiful goodbye. Crossroads, midnight blues, hold me till the dawn, like a fading echo of an old sad song. Every dream I chase, every love I lose, still leaves me standing in these midnight
bright blue.
In Focus, I'm Tiffany Meyer. Our top story, Washington is racing to cut its reliance on rare earths from China. A look at the pressure and opportunity facing a U.S. company at the center of that push. Boosting efforts to reduce America's reliance on China, $162 million going toward new technologies to recover rare earth elements from industrial waste and byproducts. Japan is feeling the squeeze from Beijing's rare earth restrictions, what Tokyo is doing to tackle the problem. More light shed on the controversy surrounding the origins of COVID-19 and the lab leak theory. A former top advisor to Dr. Anthony Fauci has pleaded guilty to a conspiracy charge and is now facing possible prison time. Washington is racing to break China's dominance of rare earth minerals. For U.S. companies producing rare earths at home, that creates both enormous pressure and a major opportunity to meet growing demand. Here's a closer look at a U.S. lab at the center of the U.S.-China competition over critical minerals.
At first glance, this looks like any other foundry floor. But this facility in New Hampshire is one of the few places in the U.S. that can turn mine waste into rare earth metals, elements the U.S. needs to build fighter jets and weapon systems, but still relies on China to supply.
One of the reasons why these elements are called critical is because of the outsized role that they play. In a $150 million weapon system, often accounting for very small amount, $20,000 to $30,000. However, the performance of that capability is completely dependent on that rare earth metal.
Anthony Baladin is the chief commercial officer of Phoenix Tailings. This company handles processing and refining, a critical stage in rare earth production where the U.S. has been weakest and China has the most control. Here's a look at the heart of the operation.
This machine here, it releases the oxide from these bulk bags, and it screw feeds it up into this hopper, and then the hopper delivers it into this rotary furnace.
Inside that furnace, moisture is burned off the oxide before the next step. Then, flakes of dry oxide powder pour into one of the electrolysis cells.
It's being fed at a rate in which we're producing the metal.
There's still a huge gap between the amount of rare earth elements the U.S. needs and what it can produce at home. Take samarium, for example, a type of rare earth element critical for magnets used in jets and missile guidance systems. The U.S. defense sector needs 50 to 100 tons of samarium a year.
Right now, Phoenix's rare earth metal production capability is on the scale of hundreds of kilograms. We need to scale that up to be tens of tons within the next few months.
The company is feeling pressure to scale up production to meet growing demand from the military. Starting next year, U.S. defense contractors will no longer be able to source rare earths and rare earth magnets from China. Phoenix has secured a $500 million loan from the Pentagon. The money will be used to build a $1 billion facility to expand rare earth element processing.
This is an extremely important project, both for Phoenix, but also for the United States and its allies.
Still, building a supply chain takes time. Baladin says the facility will take at least a year to become fully operational.
And the Trump administration stepping up efforts to reduce America's reliance on China. $162 million granted on Tuesday to recover critical minerals and rare earth elements from industrial byproducts and waste.
The initiative advances President Trump's executive order to unleash American energy while reducing U.S. dependence on foreign supply chains, particularly those tied to China. The effort focuses on materials such as scandium, copper, and antimony, which are critical to defense, energy, and advanced manufacturing. The Energy Department will oversee 9 selected projects at facilities across 6 states.
If successful, this would reduce their reliance on China, which dominates rare earth processing. And staying on Washington's efforts to secure critical minerals, we're now shining a spotlight on South Korea. Korea Zinc is investing billions of dollars to expand a zinc smelter in Tennessee, with plans to recover minerals like gallium and germanium. Their resources the U.S. currently relies heavily on China to supply. The deal comes as Washington looks for ways to loosen Beijing's grip on rare earths and other critical minerals. Located in Tennessee, Korea Zinc is transforming an existing zinc plant into a major U.S. source for critical minerals. The company plans to build a smelter capable of processing more than 1 million tons of raw material each year. It will produce 12 metals, including zinc, copper, gallium, and germanium. 11 of those are considered critical minerals by Washington. The project is backed in part by the U.S. government, which has taken a 10% stake in Korea Zinc as part of a roughly $7 billion investment. The goal is to build up domestic supply chains and reduce America's dependence on China. That comes as Beijing tightens restrictions on critical mineral exports used in everything from semiconductors and AI to advanced weapons. Korea Zinc says the Tennessee facility could eventually supply about half of U.S. demand for some of those minerals. Beijing is squeezing Japan hard on rare earth elements. For the first half of this year, Japan's imports of 2 scarce rare earth minerals plunged over 70% from 2 years ago. That's according to Nikkei Asia. These rare earths are dysprosium and yttrium. They're critical for magnets used in electric vehicles and components of chip-making equipment. The squeeze comes after China restricted exports of 7 types of rare earths, including these 2 last year. And Beijing has cramped up the pressure this year, restricting exports of rare earths and other dual-use goods to more than 40 Japanese companies. In response, Japan increased its sourcing of rare earths from other countries, but it has not been able to secure enough volume. Tokyo is now trying to accelerate efforts to extract rare earths from the deep sea and Southeast Asia. Newly declassified documents reveal the National Security Agency, or NSA, blocked intelligence about China interfering in U.S. elections from reaching President Trump. That is, the Justice Department plans to deploy around 1,000 election monitors nationwide for the November midterms. NTD's Washington correspondent Jack Bradley has more.
Newly declassified documents reveal that the National Security Agency's deputy director blocked reports of foreign influence in U.S. elections from reaching President Trump. The White House Government Transparency Task Force just released these 4 pages of emails from March 2020. In them, one NSA analyst wrote that officials had spent months working to publish intelligence about the Chinese Communist Party's efforts to subvert U.S. elections, specifically the 2016 and 2020 presidential elections. But according to the emails, the NSA's number 2 at the time, Deputy Director George Barnes, blocked its release. They say Barnes worried that releasing the intelligence could damage the NSA's credibility and make the agency appear political. The task force is now looking at more records to find out why intelligence was not shared with the president, Congress, or some senior intelligence officials, saying more documents are expected in the coming weeks. And the Justice Department is doing its part to uphold election integrity. The DOJ has deployed over 200 election monitors to observe polling places for the primary season, with much more planned for the November midterms.
Approximately 1,000 election monitors in the November election.
And this isn't new, as the DOJ election monitors have been used by administrations from both parties for decades. In 2004, for instance, the DOJ's Civil Rights Division sent nearly 1,500 observers to election sites. But just 20 years later, in November 2024, that number fell to just 250 observers. So this increase in monitors in November is meant to bring back voter confidence after thousands of names appeared on voter rolls that legally shouldn't be there.
There are hundreds of thousands of dead people on the voter rolls, and there are tens of thousands of people who are not citizens on the voter rolls.
And Assistant Attorney General Harmeet Dillon says the scope of the problem is unknown because 2/3 of states are refusing to cooperate with the DOJ's efforts to clean up their voter rolls. Jack Bradley, NTD News, Washington.
A new development is putting fresh scrutiny on the origins of COVID-19 and the controversial lab leak theory. A former top advisor to Dr. Anthony Fauci is now facing possible prison time after pleading guilty to a federal conspiracy charge. Dr. Fauci was a senior public health advisor to President Trump during his first term. Fauci has faced scrutiny over what he knew about the possibility of COVID-19 originating from a lab in Wuhan and what U.S. officials communicated about it. NTD's Daniel Monahan has more on the case.
Dr. David Morin spent 16 years as a senior advisor inside the National Institute of Allergy and Infectious Diseases, the agency Dr. Fauci led for decades. Prosecutors say Morin's conspired to dodge Freedom of Information Act requests tied to a bat coronavirus research grant connected to the Wuhan Institute of Virology, corresponding through his personal Gmail account instead of his government email to keep records out of public view. It's a pattern he was pressed on 2 years earlier during a congressional hearing.
But on February 24th, 2021, you wrote, quote, "I learned from our FOIA lady here how to make emails disappear after I'm FOIA'd, but before the search starts. So I think we are all safe. Plus, I deleted most of those earlier emails after sending them to Gmail," end quote. Did the NIH FOIA office instruct you on how to delete emails or avoid FOIA?
No. Morin's told lawmakers he hadn't deleted evidence, but under his own guilty plea, he now admits doing exactly that and hiding grant-related communications.
On October 25th, 2021, another scientist wrote, quote, "David is concerned about the privacy of text and other messages from his cell phone to you and me because he has been using a government phone. This came from Tony," end quote. Sir, did you ever have any conversations with Dr. Fauci regarding using personal phone or email to communicate with Dr. Daszak?
I don't remember it. It's possible. I probably wouldn't have remembered it, and I don't remember it. He and I usually never talked about that kind of stuff.
Court documents show Morin's accepted wine as a gift for what a co-conspirator called his behind-the-scenes shenanigans, and was offered further perks, including meals at Michelin-starred restaurants, in exchange for helping push back on the theory that COVID leaked from a lab. He's due to be sentenced November 12th in federal court in Maryland, and faces up to 5 years behind bars.
The case lands as a separate push to hold Fauci himself in contempt of Congress sits with the Justice Department. Daniel Monahan, NTD News.
Dr. Fauci also faced tough questions from lawmakers. At a Senate hearing last month, he declined to answer dozens of questions related to his handling of the COVID-19 pandemic and the origin of the virus. He hasn't been charged with a crime in this matter, but he is now facing a possible contempt of Congress prosecution. China is blocking Chinese entities from cooperating with a European Union investigation into e-commerce giant JD.com. The probe is examining whether Chinese state subsidies gave the e-commerce giant an unfair advantage in the European market. The European Commission launched the investigation back in May over JD.com's planned $2.5 billion purchase of a German retailer, Ceconomy. Brussels is examining whether Chinese regime-backed subsidies have distorted competition in its markets. Beijing responded Wednesday, calling the investigation improper extraterritorial jurisdiction. It ordered Chinese entities not to assist with the probe. Beijing also warned it could retaliate if the EU continues what it calls unilateral actions. It's the second time China has issued such a blocking order, following a similar move against an EU probe into security firm NukeTech. Coming up, Japan is reaffirming the strength of the U.S.-Japan-South Korea alliance, aiming to counter two nuclear-armed neighbors, China and North Korea. This comes after President Trump scaled back joint drills with South Korea. And barred from leaving South Korea, a former U.S. ambassador speaks out. Morris Tan joins us to discuss his experience, South Korea's political shift, and the Chinese Communist Party's influence.
That is speech by a U.S. citizen on U.S. soil, which is protected by the U.S. Constitution. And if it belongs in any court system, it's in the American court system.
More on that after the break here on China in Focus. Welcome back to China in Focus. I'm Tiffany Meyer. Japan's defense minister is doubling down on military ties with the U.S. and South Korea on Tuesday, just one day after President Trump ordered a surprise scale back of joint war games with South Korea.
As Japan faces its most severe and complex security environment since the end of World War II, cooperation among Japan, the United States, and South Korea is indispensable for regional peace and stability.
Our government has actively participated from the outset in international discussions aimed at securing a ceasefire involving Iran and restoring freedom of navigation through the Strait of Hormuz.
President Trump announced the move in a social media post as U.S. and South Korean troops began this week's Ulchi Freedom Shield drills against North Korea. He cited Seoul's refusal to help out on Iran. The president also saying North Korea's Kim Jong-un has been well-behaved during both of Trump's terms and points to his positive relationship with the leader. Seoul's foreign ministry now saying it's been coordinating with Washington on a possible role in the Iran situation. South Korea also saying it hopes President Trump's message will lead to meaningful dialogue between the U.S. and North Korea. The Chinese Communist Party has recently issued new exit and entry policies, including travel bans. It's viewed as a diplomatic tool used to control dissidents and anyone who dares to criticize the regime. And now we're talking about South Korea imposing a travel ban on an American citizen who criticized the current South Korean president on U.S. soil. Morris Tan served as the U.S. ambassador at large for global criminal justice during President Trump's first term. And yes, you heard that right. We're talking about South Korea, a U.S. ally, not North Korea. Ambassador Morris Tan joined NTD Steve Lance from South Korea to talk about his experiences and the Chinese Communist Party's influence in the country.
Ambassador Tan, I greatly appreciate you joining us from South Korea. I want to start with your story first. How did you end up in South Korea? What led you there, and what is your current status?
Yeah, so Steve, I've been to South Korea many times. I would estimate I've been to South Korea maybe 18 times. I went 3 times last year, and this year I went as part of the Korean American Election Investigation Team, together with former Prime Minister and Acting President Hwang, his top attorney, Park Ji-hyun, and also from the U.S., Dr. Douglas Frank, who's one of the top data experts on election cheating in the United States. And so that was the umbrella under which I came on this particular trip at the end of May.
You're an American citizen. Right. You were in the first Trump administration as an ambassador.
Yes.
And now you are basically banned from leaving Korea. We just saw the Chinese Communist Party enact a similar rule or law in communist China. What exactly is happening with this with regard to your situation?
Yeah, so there have been 3 consecutive travel bans that have been imposed upon me. The first in June, the second in July, and the third was an interlocking one from mid-July to mid-August. And what's really strange about this is that even though the police found no grounds for the case to move forward. The prosecutors moved forward with it anyways, because it was the police who did the first travel ban in June. I went in for questioning. Their conclusion was there was no reason to move forward with a case. And yet the prosecutors did, and travel banned me, and indicted me, and then imposed a third travel ban upon me, even though the police found that there was no reason and no grounds to move forward. And frankly, Steve, this has no business being in a South Korean court, because this was based on a statement that I made at the National Press Club in Washington, D.C. And in that statement, I said, it is reported that, and then made statements relating to alleged crimes that were committed. And so that is speech by a U.S. citizen on U.S. soil, which is protected by the U.S. Constitution. And if it belongs in any court system, it's in the American court system. And so there's no way that there is jurisdiction here. What's really strange is the prosecutors said before I came this time that there was no jurisdiction over that. And then they changed their mind and they moved forward with it anyways. So this is politicized lawfare. There is no jurisdictional legal basis. They have not given me due process because they have not given me proper notice of all sorts of things.
I was just going to say there's an argument to be made that it's not justified to be in any court, especially not South Korea. I mean, our viewers might not realize we're talking about South Korea here, not North Korea. How have South Korean politics shifted in recent years, particularly in their approach in South Korea to China and North Korea? And what signs of sort of political or ideological subversion might you have observed, and what do you think is ultimately driving that force?
You know, as the Wall Street Journal has put it, South Korea has taken a hard left turn. You have a CCP-aligned, North Korea-aligned, radical extremist government that has seized power through election fraud. And you have, when you look at worldwide election fraud, it follows the path of the Belt and Road Initiative. And what is even more disturbing is that the center of exporting the means of election fraud around the world is right here in South Korea through an organization called AWEB, the Association of World Election Bodies, formerly supported by USAID in America. But this is the means that the CCP is using South Korea's base to then send the means of election fraud through electronic voting all over the world. And what needs to be realized is you have this rapid takeover that has happened in South Korea. And we are in grave danger of losing our blood ally, South Korea, to go into the CCP and the North Korean orbit. And this is something that the U.S. should be very concerned about.
I think it's important to note that in South Korea, of all places, their voting machines are made by Huawei, the CCP-linked telecoms company, which should be a concern for any nation. How aware are ordinary South Koreans of the country's broader political direction?
Yeah, so you're exactly right that Huawei components are used in electronic systems in Korea. And actually, recently, there was an investigation of the servers by prosecutors and police that found electronic voting manipulation that is happening. And finally, there has been some investigation into these servers. I would say a sizable portion of the South Korean population is aware and do not like CCP influence. The vast majority of the country, we're talking about like 90% or so, think that the U.S. is the most important ally for South Korea. And between 80 and 90% are against the Chinese Communist Party. And so how can you have a populace like that and then a government that is extreme radical leftists communizing the country, North Koreanizing the country, full of elite capture from the CCP through bribery and through blackmail and threats? This is the reality of what's going on, where you have full-blown hybrid unrestricted warfare that is going on intensively here in South Korea. And we are in grave danger of losing our ally through blood, fire, and steel from the Korean War to the present.
Yeah, a lot of blood spilled, American blood, in the quest to rid Korea of communism. My grandfather fought in that war. Former ambassador for the Office of Global Criminal Justice during the first Trump administration, Morse Tan. We hope to get you back to the States quickly and swiftly. Thank you.
Thank you very much. I appreciate it, and I salute your grandfather's service.
That's all for today's China in Focus. I'm Tiffany Meyer. If you have any feedback on the show or have something you'd like to see us cover, send us an email at chinainfocus@ntd.com. We'd love to hear from you. For on-the-clock original news coverage, visit us at ntd.com or download our NTD app. Thanks for watching. See you tomorrow.
Midnight rain, every small town highway starts to look the same. Cheap whiskey bottle resting by the sink, while lonely hearts sit quietly and think. Old jukebox humming in the corner bar, playing songs for people carrying scars. Smoke hangs heavy underneath the light, like broken souls hiding from the night. Neon whiskey road, take me far away, past the empty bars, memories that stay. Oh Lord, let me roam till this tired soul feels home. Every road I choose turns into these blues. Cold wind whispers through the motel screen about all the things that could have been. Train tracks shining underneath the storm like old ghosts trying to stay warm. My guitar keeps singing soft and slow, things this world will never know. And every chord beneath the southern sky feels like one more long goodbye. Neon whiskey road, stretching through the night like a lonely river, disappearing out of sight. Every dream I lose, every town I roam, still searching for a place this heart can call home. Rain falls gently on a Delta town tonight. Streetlights flicker in the fading light. Old men drinking slowly at the bar, talking about dreams that never got far. Smoke rises softly through the quiet room, like tired flowers trying hard to bloom. And every lonely blues song on the radio sounds like somewhere I used to know. Rain on the Delta tonight, cold against my skin. Oh, broken memories coming back again. Oh Lord, hear my cry underneath this southern sky. Every love I lose turns into these blues. My guitar rests heavy against the wall, like it already knows the rise and fall of every lonely soul that passes through, searching for something real and true. Wind moves softly through the pine wood trees, carrying old forgotten melodies. And somewhere down the darkened railway line, another lonely heart is losing time. Rain on the Delta tonight, slowly washing through like muddy river water, pulling me from you. Every road I roam, every dream I chase, still leaves these old blues written on my face. Smoke hangs heavy in this old blues bar. Street lights shimmer from passing cars. Bartender pouring another round slow as old train whistles echo below. My guitar hums with a tired sound, like a lonely soul still wandering around. Every broken memory comes alive tonight, under neon glow and candlelight. Smoky Delta night, burning low and warm, like an old blues record spinning through the storm. Every lonely mile, every faded sign still brings me back to the ghosts inside my mind. Rain taps softly on the window pane, trying hard to wash away the pain. But every melody still calls your name, and every midnight feels the same. Southern wind moves through the trees so slow, like secrets only lonely hearts know. And somewhere far beyond this town, another tired sun is going down. Smoky Dale tonight, hold me till the dawn, like the last old memory before it's gone.